In an ideal world, the user only presses a single button and gets the best investment strategy tailored to their individual risk and reward profile. How does that work? We, as staking wards, have to understand the user first, for example, by scanning their profile, in order to calculate the individual setup and choose the best products that fit their individual needs. Then we can simply calculate the setup and allocate their capital to the best products that are suiting their individual needs. Many of you are already building these products. That means we at Staking Wards can relax, because we know the staking part is already covered by the best in the industry. You keep the ecosystem running. You build the stellar products, and you are providing the industry with innovation and develop the ecosystem further every day. For example, our lead sponsors, like Luganotes, they are building an institutional-grade blockchain infrastructure. Lido, with their approach to simplified, secure participation in staking. Tenderize, building liquid staking 2.0, or Chainproof, with their world's first regulated smart contract issuer, or OBO, building distributed validators for Ethereum. One second. We at Staking Wards need to funnel the entire staking user flow by providing information and utility. We are aggregating all the necessary information by processing and normalizing data across the entire industry in order to make the most informed decision in behalf of the user. We will also provide utility to stake through the platform with our new staking assistant that we are launching in the next days. You might actually get a little sneak peek by coming to the booth, talking to Benedict, for example, and the rest of the team. What are the necessary steps to achieve the perfect stake? We are coming from data. Staking Ward's first version was actually only a spreadsheet. Then we need to put the data into perspective. Point 2, match and advise for the user, followed by action. This is where we are now. Let the user do something, allocating the capital through our platform. And again, Benedict will talk about that later in his keynote, the future of the staking user flow. And finally, building products on top of that, abstracting complexity away. But not to forget, doing all this while giving you all a platform to connect, share insights, and have fun on this ride. Welcome to the Staking Summit.
All right, cool. Yeah, thanks a lot. We're going to transition to the next panel, I think, next. And super excited. Let's make this a big success together. Super excited. Let's rock this.
Okay, guys, we're going to keep things flowing and moving. There'll be no long, drawn-out panels at the staking summit. So the next panel we have, and the first one of the day, is VC Thesis. Which type of staking company will accrue the most value? The panelists we have are Rico Müller from Sygnum. We have Praneeth, co-founder of Ethereal Ventures, Stan Miroshnik, founder of TenSquared, and Nick Matthew, investor at Figment Capital. Give them a warm welcome, everyone, please.
Hi everyone, thanks for joining this panel. I'll be moderating this for today. And yeah, to start off, since you guys are all working for VCs, give you an opportunity to pitch your portfolio companies. Which investments have you already done in the staking space, and why? If you just can give like an elevator pitch on the ones you've done before.
All right, so maybe I'll start. My name is Stan Miroshnik. I run a fund called TenSquared. Prior to TenSquared, I built another fund called 10T, and we're investors. We're later stage investors, and we're equity investors, and so we focus on companies that are kind of Series B plus. So we're very fortunate investors in great companies like Figment, like Blockdaemon, like Intstones. We're also investors in companies that use those services like Ledger, and also in a number of centralized exchanges that are building staking capability and staking tool sets for their customers, such as Kraken, for instance. So I don't know if any of that needs an elevator pitch. I think everybody here is deep in this space and would be preaching to the converted. So it's going to be a big part of how, what consumers want, what financial institutions want. And so the core thesis is this space is going to get much larger. It's a space that's not a winner take all. There's a distributed future to it. There's a centralized future. And we're looking to deploy capital across all of those ideas. So I'll pause there.
One of the co-founders at Ethereal Ventures, and we set the fund up in the start of 2021, but prior to this, we were essentially doing venture investments at consensus of balance sheet. And for us, I think the preference has always been to kind of follow the same philosophy that we've had of backing really strong technical teams and domain experts in whatever area or niche that they're working in and supporting them along their journey in that sense. And I think as it comes to staking, and if we basically look back at Fund 1, I think one of the predominant categories that we've had a lot of exposure to is the broader staking space. We haven't invested in infrastructure providers, but we have invested in a lot of staking related protocols. So we either led or co-led seed rounds in the likes of Opal, who's doing distributed validators, where we co-led the seed round in EigenLayer on the restaking side. We also led the Series A round for Alluvial, who's doing enterprise liquid staking. And personally, I mean, I've also sat on the board of Rocket Pool for a long time, having led that investment out of consensus. So I mean, in general, we look at the staking space, and we're also active participants in other ecosystems like Cosmos, where we run validators and relayers, and generally believe that the staking space will set the stage for a lot more institutional participation, a lot more ways for people to actually start thinking about securing the networks that they love and they want to keep using towards, like a decentralized future.
And I'm Nick. I'm an investor at Figment Capital. We're an early stage blockchain infrastructure venture fund that spun out of Figment, the infrastructure provider. We mostly do early stage token investing. So we've made a number of investments in the staking space, but just a few that I'd highlight are Obol, the DVT service provider, Alluvial, which does institutional liquid staking, and then Eigenlayer, which of course does restaking. And we're super excited about the future growth opportunities of staking, and so continue to invest in that area.
Perfect. So as it looks like you guys are all focusing on different types of staking companies, but in general, if you're evaluating a staking project, what do you really optimize for in terms of your assessment? Like, you could look obviously at the tech, the team, BD capabilities, the unit economics. What's really for you the focus?
Sure, I can start. I guess from our standpoint, one of the things that we look at is things that could fundamentally lead to a difference in the market structure from the way things stand. And these could be endogenous, things related to the protocol, things that have to do with, say for instance, lack of native delegation in protocol, or difference in the way withdrawals work, the capabilities that validators are supposed to have on the network. And there's this, again, exogenous things as it relates to other validators or other staking companies in the space or protocols in the space, like the support that exchanges have for staking-related products and receipt tokens, the mentality for people to have capital efficiency in that space. And if there are teams who manage to kind of understand the ins and outs of what these differences are, and if they can think about capitalizing on those, and they have the obsessiveness and the wherewithal to actually execute on that, then basically it's that those kinds of teams we back. But ultimately it then ends up being a lot of work on the BD side. They have to be selling, they have to kind of be convincing different forms of stakeholders and kind of tap into these. So that's something that we typically like to keep an eye out for. One last point I would probably add is that there's a very different notion of value accrual, especially when we are thinking about decentralization. And it's very different from like the winner-take-all mentality we've typically seen in Web2 companies. It means a lot more collaboration, a lot more work that has to be done on the public good side, for instance, and thinking about what it means in that theater. So if people have that kind of mentality, I think that's what we love.
Yeah, and on our end, I can speak to protocols because that's what I'm more familiar with. I think any good idea is probably going to get copied. So if you're building DVT, there's going to be multiple DVT teams. If you're doing restaking, there's going to be multiple restaking teams. And so really your defensibility is your liquidity. And so the question we always think about is, what is your ability to attract liquidity, and what's your ability to maintain that liquidity? And so really we're looking for teams that have some sort of technical edge or business development edge that allows them to attract and maintain liquidity in ways that other teams can't.
So as a later stage investor, we have the slight benefit of not having to take really the technical risk of a product. We come in a little bit later and already see customers that are experimenting with it or full on using the product. And so the risk we take is, quite frankly, scaling risk and a margin expansion risk. And so what we look for are existing KPIs of a well-running business, a phenomenal management team, assets under stake, how many customers are being onboarded, the growth of those customers. Even in this market, if we kind of hold the price of assets constant, are you able to succeed on the operating metrics that you've set out for yourself, right? And so looking at those few key things gives us a good sense for this business clearly knows who their customer is and who the persona is that they're pursuing, where and how they're going to compete. And there's a clear path that we can model out to this business being successful and eventually being either acquired or more. And so for us, it's more of these later stage criteria that make the decision.
Got it. And you already alluded to it actually in terms of the exit path that you guys are envisioning with your portfolio companies, be it an acquisition or on the token side, probably more like once it's liquid, right? Maybe if you can expand a bit on that, like what you're looking for with your portfolio companies, what you're optimizing for, and give a little bit insight in your thought process on that. Maybe starting with you, Stan.
Sure. So since we tend to invest a little bit closer to the exit, it's a big part of our thinking is to, is the company, is it a product or is it a feature, right? And so is it something that's going to be absorbed by, another synergistic player in this space, or is it something that can really stand alone, that can build and expand its business into multiple product lines that balance each other out? And is it a business that's going to be able to go public standalone? There's actually very few of those businesses that make it there. And so the question is really who is kind of the medium long-term partner? And I think in the staking space, as the founders of Staking Awards were just alluding to, you're going to have an influx of financial institutions that realize, hey, these are yielding assets and people want them, and so we need to have this capability, and most of them will do a very simple buy versus build analysis and say, okay, let's buy these capabilities that are going to be kind of the core of financial services for the over the next 10, 20 years. And so I think within this space, most folks are thinking about who are the long-term strategic partners, what are the M&A kind of opportunities, and so I think exit is kind of defined that way. There's a couple of great companies that are kind of reaching that escape velocity where they're becoming IPO-able size, right? Certainly Figment is one, Blockchain is another, and so those companies have kind of mapped out a path to being, a successful large standalone business. Many of the others, the space is young, and so we're just starting to see folks come into their own and become of the size where they can really consider strategic options. So that's kind of how we think about it later stage.
That probably looks a lot different on the protocol and token side. So maybe Praneeth, continuing on that.
Yeah, I think if we look at our portfolios, it's primarily like a token-based exit that we fundamentally see. I actually am quite curious to your points in terms of how there could be consolidation or verticalization happening in the infrastructure provider space. I think people need to be more experimental or innovative and see how we can structure these exits so we can have more of an understanding of like what these business lines would look like. But from like a token standpoint, I guess we just want to make sure that there is some notion of the token kind of securing off-chain agreements or value flows and providing a better way for people to coordinate within this network and using the token as a means to bootstrap that and also incentivize people to start using this as framework, and that's what we fundamentally think about. But
Sure. Yeah. I don't know if I have too much to add on the token side. I think a lot of these staking protocols are really attractive businesses in the long term, and are investments that we're really interested in holding for long periods of time. But of course, the way that these investments are typically structured are such that 3 or 4 years after the protocol goes live and the token is live, you have of course the option to sell, and so we're constantly evaluating the future opportunity of the protocols as to whether or not we want to hold those investments for longer periods of time, or whether we want to take some off the table and continue supporting the team.
Now, investing is only one part, right? Then once you've invested, you continue to be in close contact with your portfolio companies on the portfolio management side. How do you guys work with your protocols on the staking side? How close are you to them on a day-to-day basis? And yeah, if you can give some insight on how that looks like, maybe starting with you, Nick.
Yeah, so it depends on the specific business. I think if it's a business that's explicitly trying to attract liquidity, like a liquid staking protocol like Alluvial, a lot of the portfolio support that we do is about helping them with distribution, helping them attract capital, helping them bootstrap that liquidity that I mentioned earlier. When it comes to, say something like Eigenlayer, which is trying to attract protocols that will build on top of it to provide additional yield opportunities to stakers, a lot of what we're doing is helping Eigenlayer with the business development work of attracting those protocols that would want to build on top of its platform. So it depends on the specifics, but typically, they know the tech very well. They have more than enough engineering capability. That's why we invested in them. And so now we're sort of, helping them expand their network, meet more teams, attract more liquidity, attract more partnerships, and help them sort of lock in their position as the leading, staking infrastructure provider for whatever vertical they're playing in.
Just to add to some of those points, those are extremely pertinent. In that sense, there's a few things that we also like to focus on, which are primarily on the points around ecosystem alignment. I think when you kind of think about these protocols and their paths to becoming, like category leaders in the segments that they are working in, it fundamentally means, again, to the point that I made earlier, it's not like bashing down competition. It's not a zero-sum game, but it's fundamentally getting a notion of alignment between different stakeholders. And so a good part of that has to deal with getting people in a room, asking them to leave their egos at the door, and trying to facilitate something meaningful that could result from the same. There's a lot of people in the space, and that's something that we want to basically actively foster, but between our portfolio companies, between the broader space. So that's one thing that we like to do. And the other aspect is fundamentally building some of the other things that protocols engineering teams don't have as much time to focus on, which is building, say, a proper engineering and a proper team culture, helping them with hiring, helping them think through what it means to actually progress from starting out as an idea to something that could be more broad spanning. So those are some of the things that we typically like to do.
Yeah, I'd say for us it's more sort of scaling driven, right? So the company already has kind of a mature cadence, so there's regular board engagement, and the tasks that are in front of us are more around business development and strategy and helping cross-pollinate with our other portfolio companies, with portfolio companies of other investors in kind of the broader extended family, and also thinking about how we can help you win customers who in our network can bring that to bear. And then, a lot of it is just thinking kind of through growing pains. We've kind of seen what the good looks like. So what does the corporate finance function look like? What does HR look like? What does a founder divorce look like that's graceful? All kinds of issues that come as businesses get bigger. And, it's not just a dozen guys in a room, it's 40 people, maybe it's across multiple offices, maybe it's becoming a global business. And so dealing with those kind of strategic board level corporate finance, CEO kind of hand-holding type challenges is kind of where we spend most of our time.
And sticking with the topic of portfolio management for a minute now, if you look forward, what kind of catalysts but also obstacles do you see for the next phase of growth for staking projects? And obviously this is going to differ between the more later stage companies that you invested in versus the more early stage companies that you're involved in. But what do you see there in terms of catalysts and hurdles as well? Maybe starting with Praneeth this time.
I guess in terms of maybe even starting with the broader macro side, I think we still are in a place where long-term rates have been stubbornly high, and we will probably keep seeing a little more of that until things basically turn around and you have risk-free rates going down to very small figures, and that's when staking yields actually, matter and make more sense. But I think there's some time till we see that scenario. So, and while we're navigating that, I think there's definitely a lot more that we have to build up in terms of awareness and work on educating regulators. And as part of that, maybe a shout out to some of the work that's being done by the Proof of Stake Alliance and all of the coalition of node operators, staking protocols, DBT providers who are actually actively trying to frame the discussion in terms of what staking is, because staking is a term that's been widely bandied about, and we actually need to make sure that people understand what it is. So there's that, but I think this is some other catalysts in terms of, news around the ETFs that might spike some interest on the institutional side. And so we need to be in a place where, protocols, node operators, and other stakeholders in the industry are actually ready to kind of capitalize on this institutional interest that will be coming in, and be in a place where we can educate them and actually start tapping into those segments, and make it such that staking is, like a multi-$100 billion industry a year.
Yeah, I think another growth vector is just wider adoption of crypto in general. Praneeth spoke about the importance of alignment, where these protocols or staking businesses are, in some sense, with the ecosystems they're building on top of. The more that these staking businesses and staking protocols can support these networks, the more adoption they have, of course, the better those assets do. And these staking projects, their revenues are, of course, to some extent a function of token prices. And so if they can help with broader crypto adoption and more usage of these networks, then they'll do very well in it as well.
Yeah, I'd add to that I think the opportunity and the challenge is abstracting complexity, right? If you think about who are the users that we're addressing, a very small percentage of them are technical, right? The vast majority of the future crypto audience will access crypto through Coinbase, Kraken, Gemini, Ledger, and MetaMask, and will continue to do so. And so how do we figure out a way to deliver a simple enough solution where maybe it is a one-click product? How do we make the products work together where the economics are synergistic to everybody in the value chain? How do we make sure that these gateways don't absorb all the economics in the space, but are sort of ecosystem players and are creating value for everybody at the table? And so I think, again, abstracting complexity, I think, is the big opportunity, but it's also a little bit of the challenge I think the industry is facing.
Now I want to ask you a bit about the latest developments in the staking space, like DVT and restaking, which our colleagues at Ethereal and Figment Capital have invested in some projects there. So maybe starting that question with you, Stan, how are these developments going to affect the existing kind of, well, could call them incumbents, but in crypto that's always an interesting term, but how is that going to affect like companies like Figment, Blockdaemon, and how do you see them using these technologies and integrating with their products?
So I'd say I kind of love like financial complexity, and so creating derivatives on top of derivatives is super exciting to me. But one thing we should be mindful, especially coming out of this cycle, is how much sort of additional leverage we're introducing into the system, right? And how much rehypothecation is sort of tolerable, and I think that's one of the concerns from my perspective is as these products become more ubiquitous, how do we manage kind of the risk of that leverage? And I'm curious how my colleagues think about it, especially as investors and I go there.
Yeah, I think from our standpoint, I think I think I'm harping on this point a bit too much, but it's fundamentally like when I look at things like restaking, it's a way for protocols to actually start thinking about incorporating features that were not available in protocol, and actually trying to provide like a playground and a testing ground for validators to use some of their capabilities to not just secure the protocols that they're currently working on, but also try and see if there are new features that they could like lend their support to, and actually start providing these capabilities to Ethereum for that matter, like say single slot finality or having better auction mechanisms that are not natively available in protocol, given like the constraints that we have in terms of the validator set and the way Ethereum works today. When I look at things like DBT, it's fundamentally like a reduction of risk that I basically see, and basically helping facilitate paths towards less systemic network failures, but also a way to grow the pie by actually collecting data and making a lot more validator attributes available, maybe potentially even on chain, and using that as a way to like facilitate a new wave of products on the financial side as it relates to insurance and credit instruments for validators and node operators in this space. So I think it's fundamentally a way for us to kind of get new things in protocol and give people a way to experiment with this.
Yeah, and I think the most concise way to think about all the new trends in staking is that they provide more investor optionality. So originally with POS, you could stake or you could not stake. And then with liquid staking, you could not stake or liquid stake. And with some of these new trends like DVT and restaking, they provide a much wider range of options for investors. So they can choose whatever portfolio of protocols they want to help secure, or what additional services they want to provide with their capital, and get whatever specific risk-reward profile they want on their staking. And of course, that needs to be managed responsibly, and hopefully investors will converge around specific showing points of risk-reward profiles. But yeah, like all these new tools are about providing optionality for investors and additional expressivity.
Do you have anything to add to that, Stan, or does that make sense for you in terms of the risk management perspective on the rehypothecation of staking yield?
No, I think that's an excellent point about introducing additional optionality. I think that's exactly right.
I think we're close to the end here. Maybe giving the opportunity to the audience as well to ask questions if there are any.
Hi, gentlemen. So currently, Ethereum is the de facto leader in the overall appetite for institutional investors to put cryptocurrency onto a staking mechanism. How do you see this development in the future? Is it that ETH will win in the long term, or are there any others who will make up some market cap of Ethereum staking?
I mean, we're believers in a multi-chain world. I think it's going to be, consumers are going to demand much more sort of beyond Ethereum, and multiple types of products, multiple slices of yield, multiple types of risk. And so I think it's a world of many winners.
At least for me, and as part of some of the more recent conversations we've had on the institutional side, it's all Bitcoin. I think people don't see staking as much as they should be seeing staking for what it is. So I think we still need to really grow that pie. We need to get people to understand what staking is and get to facilitate that. And I think the beneficiary for that will be Ethereum to start with. I think it has the largest stake available. I think there's a lot more understanding around that. So we'll see that, but there could be more flows in the future to other runtimes, to other protocols. So.
Yeah, just in terms of like the distribution across chains, you'll probably see some power law distribution, like some sort of weak power law distribution, and we think Ethereum is going to be that dominant protocol, especially with eigenlayered restaking, setting Ethereum as like the primary staking platform. But of course, we believe that a lot of these networks are going to be very successful and important in the long term, and so we're excited to see the growth of a multi-chain staking ecosystem.
Okay. Well, that brings us to the end of this panel. Thanks to our amazing panelists here, and thanks for joining.
So, on to our first keynote of the day. Before we get there, I just want to quickly remind everyone that if you download our Umbrella app, you can see the full agenda of today, and you can see a floor plan. We want you to explore everywhere, so make sure you do that if you haven't done already. So moving on, we have our next keynote is Trends Fueling a More Competitive Liquid Staking Landscape Ecosystem. And presenting, we have Michael Hua, who's a researcher at 1KX. Make him feel welcome.
What do we think Lido's market share will be in the next 2 to 3 years? This is a question that Vitalik has definitely been thinking about, given that he recently wrote a post on potentially enshrining liquid staking. He also mentioned that potentially relying on moralistic pressure to get users to switch away from Lido is not sustainable in the long run. I think we can all agree that competition and in the liquid staking ecosystem is very healthy for the network security and resilience. However, Lido's market share continues to grow and currently hovers around 31.5%. They also recently passed a proposal not to self-limit, so that number will probably continue to rise very soon. Today, I'd actually like to present 3 main trends that I'm seeing that will actually incentivize adoption of long-tail liquid staking tokens and pull market share away from Lido. The first one is novel infrastructure offerings that make it easier for any front end, such as a dApp or a wallet or an institution, to offer composable liquid staking solutions to their users. The second trend is general market forces, where these front ends are actually incentivized to leverage this new infrastructure to push new liquid staking products to institutional users, as well as old DeFi ones. And the third one is actually unique token designs, in which front ends will leverage to help solve the cold start problem and drive value away from Lido. Firstly, novel infrastructure offerings. There's 2 categories here. The first one is liquid staking infra to support front ends, which results in less technical and resource overhead for front ends. And the second one is better DeFi composability for users, which results in a better UX and more protocol integrations. I'd like to highlight 3 different liquid staking infra projects that are currently launching in the space. The first one is Kiln, who's building an on-chain product. There's 2 kind of buckets here. The first one caters more towards funds and enterprise custody solutions, where the liquidity vehicle is actually an NFT. And this NFT can be used throughout DeFi, whether it's for lending or for exchanging. And the second one is a little bit more crypto native, which is a staking pool in which the liquidity vehicle is actually a regular ERC20 token. And this allows wallets and exchanges to essentially launch their own white labeled product. Kiln allows anyone to offer liquid staking in a transparent, non-custodial, and hassle-free manner. The second project, which I'm sure will be talked about a lot later today, is Stakewise v3. It's essentially a protocol that allows anybody to build customizable vaults on top of the protocol. Each vault could be managed by an institution or a wallet or an exchange, and they can customize these parameters such as fees, LTVs, slashing insurance. And the beauty of this protocol is that anybody who mints a liquid staking token is getting the exact same one, regardless of which vault they're depositing into. And this allows for aggregated liquidity across DeFi, whether it be for exchanges or lending protocols. The third infrastructure piece is node set. So I'm sure all of you know, but Rocket Pool has this thing where node operators need to collateralize RPL and ETH. The issue is that not every node operator has enough capital to scale, and a lot of node operators don't want to take on price exposure of the Rocket Pool token. NodeSet essentially allows RPL and ETH holders to lend their tokens to these node operators and in exchange for a fee. And this actually eliminates the price exposure that these node operators need to take and will hopefully free up the deposit queue that's currently accruing. The second sub-bucket is better DeFi composability. So this is a chart that I put together about a year ago, and as you can see, very early on, it was very hard for anybody but Lido to get integrations. It very much relied on the Chainlink Oracle, and that served as the biggest bottleneck for LST adoption and integration. And also, 45% of all SDETH is on lending and DEX platforms, which further highlights the importance of integrations. So previously, these blue chip assets, such as Lido's SDETH, could only be listed on major lending protocols. There was like the Chainlink Oracle requirement, but also there was limited optionality for lenders. Whenever you deposit into Aave, you can't choose which collateral you're lending against. In the near future, any asset will be able to be used as collateral, and liquidity for long-tail collateral will actually be much more efficient. There will also be less reliance on oracles in general. The result is more integrations, more use cases such as looped yield, and more composability for long-tail liquid staking tokens. Just to highlight a few protocols innovating in the lending space, the first one is called Ajna, which allows lenders to choose different price buckets to deposit into. And this solution is also Oracle-free, which means that lenders are taking an active approach in lending, and that collateral can be any pool and any asset. The second one is called Morpho, which actually was announced recently. And what's interesting about this one is that they actually launched a vault layer on top of isolated pools. So you can start to imagine that protocols will start creating these vault strategies that specifically cater to lending to long-tail liquid staking tokens. Other protocols in the space include Ion, which is an ETH lending protocol that determines parameters through consensus layer data, Euler, which is coming out with V2 very soon, and Silo, which is already launched and has siloed lending markets with over 160 million in TVL. So in summary, the first trend is novel infrastructure offerings. The combination of new liquid staking infra alongside DeFi lending innovations will entice brands such as wallets and exchanges to run their own liquid staking solution, all while user experience is dramatically improved due to better liquidity and integrations. The second trend is general market forces. There's two categories here. The first one is institutional needs, and the second one is verticalization from various front ends. So the overarching thesis here is that institutional capital is the largest incremental staker in the next few cycles. And institutions have much different needs compared to crypto native users. Lido's solution is currently not the best fit for these institutions, and therefore it gives an opportunity to other protocols and companies to effectively take market share of a very, very fast growing market. In terms of needs, there's many examples, but the most prominent ones include KYC and AML of parties across the stack, whether it be depositors or minters or the traders themselves. Auditability, so how easy is it to trace and attribute rewards? And then also segregated pools. So a lot of American financial institutions cannot mix funds with non-KYC'd users. So just wanted to highlight a few protocols and companies working in the space. So Kiln, which I touched on earlier, is working on white labeled solutions for companies. Alluvial has over 60 million TVL, and they KYC the minters as well as the validators. Stakewise has an institutional product called Portara, which actually fully end-to-end KYCs every party, and Rockex is focused on centralized exchange liquidity. There's also vanilla staking solutions such as Blockdaemon and Figment as well. The second general subcategory here is verticalization from various front ends. So there's many pillars here. The first one is non-DeFi communities. So on Solana, there's an NFT community called MonkeyDAO who actually launched their own liquid staking solution that's still live today. And we also saw on Luna, many applications actually ran their own validators and incentivized native tokens to get users to switch from some of the larger validators. The second category here is wallets. They most definitely own the relationship with the user, and MetaMask has already launched with Lido and Rocket Pool's liquid staking solution. So I think it's pretty possible and intuitive that they would potentially run their own and put on a fee on top. The third category is centralized exchanges, where Coinbase and Binance have already launched their own liquid staking tokens. And I believe that others will follow suit as well as the capital inflows get bigger. And the degree of the success already of these two companies shows how important the user relationship actually is. Coinbase is the second largest solution despite charging the highest fee, a 25% commission. So in summary, many types of front ends can offer their own LSC solution to their very sticky user bases. So Lido caters very well to the crypto native user profile, which is why they're the most dominant solution today and represents the majority of current TAM. However, this changes with the entrance of institutional players. Lido also faces very heavy competition from protocols and brands trying to verticalize. The third one is unique token designs. There's three main pillars here. The first one is protocol value accrue. The second one is vampire attacks. And the third one is new incentive experiments. On the value accrual side, I think it's become clear that crypto native users favor projects that have value accretive token models. And Lido's current model does not give yield to token holders, which gives an opportunity to these newer LST protocols to essentially create a unique offering on token design alone. And one anecdotal evidence of this is GMX and Sushi, who actually built their initial communities through value accretive token models as they essentially diverted yield to their holders who also happened to be the users of the protocol, and this ended up creating a very nice flywheel for them. Another interesting angle here is value accrual is the token itself. So Rocket Pool, they get node operators to collateralize RPL, and this acts as a very strong token sink, which leads to more value creation for node operators and holders. And as a result, their market cap to TVL ratio has consistently traded above most of the other players in the space. The second pillar that I'd like to touch on is vampire attacks. So specifically, Diva launched a vampire attack on Lido about a month ago. And within that time frame, they were actually able to get over $40 million of Lido TVL converted to Diva ETH. So to incentivize users to switch, they actually gave native protocol tokens. And it's quite impressive because it's a bear market. And although I understand, it's not a very big chunk of Lido's TVL, when you start to think about maybe 5 or 10 or 15 of these protocols vampire attacking at once, and also this happens during the bull market where the tokens are actually perceived to be more valuable, that could lead to a very meaningful dent into Lido's market share. The third pillar here is new incentive experiments. So on top of providing maybe yield to stakers, there's tons of other ways to incentivize adoption. The first one is emphasizing rewarding node operators. The second one is leaderboard-style referral system rewards catering to whales, which I'll touch on in a second. And the third one is liquidity incentives. And then the last one is novel airdrop mechanisms. So one idea that I've been tinkering with is conditional airdrops. So what if you promoted that if the protocol got maybe, let's say, like $1 million or 10 million or 100 million in TVL, you would only give those rewards if that milestone was reached. So this essentially creates kind of a common goal within the community and an interesting way of bootstrapping attention. Touching on the referral system, Lido did a tremendous job when they first launched. So they launched a program in July of 2021, and actually the top 10 referrals accounted for 99.62% of all of the incentivized ETH that came into the system. The exact same story here happened on Solana, where the top 4 wallets basically accounted for 99.9% of all ST sold deposits. And what's interesting is that these incentives are temporary, but they create a lasting impact. So when Lido first launched the incentive program, and for 30 weeks, they actually had much more deposits in the incentive ETH, which is the gray line, than the organic ETH that was deposited, which is the orange line. But after a certain period of time, when they got more TVL and more liquidity and more integrations, that actually flipped on its head, and organic ETH deposits became a much larger share of the protocol deposits. In summary, the third trend is unique token designs, emphasizing token value accrual, vampire tax, and token incentives can help solve the cold start problem and serve as unique propositions to get users to switch from Lido. If you're looking to partner with one of our portfolio companies or are building in the space, please do reach out. My Twitter is Mikey0x_. I'll also be around for the next few weeks. And thank you for listening to my presentation.
Moving on, our next panel is a big one. They're all big ones. We have 17 panels, 17 keynotes across both of the days. I'm particularly excited for this next one. We've got 5 heavyweights in the staking space. I hope that's not an offensive term. Moving on, the next panel is Deciphering Institutional Capital and How to Attract It into Staking. I'd like to welcome to the stage our moderator, Edouard Lavidalle, co-founder of Stakin, Frederick Allen, institutional sales and trading at Coinbase, L'Oreal Gabriel, CEO of Figment, Laszlo Slabo, co-founder and CEO of Kiln, and Parker Paul, head of global info solutions. Give it up.
Hi, everybody, and welcome to your second panel of the day on deciphering institutional capital and how to attract it for staking. We heard it from the previous talk. Institutional capital might be the largest incremental contributor to staking in the next few cycles. And here we're going to try to understand what is institutional capital, who are institutional stakers, what do they want, what are their requirements, and how to attract this stake in also an evolving staking landscape. I'm Edouard Lavidalle, I'm the CEO and co-founder at Stakin.com, and I'm here with a great lineup of panelists. Frederick Allen from institutional sales, trading and prime at Coinbase, Laurian Gable, CEO of Figment, Laszlo Sabo, co-founder and CEO of Kiln, and Parker Poor, head of global at Imstones. And without further ado, here's my first question for the panelists. Who are exactly the institutions involved in staking, and what role do they play in the current staking market?
Let me start that one. Yeah, so I think it's, I'll go first. I think it's important to define what we mean by institutions. I think it's a slippery term. Maybe most people define institutions as whoever's bigger than I am. So it's often very relative. So a VC fund will say, well, I'm not institutional. My LPs are institutional, and they'll say my prime broker is institutional, and they'll say, well, the big banks are, and then they'll say BlackRock's institutional, and then BlackRock, I don't know, they'd say central banks or treasury are institutional. So I think it's like very important to sort of define what we mean by institutional. From running a business perspective, I think it's a customer segmentation issue. So, for example, at Figment, we really have we bucket those into 2 categories. One would be what we call essentially large token holders. Again, not so well defined, but anyone who controls a large amount of tokens. In the case of 32, or in the case of Ethereum, that would be 32 ETH, which is an easy one. And then token aggregation points, so anyone who has influence or control of other people's tokens. And that's sort of how we verticalize our customer, but I think it's really important, whether you're a protocol or a staking infrastructure provider, to really understand what you mean by institutional, because the term is like not very well defined. I mean, I don't know how you think about Coinbase. You call yourselves institutional? Probably not. You think your customers are institutional, right?
Absolutely.
Whereas
yeah.
I would say, oh, well, Coinbase is very institutional.
I completely agree. One thing to emphasize on that in splitting those two customer segments in the staking context is the second category that Lorraine touched on is the large enterprises who have underlying customers who are staking as well. And there's certain little specific product nuances that they require. For instance, they may be a little bit more sensitive to SLAs of staking validators and product nuances like the configurations of the validators and those types of things.
Okay, so yeah, we got large token holders, large enterprises, and very sensitive to SLAs and this type of things. Who do you see as institutionals as well?
No, I think I kind of agree. Like two main categories: the crypto platforms, exchanges, wallet custodians, and the large holders. Is it like crypto funds, asset manager, a well, right? It's like an individual that has like 1,000 ETH, definitely could be treated as institutional. And if you look at the platforms, as you mentioned, there's like either the wallets will serve retails, exchanges would do retails and institutions, and custodians would be more on the B2B side of things, right? So serving other institutions through the platform.
I agree. Just to piggyback on that, I think when we look at institutions, there's two buckets. There's the traditional finance way of thinking, which they have done for the last 80 years, and then to your point, the large token holders who got in early in the market, and they're gonna require very different factors in regards to KYCs and compliance and regulatory. And if we don't evolve the staking community, then we're gonna be left behind. And I think it's time for us to evolve and bring them to the table and say, how would you like this to look? And if we're not willing to do that, we're going to miss a big opportunity. So I'm glad it's happening.
Yeah. Maybe there's another definition of institutions, which wasn't it originally the blockchain was supposed to disrupt them?
Yeah, that's true.
I came for the disruption and got a BlackRock t-shirt.
Yeah, it seems like if I have enough ETH and if I'm a big whale, I'm an institution as well, but with different needs than our TradFi friends. What do you think are the requirements and expectations from these different type of institutional stakers?
I can start that off. I think the most, what they really look for, and it's evolved as staking, the staking sector has evolved the last 4 years at least that I've been in it, is that all stakers require the most secure and diversified staking infrastructure configuration. So security and then performance as well, so generating those staking reward yields. But the key factor, and now we're seeing more of a demand for it, and we as a staking industry certainly need to focus on, is the reward reporting and the data integrity. Those three key factors for me, for sure.
I think for Coinbase, also a big legal team, right?
Big legal team, big legal team, very important.
I agree with you, Frederick, on that. We have, reporting has to be top of mind and has to be critical in every aspect of it, whether you're talking to the big four accounting firms who rely on that data, or you're talking to some of the companies here that present very good reporting skills. You have to have it. There are still companies out there that are doing Excel spreadsheets, and that's just not going to fly with the institutions. And if, again, we are not evolving, then we're missing an opportunity.
And it's still super hard to find in the space, right? I guess that's why we hear staking rewards, to find good data, just to, on the 5 largest protocols, to have how much a wallet has been earning block per block on staking, and showing this to the regulator or to his accountant at the end of the year. Yeah, I agree. So definitely data is one. You mentioned security insurance. It comes with trust. And yeah, I guess sometimes they also want to spread the risk. So using, not one, but 2 or 3 of the largest provider that actually brings security and trust and good data. And last but not least, they sometimes need liquidity as well, right? Well, I'm definitely sure we'll talk about it, but all these ETP, ETF providers that are coming, or even a wallet or platform needs liquidity at the end of the day.
I can touch on that as well. So we had some exciting news last week or the week before where 3IQ, a very large Canadian asset manager, just announced they're launching a staked ETH ETP product, first in North America, of course. And one of their requirements, of course, for their underlying holders is liquidity. If in an ETP structure, if you have redemptions, and so for staked ETH, with the lockups and unbonding queues of staked ETH, how do you address that sort of product? At Coinbase Institutional, we're not just providing the underlying validators to run that, but we also have a financing business for borrowing and lending, so they can lend to these asset managers overnight. And also liquid staking tokens we offer within custody as well. We're a founding partner of Alluvial alongside the Figment guys, and we have our own in-house liquid staking token, CBETH, as well. So back to the point, those large asset managers can use these different products within the staking context to address those.
Yeah, understanding that buyer is really super important. Generally speaking, if you're at an institution as defined, you're probably pretty risk adverse. Otherwise, you'd be at a startup. So it's they really look at the downside almost more than the upside. So, and it's very tactical. So can you fill out a detailed RFP? Do you have a whole bunch of security information they're going to require, a bunch of certifications, ISO, et cetera? Can they get on the phone with your chief regulatory officer? So having that role, does your cap table look like them? So there's a bunch of little tactical things that are super important for that audience, but remembering basically they don't want to get fired for using you. And if you sort of think that way and addressing their downside fears, it's super important for serving that audience.
Yeah, if I can just jump on the regulatory aspect of things, like even if none of the regulators in the world has clear guidance towards staking right now, like when you are an institutional player, you need to be able to give a bit of visibility of where you think regulators will put the needle, or and obviously according to different jurisdiction, right? So it's like when they're talking to you, you need to have like a proper legal team or compliance team that actually again brings them trust when they decide to stake with you.
Our head of regulatory probably does more sales than lawyers.
That's right. That's right. It's all going to be fine,
It's interesting you say that, because when we talk to some of the publicly traded companies out there, one of the first questions they ask is the regulatory, the compliance, the security measures, the private keys, what's in place in regards to X happens or Y happens, what's your runway? And I think staking in general has risen this wave, and when it came crashing down, we needed to adjust. And I think that bull market's coming back, and we better have these things in place when the institutions come back. Whether that's a SOC 1, whether that's a SOC 2, whether those different licenses, it's not the wild, wild west anymore. And if you want to take a proactive approach and attract those institutions, you need to do that.
Yeah, we touched down on quite a few points. Those institutions, they have very high requirements from operational compliance, regulatory compliance, data auditability, reporting features, risk minimization, and also diversification as they look to diversify stake among different providers. And they do a lot of due diligence. Legal closes more than sales. How do you see that typical institutional staking journey from the day that an institution starts looking at the opportunity of staking to the day that they actually stake? How are things happening there? How long does it take? What's the experience like?
I think of the non-crypto native institutions, you're still starting at basic 101 education. And staking, unfortunately, is still pretty poorly defined for that audience. this audience knows what we're talking about, but that audience will often think of it as lending or DeFi or something like that. So you really start at first principles and then work your way up from there. I also think it's worth thinking about from a market share perspective if you're trying to decide if you want to serve that audience. And I think someone will correct me on these numbers, but if you look at Ethereum, probably 90+% of wallets are less than 32 ETH, but 80% of volume is wallets with more than 32 ETH. So to think about how you want to serve that audience, which audience you want to serve, and then also, so where's the TAM, where's the market opportunity, and then what's easier to serve as you expand? Is it easier to go from a smaller audience to a larger institutional audience, or going the other way? So I think those are like some considerations, either if you're launching a business or from a protocol perspective to think about.
To touch on two things that Lorraine said as well, the education piece of the staking life cycle can be extremely long. I remember back in the day, 2019, 2020, we were educating.
What do you think your average sales cycle is?
Long time, long time. Even for the crypto native funds, who you would think would be very educated on how staking works. Back in 2019, we were saying to these crypto native funds, you guys own like 2% of this layer 1 stakeable token.
30 or 90 days to 180 days?
Yeah, you need to be staking. But now with the traditional asset managers and traditional hedge funds looking at staking, the education cycle can be extremely long, 6 months, 12 months. But then moving into testing as well and actually executing a stake can be even longer as well. And to Lauren's point, it depends on market cycles as well. Hate to say it, but in a post-FTX world, we've seen the priority of traditional asset managers and hedge funds coming into crypto and testing, staking in particular, is fallen down the priority list. The other thing that Lauren mentioned as well is the actual staking product. We launched a partnership with KEYNOTE on a partial ETH staking product as well, which is something that's very popular. And as Lauren said, a lot of wallets, whether it's 90%, have less than 32 ETH. So the staking product is really critical on how to execute.
Yeah, I mean, and if you divide institutions by like 3 categories, you would say like the whales, the crypto native and the TradFi. I would say, the whales, they can stake through already non-custodial platforms, such as Ledger today, and they won't take long to decide, right? It's like they look at the APY, they look at the commission, they check the player in the back end and the stake. If you look at the crypto native, definitely they will be looking more, into what insurance you have in the back end now, like what slashing, anti-slashing policies you have. But still, they will be willing to stake faster than a TradFi player, for example. That, as Lauren said, you need to come back to the basics. Like staking is not DeFi. It's consensus layer rewards and not. There's no smart contract risk in that sense. Most of these players haven't staked yet, and they're coming in the coming months and years. Yeah.
It's so basic, they think you're a counterparty.
Yeah.
Basically. They assume you're custodial just by definition.
That's right.
That's how sort of basic it is.
And what's the role probably being played by wallets also with institutional staking? I heard you launched a new project.
Partially staking, yeah, alongside KEYNOTE. So the importance of the wallet, I mean, the staking flow, you execute a stake through a wallet, through your wallet solution, whether it's a big custodian like Coinbase or a smaller wallet, hardware wallet. So the importance of wallets in the staking flow is critical. You can't execute a stake without the wallets, and therefore for us staking providers as well, we need to partner with these wallets and custodians as well.
Yeah, that's one of the things that I'm very proud of at Aimstones is we actually have a drop-down in which we partnered with, whether it's Fireblocks, Ledger, the MetaMask wallet, that you can go on the platform and pick the wallet and stake directly through your wallet. So making it seamless for institutions and making it seamless for individuals is crossing that border.
So the interface is very important, or being integrated within these interfaces in order to capture institutional stake. Do you see institutional staking evolving through time? And I know there's lots of innovations going on from direct staking, liquid staking, restaking.
I think, yeah, I think this was brought up on the first panel. I think Stan specifically raised the issue about whether this is a feature or a full product set. Is it a feature of custody? Is it a feature of a prime broker? Or is it a separate service provider offering? And to be honest, I think that's still an open question. And where will those decisions get made by the buyer? So will that happen in a trading interface? Will it ultimately happen in a Bloomberg terminal? Will it happen with their prime broker, with their custodian? I mean, in traditional finance, no one interacts with their custodian ever, and nothing happens in that interface, right? Unless you lose a paper stock certificate or something weird. But maybe that's not the case because custody is very different with crypto. So I think that's an open question, and we'll have to see that evolve. Right now we have sort of a very diverse ecosystem of independent providers. I think that's good for decentralization. I think it's a really open question about the role of custody and prime brokers playing that going forward.
Yeah. I think the industry has completely changed over the last 2 years. I mean, we weren't talking about restaking or liquid staking just a couple of years ago, and now it's top of mind. And what's interesting to me is the institutions have even came and wanted to have conversations about liquid staking and about restaking and, tri-party agreements when it comes to collateral management. There's many different aspects that are going to fall under staking, and I think there's a lot of opportunity.
A lot of interest, institutional interest from traditional hedge funds in particular about restaking. I mean, liquid staking, the cat's out of the bag, but a lot of interest, and that education cycle on restaking Eigenlayer has started the last 6 months for sure.
Yeah.
I mean, you touched on basically ETP and ETF that will be like massive drivers of institutional adoption in staking in the coming years. ETH, staked ETP, staked ETF will emerge probably in the coming months next year, and they need liquidity. So borrowing and lending, providing them liquidity at the brokerage level or validated NFT, I think it's a good product for this. And then definitely restaking, right? But they would look at the risk of, having an 8, 9, 10, 12% rewards mechanism on restaking is great. But what are the AVS, or on top of Ethereum, what are you running as additional validator? Like, do you trust the chain link? Maybe you trust Ethereum and chain link, right? But do you trust Ethereum and a chain that you don't really know? And it still comes back to, are you using the Figment or the Kiln of the world or Coinbase Cloud? As like, how do you have anti-slashing policies? Do you have insurance? Do you do the data properly? And obviously, restaking is, in that sense, is an exciting opportunity for our customers tomorrow.
So an opportunity they're taking a look at, but keeping in mind the risks behind the operations. And it sounds like we can potentially expect higher yields from these opportunities.
Higher yields?
Yeah.
I mean, on restaking for sure, but to Laszlo's point, I mean, the risk-return equation needs to be emphasized within staking, and particularly restaking, but also to take a step down back to traditional ETH staking. The ETH yield is what, like 4 or 5% now. With the US T-bill at like the same, a lot of people looking at coming into crypto, new net capital, they're like, why would I buy ETH and then stake it to get 5% when the risk-return equation is completely different? Why don't I just buy US T-bills and get the 5% for virtually no risk?
Yeah, that's an interesting point, and I think it's a bank in Japan is actually giving you the option to whether get staking yields or interest on treasury bills. And I don't know if that's public yet, but this just happened in Japan. So I think there are going to be different options, and it's a vehicle that produces income, and people are going to be able to make some choices. And again, I think the timing is pinnacle for us.
With staking ETFs probably coming to market, staked ETH, staked ETH with restaking options, how do we ensure regulatory compliance, since that's definitely something that these institutions are looking for?
So I can touch on the OSC, as I mentioned before,
we should always be buying you guys lunch.
Yeah. In the US at least, yeah. So, but to touch on Canada first, with 3IQ, large asset manager, just launched their staked ETH product. They worked very closely with their regulator, the Ontario Securities Commission. So to your point, what is the focus on regulatory and compliance? It's working closely. The first step is working closely with your regulator. 3IQ did it successfully up in Canada, in Ontario. Down in the US, we are working closely with our regulators in the SEC, and yeah, we do have a very large and important legal team at Coinbase working through it. But my point is, it really starts by educating and working closely with the regulators about what is staking, what are you exposing the people who are staking, what risks you're exposing them to.
Yeah, I mean, outside of the US, specifically in Canada also, we've actually gone to the regulators with an exchange customer to make a presentation to them about staking.
Yeah.
So that's how sort of, again, tactical and ingrained it can become. I think on the staking ETFs and ETP issue, I think it's really important to think about who might be the winners and losers if those are actually successful. Not just from a staking provider perspective, but probably for centralized exchanges who don't do custody. Probably losers, because people can buy them through their brokerages. So for pure crypto exchanges, probably losers if they become successful. Brokerages who didn't have any crypto offering, probably a win if they become successful. And staking providers, depends on if they use a diversified base or go with one or two. But I think it's just like if they, that's been a result of a lot of the price action has been from, those press releases from BlackRock, et cetera. So I think it's kind of fun to think through the consequences if people are starting to buy Ethereum, and I suppose Bitcoin doesn't really apply here, through those vehicles rather than directly. So I would think for your business, might hurt the exchange business, but be really good for the custody business.
We're all about growing the crypto ecosystem. Yeah, we have something like 100 million retail users on our platform, but growing the crypto industry as a whole is definitely our focus. And to his credit, Brian Armstrong, he's lived by that for 11 years now, and he sticks to it.
Any thoughts from an EU perspective?
Yeah, I mean, coming back on ETPs, and even for centralized exchanges, I'm a big believer in on-chain flows, actually. The rewards mechanism, liquidity, if there's liquidity, either pooling or author validator. But the beauty of blockchains is that a regulator can, differently to what happened to an FTX with complete opacity, but what we've seen in other TradFi banks recently is like you could track through a Dune dashboard or through another dashboard, like the flow which is happening on chain, right? And yeah, I'm a big believer of like flows being staked and rewards accrue to a wallet, could be segregated, could be pooled. And happening all on chain, and I think regulators will set these standards as a default in the future.
I agree. I think you made a good point earlier about the staking alliance. I think Frederick, you made it. If you're not involved, from a perspective of the company and talking to these regulatories and asking questions and bringing, really successful cases to them and saying this is what's out there, then you're fighting the uphill battle. And I think everybody on stage has taken the point of, let's go start the communication. Let's start talking about this to get this industry where we think we can get it. So,
thank you. I think we have a few minutes left. Probably a last question for all of you, but as we look into the horizon, then the probably next 5 years ahead, always hard to project ourselves in crypto, but what do you think is the most transformative change that staking service providers should prepare for in order to work with institutional capital?
Wow. Do you want to start?
I'll take that one. I think someone said it on the previous deck, optionality. I truly believe you need to have more options, and tri-party agreements when it comes to collateral management, I think is going to be a huge part of our business. That's definitely the conversations we're having right now with hedge funds.
I think, to touch on that, I think the DBT technology will improve the staking industry as a whole because it'll lower insurance and help bring traditional insurance underwriters into staking. They do exist, they are participating, but not in great size. So new technologies like DVT and Ogles out there in SSV, new technologies like that, I think will be transformative in bringing down or bringing more insurance underwriters into the staking industry, and therefore that risk return of potentially getting slashed is almost non-existent, hopefully. I think that could be pretty big in the future. I agree.
Yeah, I mean, increasing our security policies, you know, even the way we handle validation keys, for example, increasing our insurances, increasing you know, getting more accurate data into the staking environment still, and that's still in many of these chains a big problem. And again, putting a lot of these flows on chain with the risk that it implies, but you know, having the same standards of securities. But yes, I think you know, the on-chain world will win at the end of the day.
Data uniformity and UX still has a ways to go.
You said, sorry?
Data uniformity and UX still has a way to go.
Absolutely.
Right. Amazing, guys. Well, I'm very excited to see where the staking space is at today. And thanks a lot for sharing more from your perspective of the institutionals staking. And yep, a few years ago we were definitely not here, and I'm excited to see what are things going to be in the next few years as we're building the internet bond, and how do we bring this next billions of dollars into staking, and how do we bring the next billion users into staking. Thanks a lot. Thanks to our panelists.
Okay.
back-to-back panels with our next one. But before we move on, I would like to remind everyone that we do have some workshops going on at the same time. We have a workshop on now mapping the regulatory landscape of staking in the breakout room. So if you refer to the floor plan, you can see where the breakout room is. So yeah, moving into our next panel. This one's hosted by one of our very own at Staking Rewards. The panel title is How to Scale Staking to 1 Billion Users. The moderator is Benedict Gritz, Product Manager of Staking Rewards. We've got Hao Jiang, Principal Cloud Solution Architect at Tencent Cloud. JK, founder of Aprabara. Mete, Head of BD, KuCoin. And yeah, I'd like to welcome our guests to the stage.
All right, welcome everybody. Before we get started and to talk about the UX and adoption of staking to 1 billion users, I would like to give our guests and panelists a chance to introduce themselves real quick. Let's start with you, JK.
Yeah, thanks for inviting me. I'm JK. I'm the founder of Apibara, and Apibara builds products and toolings for the staking ecosystem. So far, we've built out protocol staking.info, where we share the latest staking statistics. And then now we're currently building out staking.xyz, and that's going to launch in 1 or 2 months, but we'll see. Yeah.
Hi guys, I'm Mete Elmas, working at KuCoin as head of BD in MENA. I've been working for KuCoin for more than 2 years, and I've been exposed, let's say, to crypto in 2016, right before ICO boom, we can say. Before that, just like any of you, probably I was working in the real sectors like automotive, etc. But this passion brought me here, I guess.
Thank you, Mete. Howie.
Yeah, thanks for having me. So I'm Howie from TenSquared. So TenSquared is one of the largest cloud vendor with 26 global regions, supports Web3 and crypto as one of our key strategic target. And we have from small validators as well as large validators as our customers, which is happily using our offers. And we are supporting from classic networks like Ethereal to the very much later newer networks like Sui or Say. So we have tailored solutions and good support for validators. Thank you.
Thank you, guys. Then let's jump into our conversation. To get 1 billion stakers, we need to have more than 1 billion crypto users. So I would like to kick this off big picture. What is the prerequisite for crypto to get 1 billion or more than 1 billion users? Today, we have about 9 million stakers and 400 million crypto users. Rough estimate. JK, what has to happen?
And I'll speak specifically for staking, right? How do we get to that threshold? One day, like, there was a time where I thought, so I mean, I'll say the problem first, and it's really about the complexity of staking, both on the protocol end and on the UX end, on how users interact. To discuss the first part, all the protocols currently existing out today that uses proof of stake has vastly different staking functionality. It's all very different, and because we've made it so complicated, it's impossible to explain this to regulators, to ordinary users. I mean, we ourselves are sometimes confused. So, we need to solve that area of abstracting that complexity away. The other part is UX. I've run customer support, as part of the customer support at Stakefish. I've seen the users, their workflow on how they go about staking. It's very complicated when you think about it from the user's perspective, who really just want to stake and don't understand what a wallet is, what unbonding period is, what validators are. And for them, it's very scary to get started. And so we really need to solve that user interface and UX problem as well. So there's two phases to this.
And Mete, I think at working for KuCoin, I think your company thinks about getting 1 billion users yourselves.
I'll try my best.
So, tell us a little bit about it. How to go get 1 billion users in crypto?
Yeah, actually, as you said, according to AAA, I guess there are more than 9 million stakers, but KuCoin exchange alone have 30 million users. So if we are talking about reaching or bringing crypto 1 billion users, it may be a little bit radical beginning, but we will be much closer to 1 billion, in my very humble opinion, when crypto hodlers can be satisfied with their crypto assets without expressing their wealth in terms of fiat money. Of course, this view doesn't include removing of fiat money from circulation at all. I don't want to get arrested right now. But to be honest, even so-called crypto geeks are expressing their wealth in terms of fiat money. They should stop it. Because especially if you are a person has some trust issues to crypto, expressing a crypto guy his wealth with fiat money reinforces your concerns. So this should be a factor in my very humble opinion again. And the second thing is crypto is still very complex for Uncle Joe. It's maybe a little bit cliche, but it's true. And staking is not an exception, but I think we'll go through it during the panel. So I will talk more about it.
Thank you. Howie, how does get crypto more than 1 billion users?
Yeah, so 1 billion users, that's a very big number. So I Googled a bit. So basically, it is the number that in 2000 for internet grows during the past 23 years to a number of 5 billion internet users globally. So if we 10 times the current stakers and the current cryptocurrency users, it will exactly reach this number. Proportional will solve the problem, right? But we have to see that it took so much time for internet, for Web 2. So the easiest thing would be we try to transfer those 5 billion internet users to Web 3, and part of them will have a stake. So in this case, problem solved. And the other part, I would say, is classic finance. Digital currency as a new type of asset. So people want to put money in a bank in a way that they want to put their money for like an ETF fund or by an institute to make a stake, but it's more from a perspective of investment or value holding. So in this way, I believe that this will bring us also a lot of staking users, or in a way of delegated staking. Yeah.
All right. So let's imagine a world that you described. We get there. We have more than 1 billion crypto users. Let's talk about staking. And to start off, let's talk about our different perspectives on staking. What is it? Is it a security service? Is it economic rewards and investment? Or is it about governance? Let's start with you, Mete.
Okay, I guess as an exchange representative, I should talk more about the delegation perspective. If we summarize the items you just mentioned as validation, delegation, and of course, in time to time incentivization. At KuCoin exchange, in custodian perspective, because basically people keeping their assets on our platform, and we are working hard to provide the best products, best earn or staking products or services that set the industry standards. So talking about this perspective for KuCoin exchange, in essence, staking is more about delegation, because people are basically delegating their tokens or their coins to us. They are trusting us. But this is only the exchange perspective. KuCoin is an entity with many muscles. We have KuCoin Labs, KuCoin Ventures, and sometimes for one entity, staking may mean more than one, let's say, explanation. For KuCoin Labs and Ventures, for example, especially during their incubation and investment phases, due diligence phases, staking can primarily be validation, for example, or in some cases it can be governance, because they have to do it. But on exchange sides, we are still trying hard to, let's say, be the best version of delegation perspective of staking.
Yeah, it is even called earn, right? So very good. Thank you so much. JK, what is staking?
Yeah, staking is a crypto economic game that helps secure the integrity of a protocol. And the protocol could be a proof of stake network, or it could be middleware like Chainlink or DeGraph. That's what it is. Anything outside that is not staking, period. Arbitrum currently passed their newest vote. That's not staking. And attempts like that really does confuse regulators, because they're going to start then categorizing tokens being locked up in a smart contract as staking, and group that up with Ethereum staking, where there's a lot more work being done by the ETH stakers. It's not just being locked in a smart contract, right? When you're doing ETH staking, you're actually securing the integrity of the Ethereum network. It's fundamentally different. So I know the Proof of Stake Alliance did release sort of like their guidance on the best practices on how to define staking. Like, these attempts need to happen because we really need to stop butchering the term staking, because the more we do it, the more we're just shooting ourselves in the foot. Later down the road, the regulators, we're already sort of seeing this in some of their opinion letters, they're grouping together everything, including lending, with staking. And this is the way for us to, this is a road to nowhere, essentially. So want to make sure that it's clear that, proof of stake it must be essential, I mean, staking must be essential on preserving the integrity of the protocol. That's how what staking is.
Howie, from an infrastructure provider point of view, what is staking?
Yeah, from an infrastructure perspective, I think it's very, very important. But first of all, for staking, I think we are, it's a very broad term, yeah. So my understanding is that people put their assets or tokens getting locked and usually getting back some rewards. Not necessarily, but that is most probably as it happens till today. But some type of new staking like non-fungible tokens can also be getting staked and get back a reward, but without join transactions or get a validation phase. So it can be different, I mean. But as of today, I would say staking needs a very strong and also kind of decentralized infrastructure support. That's a very big challenge, as we all know that it's highly centralized by big data centers or cloud vendors in the world to support many big networks. From our side, so we are supporting our customers to choose another stable and solid cloud as a first step for distributed cloud, multi-cloud operation to go to the first step of decentralization. So that is my understanding of the staking. But probably I would say why the challenge is so big here is that we have talked about the numbers of the internet user growth in the past 20 years. It is backed by a very solid cloud centralized operation to support such very big utility of internet to change everybody's real life. So that's how internet gets success. So for Web3 or staking, we want to achieve the same, still under the assumption of decentralization, which is type of why it makes so much sense. So we can imagine that the challenge could be how big, because we have to solve probably the same scale of size of the users to provide real value to them, to change the life, technically in such kind of systems, but not in a centralized way, in a decentralized way. So I would say there is a long way to go, but we will be there in the future, step by step.
Benedict, I was just curious about your definition, honestly. Your definition of staking, actually, because stakingworlds.com, right? You guys are like the face of staking in a lot of ways. I'm curious about how you guys define staking as well, actually.
Yeah, I can speak first for myself. So the reason why I'm asking the question, and what is very obvious also by the responses, staking means something different depending on your context. So if you ask in the Cosmos ecosystem context, a delegator, he says, I stake for governance. It's perfectly fine in Cosmos. In Ethereum, it's a different game. In Ethereum, a staker has to be a validator, like first and foremost, right? To call himself a staker. And so I would say it depends on the context. And this is also why I wanted to have this question before we even go into adoption, because it is very context dependent. And another thing, I would like to extend what Jannik and Mirko said in the beginning. Staking is an entire ecosystem of different tooling. It's of different participants. And literally, this is the idea of the summit to define this. What is staking? What can we do together? How do we all work on it together? And in this regard, from the different perspectives, let's talk about adoption. So what problems are there from the different point of views to get to 1 billion stakers? Maybe we start from the earn perspective.
Okay. Of course, we can talk about more than one core problems about staking, including regulations, infrastructure, or sometimes UX, incentivization, etc., etc. But again, talking about an exchange, a centralized exchange, or talking as an exchange representative, I would like to stay more on the UX side, because as you all know, centralized crypto exchanges are in a claim of bridging the gap between decentralized finance and centralized finance. And again, staking is not an exception. In terms of UX, staking should be intuitive, it should be inclusive, and it should be user-friendly. To be honest, especially on the decentralized finance side, I don't think that we get there yet. But centralized exchanges, including KuCoin, tries to provide the best user experience, even for the ones who are not very well authorized of technological jargon, or let's say, even if they are not tech-savvy or financially privileged. You can just go on a centralized platform like KuCoin, just deposit $10 and start staking. It's not only about money, the amount of the money, but at the same time, it's the easiness of usage, just with few clicks. So in my opinion, UX is one of the biggest problems of staking or let's say barriers to overcome to reach 1 billion stakers. And in the short term, there are many projects which have the potential to overcome this issue on DeFi side. Basically, yeah, these are my opinions.
Do you think, to elaborate a little bit on this, do you think from a custodian has sort of a shortcut to a good UX in comparison to a non-custodian?
Actually, sometimes yes, I would say sometimes no, but generally yes. Being a custodian also gives you the responsibility of trust, as you might know. And when it comes to staking, I mean, basically you are locking your assets for a time, and you definitely need a trustworthy platform to do it.
Right.
In terms of this trust, we are really building or building the best products and also cooperating with external partners to bring the best opportunity.
Right. Thank you.
Just a quick question to Mete. Does KuCoin work with validators to launch staking on KuCoin itself, or are you guys running validators yourselves internally?
Actually, it depends on the projects, but for sometimes we are validators directly. So basically people are delegating to us, and sometimes we use staking as a service. That's the...
Thank you. From your perspective, what do you think are problems for the staking UX?
First off, the things as mentioned already is the infrastructure in a decentralized way to supporting different networks, including staking. Second one, I would also say the governance, and also in the regional and different countries, different attitude towards digital assets and blockchain in general. Because this has a big impact from the finance perspective for institutions. From this perspective, a lot of users, if they want to operate their own, for example, home staking or this kind of approach, which is in theory, yes, but practically very low chance, I would say. Most of us probably would expect either a custodial or non-custodial type of way to get staked by a trusted party in this way.
So I've already said UI, UX. I won't repeat that. Maybe another angle to talk about the reason for the hurdle to adoption is going to be data. there's actually a lot of assets being staked with suboptimal validators. And at times, like we're talking about more than 100 basis points just left on the table by putting your stake with a validator that is not performing well. I mean, if you're staking as an institution, if you're staking 100 million, like, that's 7 figs of, real yield that you're leaving on the table and walking away from. Surprisingly, this is like really widespread, believe it or not. And there's no sign of this actually improving at all. Of course, stakingrewards.com does provide a way of getting to that, but I think there needs to be multiple sort of threads of efforts to try to make sure that we have more visibility and data around how staking is actually functioning behind the scenes. Because also at the end of the day, this also leads to audits too, right? You can't really tell auditors, hey, this is how much we earned, but we have no idea, like, where we got these rewards. Like, that doesn't work, right? So I would say the data part is the other part of the puzzle that I don't think a lot of people are also paying attention to.
Yeah, it's another interesting thing is when you think about staking, you think about everything, but for instance, boring topics like taxes or accounting. But for instance, at Staking Rewards, our head of research is from Germany. And whenever I want to know his opinion about something, he also adds the information, this is a taxable event or this isn't. So I think this is, it sounds funny, but this is actually probably an adoption problem in these countries where staking is a taxable event. And just imagine in the countries with the highest adoption, if staking wouldn't be a taxable event, I think this would contribute to the adoption significantly.
Maybe if we just took this question to Gary Gensler, he will apply the Howey test. He always makes this.
One thing I do want to add on the taxation front is I do want to give a shout out to like Trust Finance, which I think is working on staking specifically on the taxation front. And I say this only because I've personally also worked with various different tax firms to see whether or not they actually can track staking rewards. A lot of them unfortunately cannot, but like Trust Finance seem to have actually done it. But other than them, of course, validators, some top validators also do have really good tracking systems. So definitely worthwhile checking out like the institutional focused validators out here, like Figment, of course, Lucanodes, Kiln, like these are all great names, Blockdaemon. So yeah, there definitely are a few players who do track taxation.
So yeah, we'll approach our last topic, and then afterwards I would like to open the floor for a few questions. So whoever will be interested after the last questions, please raise your hand and we'll try to get a few questions in. So to finish up, I would like to hear, we talked about adoption, we talked about staking. I would like to hear about either a recent topic, like for instance, a staking ETF or the staking model, or the influence of the bull market, or whatever you think is going to drive the adoption of staking, or even a good example of a protocol that does a good job in mass adoption. Let's start with you, Mete.
Okay. Of course, it's not financial advice or project shilling, but we have to admit that Tezos and Polkadot, they really did a good job in terms of achieving mass adoption within their community of staking. So both liquid proof of stake and also nominated proof of stake approaches were good at that time. But I don't want to stick on their backend. Rather, they have some items which are community engagement, incentivization, also innovation and accessibility. These 4 items shouldn't be missed if we want to go to mass adoption in staking. At the same time, if we are going to talk about the trends rather than ETF staking, to be honest, I don't want to talk about it before it becomes real. But liquid staking is still a good trend for the mass adoption. But at the same time, cross-chain staking hypes up because it directly removes the barrier for sticking on one blockchain to stake your assets. And with the, I mean, if it consists with liquid staking, it gives you the maximum flexibility right now. So these two is good. These two are good trends recently, in my opinion.
Thank you. JK?
So I really want to see more simplicity from the different chains launching. If it's not simple, it's like so difficult for teams like StakingWars.com, teams like Apibara to really understand and try to explain this to end users. If we're having a hard time, that means that end users, trust me, are not going to understand what's going on at all. So I really do hope people do strive for simplicity more, and I do fear that we're stepping away from it, which is a concerning sign. But recently, I think the project that really did pique my interest, I guess, is DYDX. Primarily because when you stake DYDX, you're earning your staking rewards on USDC. That's a first. That has never happened yet on any proof-of-stake protocols. We will see how that plays out, but it's very interesting, the fact that you could earn USDC on DYDX. I will say, though, one last comment I would like to make is I would like to tell the audience and everyone to not focus too much on LST, actually. I caution against it. LST and Ethereum, yes, is interesting, but LST elsewhere, outside of Ethereum, has really not gained any adoption. And I think, so I caution against people thinking like LST is going to be the answer to higher adoption on staking.
You're going to have a lot of fun and people to talk to about this.
No.
Real quick, good example, Howie, before we open the floor for a last question, because we're running out of time.
So good examples, I would say still is something, finance product which is supported by regulators, or something could really change people or end users' real life, make a lot of sense, so that people want to stake something, not just for revenue, because it comes with the money. When there is a bull run, when there is not, people probably an institution or a private person, they will just come and go. So what makes them stay is, so they need a very strong value of the system or applications or ecosystem of blockchains, whatever innovations could happen there. So what I see, like for example, for gaming or for NFTs, for those tokens get staked, probably it's not for a goal of earning some revenue, but to prove kind of identity or form a society, whatever type of utilizations. Yeah. So.
Thank you. We're out of time, but I promised you get at least one question. Is there anyone in the audience who would like to ask a question? Obviously, otherwise, after the panel, you can catch these guys for the next 2 days.
I guess everyone is here for business.
Thank you.
Thank you.
Then I would like to thank you.
Thanks for sticking with us, guys. Hope you're enjoying yourself. Our next keynote is by Fisher Yu, co-founder and CTO of Babylon Chain. And the title is Babylon, Unlocking 21 Million Bitcoins for Trustless Staking. Please, everyone, give a warm welcome to Fisher.
Hello. Hello, everyone. My name is Fisher Yu. I'm the co-founder and CTO of a Layer 1 project called Babylon. You might wonder why a Layer 1 project talks here in a staking summit. Indeed, I myself was wondering as well. So indeed, last month, I already visited Istanbul to attend a conference called Cosmoverse, which is an annual gathering of the Cosmos ecosystem. Are there any Cosmos validators here? Great, yeah, great to see you guys again. Yeah. So yeah, I live in Sydney, so it was like a 25 hours flight, one way. So after Cosmoverse, I told myself, I'm done with traveling this year. But later, my co-founder told me, say, hey, Fisher, there's a very important conference I want you to go, and it is in Istanbul again. I was like, no way, leave me alone, please. But the conference name is called Staking Reward Summit. I was like, wow, interesting, I'll consider it. And my co-founder told me there is a panel with a name called Bitcoin Staking. Then I was like, okay, when is the next flight to Istanbul? So here I am with a mission to introduce to the staking industry something I believe everyone will love, which is a brand new, fresh staking asset, which worth 600 billion USD, whose name is called Bitcoin. Okay, so a little bit introduction about our project. Babylon was founded in early 2022 by myself and my co-founder, Professor David Shea from Stanford University. So our mission is to scale Bitcoin and extract the security of Bitcoin and use it to secure the entire decentralized world. Okay, so basically what we try to do here is to combine the security of Bitcoin and the efficiency of proof of stake to make the decentralized world a better place. We started our journey from the Cosmos ecosystem, and the first Bitcoin security sharing protocol we built is called Bitcoin timestamping. So what does this protocol do is to send succinct and provable timestamps of POS chains into the Bitcoin network, so that there is a history of all the POS chains on Bitcoin, and the security of this history increases over time when Bitcoin chain grows, so that by this way we can solve the so-called long-range attack problem of POS chains, where the older blocks are more subject to history revision attack. Okay. A very powerful benefit of our timestamping protocol is that it can allow the stake unbounding time of POS chains to be reduced from weeks, such as 21 days or 48 days, to merely 1 day, which will significantly improve the liquidity of the staking asset. Okay. We have launched our Bitcoin timestamping testnet in this February, and we have already integrated with over 30 awesome Cosmos chains on our testnet. And early this year, we have passed a governance proposal with Osmosis, and so that Osmosis will officially use Babylon timestamping protocol once Babylon launches its mainnet. And the support rate of this proposal is 99.62%. Okay, so we solved the long-range attack problem for the POS chains, but we are not done yet. We are not completely happy with the security we provide to the POS chains, because Bitcoin timestamping's protection is kind of slow. For each POS chain, you can only get one timestamp per 10 minutes. So this kind of slowness is perfectly okay for timestamping, for stake unbounding, but if we want to keep the fast confirmation of POS chains, we definitely need the help of staking. So we ask ourselves, okay, Bitcoin is not just a proof of work, okay? It is also the network that hosts 600 billion of assets. Does it make sense to turn Bitcoin, this asset itself, into a staking asset for POS chain? Okay, so this is the question we ask ourselves. Right? Does it even make sense? It turns out that Bitcoin is indeed an awesome staking asset. First, we are talking about 500 billion plus. Okay, now I think it's 600 billion plus security capital for POS chains, which will be very useful, especially for new chains to bootstrap themselves so that they can start with a very high security level so that they can convince their users to lock more values on their chains, so to have a higher TVL. The second is less inflation pressure to the POS chains, because currently, most of the Bitcoins are sitting there idle, not generating any yield. That means as long as the POS chain can provide some yield to the Bitcoin holders in a secure way, Bitcoin holders will be happy. They don't demand like 10%, 20%, or even 50% API. A single-digit percent reward, they'll be happy about that. Okay? So less inflation will help the POS chain to have a healthier economics and more utilities of the native tokens. Next, like Bitcoin, it's also a very stable security asset because its price is relatively much less volatile compared to any other native tokens. So this way, when the Black Swan event such as Terra Luna happens, where the native token price drops significantly for a short time, the security level of the POS chains secured by Bitcoin will be less affected. So it will be much less likely for such chains to be attacked or overtaken by malicious entities. Last but not the least, the benefit of Bitcoin staking is that Bitcoin is arguably the most decentralized asset in the entire crypto world. So adding Bitcoin into a chain staking portfolio will greatly improve the decentralization factor and minimize the reward concentration for the POS chains. Okay, so these all sounds exciting, right? But when we talk about our ideas with Bitcoin holders and with mining pools, or even everyone, the questions people ask is first is it even possible? People are very skeptical about this. This is because there are two things that holding people back. First is that the Bitcoin holders, they are very conservative. There's a very famous expression among Bitcoin holders, which is called, not your keys, not your coins, right? So Bitcoin holders, they'd rather be killed than giving their Bitcoins to any third-party custodian, okay? So this is first. Bitcoin holders does not like doing anything like this. And second, Bitcoin does not have any smart contract to understand what's happening on the POS chains. So how can you turn Bitcoin into a proper staking asset? So, question, is it even possible? The answer is yes. So, let's take a look at what does it mean to be a proper or first-class staking asset. So there are several properties. First property, sounds scary, but for us it should be very familiar. It's called slashable. It means when the staker attacks the POS chain, its stake should be able to be slashed. So this slashability is actually the foundation of POS security. Second property, it's called fractional slashing. It means when a slashing of event happens, the protocol allows only a fraction of the stake to be slashed. So this will make people much, especially Bitcoin holders, much more comfortable in participating in staking, which is a relatively new concept in their mind. The third one, which is the most important to the Bitcoin holders, is called trustless staking, which means to participate in a staking, the Bitcoin holders do not give their Bitcoins to any third-party wallet address. The Bitcoins are still under their own private keys control. So this is super important to them. Without this, Bitcoin holders will just walk away. Okay. The next property, delegatable, I guess which is the most interesting one for our validator friends here, is that for retailer Bitcoin holders, they should be able to delegate their Bitcoins and voting power to a capable validator instead of running a validator by themselves. So this way, the validators they delegate to can take a cut of the staking reward, which it will be a very big business for the validators. Next one, called on-demand unbounding, means the Bitcoin stakers can unbound from a POS chain anytime, just like any normal POS chain protocols. The last one, which is very enchanting, it's called restakeable. It means the asset can be staked in multiple places or services and earn multiple yields. So this is also very important for validators. That means the validators can attract one stake and do multiple works and then earn multiple commissions. Okay. So all these 6 properties are like fundamental and important properties for a staking asset. And yeah, I'm happy to share that by combining our Bobulan team's deep knowledge of cryptography, our understanding of Bitcoin script and consensus, as well as building on top of our timestamping protocol, we successfully made Bitcoin achieve all these 6 properties. So for the first time in history, Bitcoin becomes a first-class staking asset for the POS world. Yeah, so a little bit about our roadmap before I wrap up. We launched our Bitcoin timestamping testnet in this February, and we just launched our Bitcoin staking minimum viable product in this September, and we are working towards a testnet launch by the end of this year, and targeting a mainnet launch by next summer around the Bitcoin halving. And after that, we will tackle the BTC secured data availability services. And once all the security issues are solved, we will tackle the crown jewelry, which is the Bitcoin liquidity marketplace. Yeah, so in Bobulan, we are trying to build a Bitcoin-aligned staking world. So as I just mentioned, we would like to launch our first Bitcoin staking testnet by the end of this year, and we will onboard 50 high-quality validators. So if you are interested in becoming our partner, please talk to us. Thank you very much.
So we have 2 more keynotes before we break for lunch, and yeah, we're not slowing down. 2 heavy hitters in the liquid staking space. Next up, we've got Exploring the Potential of Stakewise v3 with Jordan Sutcliffe, who is the BD lead of Stakewise.
Alrighty. Cool, thank you. So, thanks everyone for joining me here today. I vividly remember lots of things from Staking Rewards last year. It was a fantastic conference, or Staking Summit, I should say. But it was also the day of the FTX crash, which is, yeah, look how far we've come since then. But I also vividly remember talking about or theorizing what can be done with Stakewise v3. It was still very much in its ideas phase and design phase. And now it's great to be presenting a year on some of the protocols and entities that are now building on v3. Now it is essentially built. For those of you who are not aware about who Stakewise are, so Stakewise was one of the first liquid staking providers back in the day. We launched back in early 2021. But for the past 18 months or so, we've had full focus on our version 3 upgrade, inventively named Stakewise v3. This protocol has been, as I mentioned, in design phase and development for over 18 months now, and has been on testnet since February. So one quick update on where we are with v3. So I can confirm the contracts are on Mainnet. It's taken a long time to get here, but it's awesome to see this protocol on Mainnet. We are literally just crossing the T's, dotting the I's, getting some final testing in place before we launch it to the public. So that's awesome. For those who also follow Stakewise DAO, you will see that we've just approved the Oracle network for the v3 protocol. And I think you can also agree with me that it's a pretty strong set of oracles and partners we've got ready lined up for Stakewise v3. So when we say v3 is soon, yeah, it really is soon. Before I go and look at some of the examples of what people are doing on v3, I felt it necessary just to give a quick introduction of what v3 is. So Stakewise currently is a single staking pool permissioned node operator set. What we're doing with v3 is we're essentially white labeling our smart contracts, allowing any entity to launch their own staking pool alongside our existing pool. These staking pools, or vaults, as they are known in v3, are the foundation for the protocol. Each vault is a unique smart contract. All assets are fully segregated, and the configurations within these vaults are all going to be unique. Vaults are essentially a one-stop shop for offering staking as a service. Anyone who wants to offer trustless, non-custodial staking can leverage these smart contracts. And they automate everything for you, everything apart from actually running the nodes yourselves. So they accept delegations of any size, they pool capital, they automatically register validators, wind down validators, they auto-compound, they tokenize, they handle fee distribution. You kind of get the picture here. And I'll talk through some of the features of vaults when I go through the examples. But essentially, it's like the Swiss Army knife for ETH staking. And the best part of it for most people in this room is that vaults are actually free to use. We do not charge for the use of vaults. We kind of see them as like the Gnosis safe for ETH staking. It's a public good. We think anybody should be able to offer staking as a service, and we're giving them the tools to do that. On top of vaults, we have our liquid token. This is the new token which we're launching alongside v3. And as you can see, it kind of plugs into every single staking pool or vault on this platform. The clue is in the title, OSETH, or over-collateralized staked ETH. This token is over-collateralized. So whilst we have a single token that is connected to all of the vaults in the ecosystem, the over-collateralization ensures that staking rewards and slashing penalty or staking penalties do remain truly isolated to each vault. And we as Stakewise are providing the liquidity and integrations for this token. So not only are we giving people the tools to offer staking as a service, we're also giving them a ready-made liquid staking ecosystem or liquid staking token that all of their stakers can use and they can plug into. So that's kind of a quick high level of what v3 is. And now we can actually have a look at what people are building on v3. So first up, we have our friends over at Blockscape. They probably don't need much introduction. Blockscape is a commercial node operator. They're a Lido node operator. And actually, like a lot of operators on Lido, they have their own clients who want to liquid stake. The problem for Blockscape right now is that they can't send those clients to Lido because otherwise they just lose them as clients. And this is where they're using Stakewise v3 to allow their clients to stake with Blockscape and still access a liquid staking token. They're making an institutional liquid staking solution specifically. So Blockscape will be launching a private vault. Private means that only whitelisted addresses can stake into the vault. And Blockscape has full control over the KYC, the client onboarding, whatever they want to do to allow clients to stake into this solution. They can do that through the vault's private feature. And this also gives the staking solution some institutional or regulatory security. It means that the clients, it's not a fully permissionless pool that anyone can delegate to. All the entities are known KYC'd entities. And so it's a very regulatory secure way to offer liquid staking. What's cool about the Blockscape solution is that they're embedding DVT. Vaults are completely agnostic to the staking solution that runs within them. So it can be whatever clients you want to run, whatever MEV relays, whatever DVT solution, what have you, you can run within vaults. And that's going to lead to a really diverse network of staking solutions that are built on V3. And Blockscape specifically have partnered with SSV in this case for their DVT solution. The last thing to mention here is that this is a tokenless vault. Blockscape are not launching their own LST. They could do, vaults do have that feature, and I'll show you an example in a second. But in this situation, deposits are not tokenized. They are instead, the stakers of the Blockscape solution will be leveraging that OSETH token I spoke about briefly earlier. So the liquid staking solution is fully provided for Blockscape. They're just benefiting from all the vaults functionality which we offer. So that's one example of a node operator who's building on top of us. Next up, we've got a DeFi protocol. So Gravatar, some of you may be familiar, they're a friendly liquidity fork, a decentralized stablecoin that allows LSTs for use as collateral to borrow their stablecoin. They've onboarded RETH, STETH, they're onboarding OSETH as well, but they wanted to go one step further and launch their own liquid staking token for use within Gravatar. And this is where V3 comes in. So they're creating a public vault where it's, again, because it's public, it's fully permissionless, anyone can stake. The capital in this vault is pooled, so people can stake whatever size they want into this solution. And when deposits hit the vault, users receive the custom Gravatar LST. They can customize it, the name and ticker, whatever they please. It's going to be something like GETH. And then GETH can then be onboarded to the Gravatar protocol to be used as collateral for minting GRI. Gravatar are heavy, or they're big on decentralization. And so they've partnered with NodeSet, which is a new entity which is coming out of Rocket Pool, essentially, where NodeSet is a permission set of node operators, but a lot of them are solo stakers, a lot of them are Rocket Pool node operators that want to offer their nodes to help other entities run staking as a service. And they're partnering with Gravatar here. So NodeSet, last time I spoke to the team, have over 100 node operators that are ready to go, and they'll be staking the capital that gets delegated to the Gravatar staking solution. And again, the vault's functionality handles the distribution across all of those node operators. Again, I think that's a pretty cool use case. It's very quick and easy now to launch a protocol which is similar to Rocket Pool or Lido out of the box. Next up, we've got like ETH staking on exchange. I can't mention the names of exchanges, but it's fair to say that our friends at Sensei Node are partnering and integrating with numerous exchanges where they're helping them enter the ETH staking market. And along the way, they're embedding V3 into this solution. So for every exchange, they're creating a private, again, KYC pool that these exchanges can control which users stake into this solution. Even though it's private, it's still a pooled staking solution, which is important for retail users who do not have 32 ETH, so they can still stake whatever ETH amounts they want. And the vaults contracts handle the revenue sharing agreements between the exchanges and Sensei Node. They can configure this however they like. The numbers are definitely illustrative here, but you get the idea. The vaults functionality lets them configure this solution bespoke to how the exchanges need it. In this situation, OSETH is temporarily disabled. A lot of these exchanges are just entering ETH staking for the first time, so they want to take baby steps first, and then with the potential to onboard and enable full liquid staking with OSETH at a later date. Just a couple of final quick examples here. Again, Chorus One, another very well-known node operator, doesn't need much of an introduction. They have a product called Opus. This is where anyone can go to the Chorus UI and spin up validators. Right now, you can only do that if you've got 32 Ether. It's just native 32 ETH staking. By embedding V3, as Chorus One are doing, they're able to offer pooled liquid staking to their users. For their clients who require more of a bespoke setup, they can still achieve this. And for larger clients, they'll be creating private vaults specifically for those clients. What this allows is for large entities that are clients of Chorus to create a very bespoke commercial agreements, essentially for their state capital, ring-fencing their capital in a private vault so it's not commingled with any other entity, while still being able to access a liquid staking token. And this is a really good example of like a fully white label use case of Stakewise v3. The clients of Chorus One never need to go on the Stakewise UI. Obviously, we built a full UI for v3 for people to use, but Chorus One is embedding everything in their own UI, and I'm sure they'll have to put it in their T's and C's somewhere, but their clients never actually need to know they're using the Stakewise infrastructure under the hood. And the last example here is Enzyme Finance, another DeFi protocol, which is run and managed by Avantgarde Finance. And effectively, this is an on-chain asset management protocol. Anyone can come in, launch an Enzyme vault, and become an asset manager and assign capital on-chain in however they please. So there's two ways that Enzyme Finance are integrating v3. Remember, OS ETH is just like any other LST. It's well, not like any other T. It's a repricing LST. So holding OS ETH allows people to stake. It's a simple swap into OS ETH and unswap to stake and unstake. And because OS ETH is over-collateralized, it has inbuilt slashing protection, and it will accrue the yield from a highly diversified set of node operators. As far as LSTs go, like an OS ETH standard LST is pretty high up there. It doesn't get much better than that. And so Enzyme Finance asset managers will be able to just simply enable one-click staking within their vault with slashing insurance. The other thing as well, or an alternative way these asset managers can deploy capital, is by viewing the Stakewise marketplace. Every single vault, every single staking pool that is launched on Stakewise v3 will be shown within the Stakewise UI and ultimately within the Stakewise marketplace. This gives stakers the ability to cherry pick, and the vault managers in this situation for Enzyme, to cherry pick their preferred staking solution. Maybe they want to stake with solo stakers, commercial operators, those running DVT, what have you. Whatever they want, they can cherry pick their preferred solution and stake directly into that vault, into that staking pool. And of course, they can still access the liquid staking token of OS ETH. And so it gives these asset managers a very bespoke staking configuration. This list is not exhaustive here. There's plenty more people, entities that are building on v3. Wallets, custodians, you name it, they're all looking at v3 to kind of launch their own staking solution. Let me just leave you with this. Historically, it has taken years, maybe even multiple millions of dollars in some cases, to launch staking solutions or liquid staking solutions. The Gravatar Vault is a great example here. They're able to launch their vault, and it will take them, I kid you not, about 5 minutes to do it on the Stakewise UI. And they can plug in a node operator set with hundreds of node operators. It's taken Lido, Rocket Pool a long time to build up their solutions with many number of node operators. Gravatar can do that within 1 day, effectively. And for those who do not want their own LST, they can use OS ETH, the ready-made LST from Stakewise. So I can hope you can kind of see that this protocol can be very powerful. And we're kind of hoping it has the chance to disrupt the current ETH staking landscape, and it unlocks a lot of new opportunities for entities. I've just run out of time, so all I will say is keep your eyes peeled for some communication very soon on the mainnet launch. It's great to see our partners already building on this. There's many more examples and announcements to come. And yeah, stay tuned, guys. Thank you.
So we're going into our final keynote before we break for lunch. I'm sure we're all hungry. Bold statement, if you haven't heard of Lido, then you've probably been living under a rock. Our next speaker is called Eugene Schne, which I've been informed is his nickname. And he's going to be speaking about planning the future of Lido. Give it up for Eugene.
you hear me? Let's start. My name is Eugene, and I'm Lido tech lead. I'm going to share today my personal view on near future of Lido. It's actually Lido timeline for 2024. And you know, when it comes to setting goals within a DAO, it's important to explain how it actually works, because DAO can plan the future because it's on-chain entity coordinated by voting, right? Another important disclaimer that Lido contributors, it's not Lido DAO, it's different things. And Lido contributors is human beings that contribute to Lido in any way. They're coordinating off-chain, preparing proposals, and put it up for voting. Snapshot on-chain or on-chain, Aragon voting, whatever. And token holders actually approve that proposals and can vote or not vote on a proposal. And what is important is that LDO holders is an open set. So how actually to plan the future together with the faceless, anonymous token holders? To fix this, this summer, Lido DAO ratified its mission, vision, and purpose through a snapshot vote. And it's extremely important to align on things like that if we're talking about DAO. But it still doesn't have with timelines, right? Because how contributors would know what is the next step desired by LDO holders? That's why Lido came up with a special process for that. We call it GOOSE. And GOOSE stands for the Guided Open Objective Setting Exercise. Let me explain what it is. It actually works very similar to blockchains. So there is a genesis event and yearly cadence. So you can say like, it's actually 1 year, and in the beginning of year, it's call for proposals. Anyone can submit proposal. After that, there is a review stage, and after that, all proposals, it's put it up on a snapshot votes. And once we have like wind proposal, after that, DAO contributors can just take a look and build their things in alignment with that wind proposal. And for Genesis proposal, like recently it was, Genesis proposal was approved. It happened on November 2nd, and there was only one proposal by Hasso, it's Lido Strategic Advisor. And here you can see 3 main points that Lido contributors should focus on next year. It's very easy. Laser focus on security, also growth opportunities like institutional stakers, and Ethereum alignment. And what I'm going to share with you, it's my personal view on possible timeline for Lido 2024. So like, now I can share with all these like disclaimers. And yeah, 2 disclaimers that since I'm primarily builder, I'm focused on features or challenges that can be solved through the code. Yeah, and the second, by my role, I have a pretty good visibility of what different contributors team are up to, and I want to share with you. And first one, it's about risk mitigation. So it's about laser focus on security. It's about validator set diversification. What risk we're addressing by the decentralization validator set? Current validator set is pretty good, but there are too many risks. It's hard to scale in the long term, and there is a big potential for collateralization. And during V2, we built staking router, which it's a concept that allows you to build like models that can implement different validator set principles. Currently, we have only created models that plugged in staking router, but it's possible to build another models. And as Lido contributors, we are aligning that there are two most important directions. It's permissionless and DVT. And the next step, which likely would happen in the beginning of next year, is the launch of simple DVT model in collaboration with OBEL and SSV, and its experimental model. And it would have limited amount of stake, but it allows us to onboard more node operators. That's very important. And next, OBEL and SSV teams exploring an opportunity to build their models, which would be also plugged in staking router. And last but not least, it's a community staking model, which is actually allow permissionless entry with a bond. So it's similar to Rocket Pool model. And we hope that it would be possible to build and deploy all these models during 2024. And this would help to expand node operator set and node operator amount from like 40 to hundreds. That's about validator set. Next one is governance risk. Governance risk, like governance capture risk, one of the biggest risks like for Lido DAO and probably for other DAOs too. And how it can be possible. Malicious actor could buy or steal sufficient amount of LDO and try to attack stakeholders by upgrading the protocol in a malicious way. This would affect STF users, and we want to give them an opportunity to leave before the vote would actually activate it. Let's take a look on a slide. Here is the happy path, how dual governance working. There is a malicious proposal that reached the quorum, but not activated yet. And STF holders could log their STF into veto vote. And once they do it, time log would extend it, and no vote can be activated during that time log. And finally, once it's some significant portion of stakeholders would be logged into veto, say like 5% of STF, veto state would be activated, and STF would be withdrawn and given back to the holders. So this is the like rough idea of the mechanism. The real mechanism would be more complicated because it addresses all challenges and all edge cases and attack vectors. And recently, it was a relaunch of forum thread. You can check out the thread using this QR code. And it was a relaunch. And last iteration of research was published by Sam. And if you're interested to take a look or contribute or, I don't know, write a blog post or trying to provide your input, all that contribution are welcomed because it's a very novel mechanism and like would be happy to collaborate. Another risk is related to like Oracle risk. And the idea is very simple that Lido relies on Oracle to deliver CL balance to smart contract. Currently, it's 9 different parties and 5 is a quorum. And by adopting KE 4788, we can mitigate this risk with like ZK. So it's with ZK, it's possible to do in a trustless way. And 3 different teams proposed their potential solution on Lido Research Forum, and we're thinking about multi-proval architecture because the ZK technology is still new and we want to ensure reliability. And the last thing about risk, it's execution layer triggerable exits. Once EIP 702 would be available on Ethereum, all LST, including Lido, would need to adopt. Right now, it's on discussion stage, and it's scheduled for Prague Electro hard fork. It's next after the next, so we're probably half of a year away from it. Let's move to opportunities. I think that the most important opportunities next year would be institutional stakers. And like institutional stakers, they require much more flexibility than retail customers. They seek the ability to choose risk and probably not operators. In the same time, Lido must preserve staff fungibility and network health. So it's probably possible to build a model similar to Stakewise fee-free, but the main challenge is to ensure that stake would distribute evenly. We have an idea how we can do it. It can be done by incentivized stakers that choose node operator in ways that improve like stake distribution with a better LTV. And we probably should focus on it next year. Another opportunity is restaking, and for sure it's a good way for stakers to get more rewards with the same amount of stake. And it obviously would be popular, but my view here is that we need to research risk first. And I did some napkin math on the side of the slides that given Lido TVL and daily rewards, to push Lido APR on 1%, it requires like 200 million USD per year. So I think that right now it's not really, it doesn't make sense to include this into STF rewards. And the last one, it's like Ethereum alignment, like pretty broad thing. But I think that the idea of Ethereum alignment for LST is that a large LST should not harm Ethereum, but instead assist in reducing risk. And almost all that I've talked about are reducing risk for Lido and Ethereum network as a whole, right? And but there are additional ideas that I want to share with you that might be beneficial not only for Lido, but for other LST too. First, it's adopting EIP 72521, increasing max effective balance. It's not directly related to like LST rewards amount or something, but it's very important to important for network itself because it's important step towards single slot finality. The second one, it's like idea how, like there is no way to ossify Lido right now, and upgradability is the biggest risk. And we came with the idea to like partially ossify. It's kind of allow protocol upgrade only on Ethereum hard forks, but it would require EE because right now there is no way to know how much blocks pass since last hard fork on a smart contract level. And the third idea is actually allow users and node operators to fork any LST in case of dual governance veto situation. I'll explain a little bit more of it. One of the downsides of dual governance is long withdrawal period, which could take months. And one of the ideas that raised during dual governance research is what we call LST forking. What if instead of withdrawal, holders can move their position from one LST to another without going through withdrawal and deposit queues? And it can be possible, it might be possible if it would be a way that change withdrawal credentials of validator. So forking in that case will require coordination between STF holders and node operators. So it would require ways there to support features similar like 0, 0, 0 to 0, 1 withdrawal credential rotation. And in general, it's a good way to avoid vendor lock for LST users and to de-risk LST without overloading Ethereum consensus. And that's it. Let's build together. Like it's a lot of work on 2024. Thank you.
That's it for now, guys. We're breaking for lunch, 45 minutes. I know my tummy's rumbling. If you're a gold or platinum ticket holder, you can head to level 1 where we'll provide you lunch. And yeah, enjoy your lunch.
back, everybody. Hope you had a good lunch break. Staking Summit Day 1. How are we feeling? Woo! All right, some energy. We got to bring some energy into this cold room. Yeah, so we've got a good afternoon planned for you all, starting with a panel on how to make decentralization lucrative, which is, of course, a very important topic. And I'm going to let Yvonne, the moderator, introduce the panelists. So please give a warm welcome to the panel.
Check, check. Can you guys hear me? Hey everyone, I'm Ivan. I run ecosystem over at Aragon, and I've been fortunate enough to be coordinating this panel. Everyone else here is much more than me, so it's a bit intimidating, but let's see what we can do. So we have Martin here from Rockaway X Labs. They're building a node monitoring infrastructure as well as smart stake rebalancing. I have Zachary from Nimbus team, who are building a lighter Ethereum client. And last but not least, we have Lansky from DAppNode, plug-and-play nodes that anyone can run from their home. Our topic today is about decentralization, and Vitalik defined decentralization across 3 types. So you have political, architectural, and logical. And so it's a multi-dimensional beast. But we'll start from the inverse picture. So we'll start with centralization, which it's a naturally occurring phenomenon. We call it economies of scale. But within our space, it's a bad thing. And so my first question is like, which centralization are you most scared about? Which part of the stack or which dimension of it? Take it away.
Maybe I can take it. I think in this ecosystem, there's a lot of work going into how do we create the centralized systems that are resilient to certain centralization vectors or single points of failure, censorship resistance. A lot of the brain power when designing protocols is spent on this particular way. But then, like for example, I'm going to give an example. Ethereum and proof of stake was designed to be extremely decentralized, meaning that there was a low barrier of economic entry, 32 ETH. Back then, when this was thought out, it was not that much money. Now it's quite expensive. Then there are incentives or the penalties for being offline were on purpose very minimal to encourage people that do not have reliable internet connections to be able to work on that. And there was these incentives to centralization. There is a little known feature on the protocol that is correlated penalties, that your validator, if it goes down, the penalty for being down is higher the more validators are down in the same time. And this is clearly meant to, like if an Amazon, or if a big data center with lots of validators goes down, the correlated penalty will be higher. So it's meant to incentivize, do not have everything on one data center, decentralize it. So what I'm trying to say is, even if you create and design a system on purpose so it will be maximally decentralized, there are, like the systems or economic systems evolve and you have new threats coming all of the time. For example, MEV. MEV is a big centralizing force because of the power distribution of rewards. People that own a lot of validators, institutions that own or run a lot of validators, fall into lottery blocks a lot more often, therefore have a higher revenue that single validators or solo stakers. So this is the centralization that I'm most worried about, which is the one that's not predicted, the one that's not obvious, the one that will happen no matter how you try to design it, the one that will come out of the woodwork.
That makes sense. It's something that we've seen a lot in DAOs, is this, like the celebrity delegate, they appear at the top, everyone just delegates to them because that's like your default option. And we see that happen in, which node do you delegate to? And I know, Martin, we had a cool discussion around, like, how do we solve for this? Like, how should we present delegate nodes so that people actually choose?
Right. I guess the centralization risks this addresses is sort of somebody who's effective at getting stake, as you call the celebrity delegate, right? Initially, they get more capital, they have higher rewards, they can reinvest faster, and then they can become even more powerful, right? That's a very natural centralizing force. They're more effective, they have more money, they can expand faster. And what often does happen is, the maybe validators who have the best BD or who are most well known, they somehow become these celebrity delegates. And I think the way to counter that is to provide reputation services. So for all those validators who are maybe further out at the tail, who don't have as much capital to invest in, or they're not able to put in the effort to make themselves visible, they somehow need to gain visibility via, let's say, like a third-party service, right? That says, we're going to measure all these validators at the same scale and have a look, like, although these guys are not at the top, they're doing a very good job. And actually, if you score them on an absolute level, they are just as good as the big guys, but you wouldn't be able to pick them out of a lineup, right? Because there are thousands of these guys. So I believe one way to combat this is to just provide the same level of reputational services for everybody, which I think was also what Stakin Rewards is working in the space to provide sort of that reputation.
Yeah, I think one place where it maybe feels like we've won a victory against centralization is clients, right? Like a couple of years ago, Prism was like almost 70% of the network was running Prism. So how, like, are we out of the woods on that aspect, and what are the challenges ahead, Zachary?
I think we have still a way to go before we kind of really see the client diversity where it needs to be, so kind of in order to protect the network from potential problems. But I'll get back to your original question. It's related to this topic, basically. What is the type of centralization that we should be most scared about? I certainly think it's the political one, where there is only one entity making decisions, and there is kind of nobody else having the competence to kind of step in or propose an alternative to the users. And one important aspect of client diversity is exactly this. When there are multiple implementation teams who kind of understand the system well enough, you could argue that nobody could really propose something that's not in the interest of the community, because all of the client teams will be able to kind of propose an alternative. We will always have a choice. For me, we should be asking what are these properties of decentralized solutions that are more attractive. And I think certainly one of the best benefits is that it is an escape hatch from this digital feudalism that we are finding ourselves into. We are kind of subject to the whims of kind of corporations which set up the rules of the software system that we use every day. And the other one is that the centralization is really a way to create these unstoppable services in the end of the day. They are both on technical level unstoppable because they eliminate a single point of failure, but they are also kind of unstoppable in regulatory terms quite often, where there's no single entity that you can target and in attempting to shoot down a service. Like one of the key benefits in the design of this decentralized protocols is that even if the development teams goes away, if the protocol is designed properly, it would be able to live on essentially forever.
Yeah, I think like the team walking away is one extreme event that we look at and we're like, okay, can the protocol sustain this? You know, censorship, economic capture, and it's important to have that designed, you know, into the protocol. But to Lansky's point, right? Like centralization pops up here and there, and you know, it's sort of like a dynamic battle that we keep fighting, right? And that means that if the enemy, right, it's a natural force, but it keeps evolving. So should we. And you know, a popular topic now is the ungovernance, which is like let's ossify contracts. Like we create a protocol, it's unchangeable, you know, immutable. Also on the protocol side. Do you think that's sustainable? Like, can we fight an evolving battle without our ability to evolve?
Yeah, if I can take that up, I don't believe that. I don't think so, because I totally agree with Lancy's point on how you summarized it. However you design the protocol, somebody's going to find a way to sort of unbalance it, right? If you think of decentralization, what are you trying to do? You're trying to maintain this whole system in some sort of balanced state. You want to have, you want to have some parameters within bounds, but humans are very ingenious, and some way always comes up to unbalance the system. So talking about designing protocols to be decentralized like gives us this sort of ideal mindset of if I do it right, I'm done. And I just don't think that's true. That's never going to happen. If you want to focus on being decentralized and maintain these properties that come along with it, like credible neutrality, it is always going to be a continuous battle, and you can never stop. And I think what's interesting about decentralization, by the way, it has these aspects of this prisoner's sort of dilemma problem, right? It's great for me if all of you decentralize and I have to worry about it because I get to use this credibly neutral infrastructure, but at the same time, I'm not constraining myself. I'm able to make as much money as I can, grow my stake. Hopefully not too much. We want to maintain the state, but it'd be great if you guys take the cost. So what this leads to is you can achieve or you can keep decentralization happening while there are interested parties who are willing to uphold it as a value and invest in it. It's always going to cost. Because if the system becomes unbalanced and you want to rebalance it, it is going to cost effort, money, time, and attention. So the there always has to be someone who says, okay, it's my job to do my part in decentralization. So in our case, we found foundations, blockchain foundations that are good partners for this because, hey, they started this whole chain. Now they're charged with managing this treasury of tokens, and they're supposed to sort of evolve the ecosystem while maintaining these parameters, this decentralization, right? So I think it's really important to understand like who the players are who are supporting decentralizations in various ways. And by the way, I was thinking about this. Are you guys the only ones who are helping decentralization without being funded? Because you mentioned you guys were self-funded. So
That's
I think
right.
it's an interesting sort of counterpoint to what I was always thinking. But you guys are managing to help decentralization without sort of getting a party that would fund you.
Right. So I guess we're entering territory of public goods, right? What are public goods? How do we fund public goods? Is this a sustainable model to incentivize decentralization? Speaking about incentives, maybe it is. I don't have the answer for this, but it's definitely what is working right now. And yes, as far as I know, DAppNode. Well, no, there's more. There's Ethereum. There's NiceNode. There's probably a couple more that provide ways of running your own node in a simple way. And yeah, I think they're all basically considered public goods. And maybe here the incentive for decentralization is some sort of protocol revenue directed to public goods. What are the things that we believe that are contributing the most? Not only belief, but maybe like we could come up with several metrics. What are the things that contribute the most to keeping that decentralized and paying it off? That said, this sounds really good on practice, but for the day-to-day operations of an organization that provides these public good services, this is a pain in the ass, I'm telling you. Not knowing where the next funding round is going to come, where the next grant is going to come. So somehow, all these public goods, so there's got to be something in the protocol that already allows for some sort of predictability on that. We cannot rely only on grants or this sort of stuff.
You mentioned foundations. You're in essence like a public goods provider, and so there are clearly different stakeholders that contribute towards the protocol, and that begs the question: is governance needed, or is it just another attack surface, or is the way to incentivize people to feel more ownership and work for the greater good of the network?
Governance is going to be necessary, because if we're talking about dynamic systems, complex adaptive systems, it is very unlikely that we are going to create these checks and balances from the beginning, from the get-go. Technology if we keep adding new features, we're going to have to also add other things that counterbalance what these new features bring into the system, right? And here is, so some sort of governance will be necessary. Now, what sort of governance? Zachary was mentioning having different client implementers and like the sort of like the Ethereum governance over what features go in or how do we implement those features. That's always going to be necessary. But at the same time, as you mentioned, it is a vector attack if you don't plan it properly. If you do token-voted governance, you get rent-free value extractors that will buy your token when it's down, and then will attack the governance of the protocol because they will acquire the majority on the protocol.
That opens a lot what Zachary was mentioning around like the political centralization. Are there remedies to that attack vector that you feel particularly excited about?
Well, I mean, there are formal systems of governance, right? For example, how a DAO is operated. Like, there are members with certain voting rights. They have to make unanimous decisions and so on and so forth. But there's other kind of governance where people just vote with their feet, right? If they are presented with the alternatives, they can freely choose like what's in their best interest. And I think this one is actually more flexible. So if a protocol has the option to use it, that's kind of usually for the benefit of the users. But sometimes you have to use the DAO model, especially if you are managing resources of some kind. Something that was kind of previously mentioned here and I found interesting is that this claim that kind of decentralization has to be actively kind of subsidized to some level by somebody, either a foundation or maybe kind of everybody who is participant is doing it for idealistic purposes and so on and so forth. And why I found this to be true sometimes, it doesn't necessarily have to be universally true. I think sometimes decentralization can be a completely rational choice for the users of a particular system. Because sometimes, and these are relatively rare opportunities, but it could be more efficient than a centralized system. This tends to happen when the protocol manages to somehow leverage the idle resources of all the participants. Because everybody has a lot of computing power on their disposal. We have personal computers, laptops, our phones are supercomputers by kind of prior standards and so on and so forth. So for example, Status, the company that's sponsoring Nimbus, is trying to leverage these idle resources to build, say, an efficient file storage network or an efficient communication network. And in the end of the day, we can come up with a solution that is more cost-effective than the centralized provider offering file backup or the Dropbox and companies like that.
You have something here.
Yeah, like that's clearly a big. I'm a big proponent of economies of scope to counterbalance economies of scale, right? Economies of scale are extremely powerful and they allow you to run thousands and thousands of validator run with the cost of running one execution and one consensus node, for example, if we're talking about Ethereum again. So that's like that's the cost of like 1 terabyte of storage plus a little bit of bandwidth. And you can run thousands of these. A solo staker has the same cost of running this execution, this 1 terabyte, and the same bandwidth cost, etc. But they're only running one validator, or two, if they're fortunate enough. Economies of scope can solve that. This machine that you already have running, you can put more stuff. Maybe you cannot run an Ethereum validator, but maybe you can share part of your storage on the Swarm network. Maybe you can share some of your bandwidth for WACO communication protocols. Maybe you can, so economies of scope, expanding what your machine can do with non-competing resources is something that will allow for this true decentralization of infrastructure, right? We're talking about infrastructure decentralization now, to happen. Yeah.
Martin, does running different protocols on the same machine sort of resource sharing, like, do you think that is feasible, or do you think it produces some systematic risks?
Yeah, I think it is feasible, and I'd prefer this systematic risk over this happening inside like one data center, right? I mean, obviously there's correlated risk now. If that node goes down, it affects 2 different protocols. But I mean, unless that's a significant part of those protocols, it's likely not going to cause any havoc. Like you'll get slashed, but you're not endangering the network, right? On the other hand, if everybody is sitting in that the cheapest data center, that's where you have significant voting power aggregation, and that's not going to. I really like this idea of economics of scope. By the way, it's in my mind it kind of captures the long tail of these things that have to be handled on the blockchain, and these frequently fall outside the purview of the big professional validators, right? They want to focus on this one thing, do it the best, and scale out. Mm-hmm. Whereas then that leaves the soul stakers to sort of be more nimble and be able to capture some of that value.
I think the value of this long tail also increases with things like restaking, for example. Right. Because restaking, so reutilizing the economic security of Ethereum for other protocols on a smaller scale, like maybe there's a secondary protocol on restaking that only requires, let's say, like 50 million in order to properly secure this protocol. Well, there's a lot of institutional providers or pools that have already these 50 million on themselves. So if only one political actor takes care of the security of this protocol that's using restaking, that's not decentralization. You're not using it right. But all of a sudden, this long tail gains a lot of value, because if lots of them manage to restake their ETH and be offering economic security to these other protocols, and they're part of the long tail, all of a sudden, this protocol that's only using 50 million of economic security manages to have a politically decentralized set of validators.
I want to switch it up a notch and talk about the incentives, which is like half the half the panel today. You know, you mentioned some sort of like revenue going back to the providers of public goods, and you know, like block rewards and like fee, like transaction fee share going to node validators is like one element of that. But you know, there are networks that need bootstrapping, and you need more direct incentive models there. And we've gone through several cycles of airdrop summer, and we kind of know that that doesn't really work too well for the long term. What are your thoughts, or like, is there a model that you're excited about which has the promise to do a more long-term incentive alignment?
I haven't seen anybody sort of come up with a good model here. It feels like it should be some sort of incremental. As you deepen your engagement, you're sort of getting more airdrops. I think the original idea of airdrops makes sense. You want to distribute the governance token widely, so you start up with a more dispersed sort of control. The problem with, and I think that's everybody already knows this by now, is like when you airdrop these tokens immediately at the start of the protocol, the first thing that most of the people are going to do is dump them the moment the decentralized exchanges list them. And this has been happening for some time. Like, I haven't seen a really good solution that would help this out. But it feels like an incremental onboarding campaign where you would get, as you perform more actions with the protocol, you'd get these incremental airdrops. Would absolutely make sense here. And the only reason it's not happening is it feels like it's not a priority for the protocols as they're developing. That's one of the things that we see when we consult with, let's say, you know, app chains in Cosmos when they're starting up. They have so much, they're putting so much of the attention to get the code base right, to avoid bugs, to try to, you know, have all the functionality in place. And then they don't even take necessary care to select the right validators, right? So they rush that. And then airdrop, I mean, come on, that's like, you know, 0.456 on the radar. So frequently, I think they go with a simple option and just let it up. And then it doesn't really serve the decentralization. So I can't give you a happy answer here. I haven't seen anybody do this sort of in a way that would feel right.
I think you touched on a very interesting point here, though. You said it's not a priority for the team designing the protocol. So it's, you know, the person that is, or the team that is deciding about distributing the incentives, their incentives are not aligned.
Very meta. Yeah. That's exactly right. That's exactly. Airdrops are an excellent way to reward founders. Founders of the project. They get a massive bag. They can use it. There might be lockups. But as you very well pointed out to me in a previous conversation, you can sell these lockups at a haircut, but you can sell these lockups before they vest. So they're an excellent way of incentivizing founders, not necessarily to incentivize actual work on the protocol. And speaking about the right incentives, it's not that I have the solution, not at all, but airdrops are not one. But maybe a combination between conditional airdrops and proof of work. Proof of work is still the best way of rewarding. You do the work, I give you money. But how do you attract people to do the work? Maybe with a conditional airdrop. Maybe you go and say like, hey, I have seen, to use the same, I'm not trying to innovate a lot, but to use the same model as it is being now. How do you get an airdrop? Because you're on a list, because you have done something in the past. So it has some sort of reputational aspect to it, tying back to what you were saying, Martin, before on creating these reputational lists. But you're on a list, you have done something. Therefore, somebody thinks that you have the ability to participate in this protocol and do some work for this protocol. Help me decentralize this protocol. Now you're on this list and say, hey, if you do this work, I have selected you as one of the people that will bootstrap my protocol. Now start running this, and for sure you will get at least this package, plus then you will keep receiving by proof of work, like whatever the usage of the protocol is, whatever, like, and hopefully you can design a system that has the right balance. But yeah, as I said, I haven't cracked this code.
I think an interesting element here is what Zachary mentioned of users voting with their wallet, and users voting with their wallet in more traditional sense doesn't involve tokens, right? It involves like where do you go to spend your money to fulfill your service, and it feels like users probably are the ones that have the power to change the mind of the teams that are building the protocols. So how do we make users care?
Yeah, I think that's $1 million question, honestly speaking. Like so, but I wanted to add a little bit to those airdrops. Yeah, airdrops are now distributed based on retrospective actions. So the fun part is people are actually guessing what's going to be the criteria for the next airdrop, right? So it's like it's randomized. Like there are people who would like to do something, obviously. So but back to your question of incentivization, I think if you can reach that set of people who are willing to do the work, and there seem to be some because they're even doing it speculatively, you might be able to have a controlled way of bringing them into the system, right? And incentivizing them step by step, as we said earlier. But I was just pointing out this, like, for me, ridiculous situation where you've got these speculations, like, hey, maybe I need to stake this and bridge this from here to there, and then I might be in the airdrop. Like, it seems so visceral to me. It seems so uncontrolled and crazy to spend money this way instead of actually, trying to avoid issues. And to answer your question, it feels like there still are, and there may be more people who are genuinely interested in crypto. And if you try to connect with these guys and offer those airdrops, not retrospectively, but prospectively, you've already solved half the problem. I don't know anybody who's tried.
It's a problem that we cannot obviously solve here, so because it's far too encompassing. But for a closing, I want to hear your closing thoughts on, like, where do you think lies the most power to drive this change? Is it the users? Is it the foundations? Is it the validators? If you can point towards, like, who's best positioned to start driving this change?
I think one of the kind of key values of, again, decentralized protocols is that they mimic the real economy. The real economy is already decentralized. Like, that's why the price discovery mechanism that we have is what makes the market-driven economy successful. And so if you want to design a successful protocol, you have to embed the same kind of market elements within it. So over time, we will find kind of use cases which are solving a real problem for the users, and by necessity they will be decentralized in order to function like a real economy.
Thank you.
Feels to me that the answer changes over time. At inception, it's obviously the foundation that's holding most of the tokens, and it's performing these airdrops, is doing these delegation programs. It has the economic power, is in the driving seat. But if the protocol is maturing in a sensible way, that foundation wants to be giving up its power essentially to the community and the protocols that are active on the platform. So hopefully if the platform grows, the stakeholders then become vested in maintaining like a good, credibly neutral status so that they can all thrive on the platform.
I think my co-panelists have summarized it pretty well. I would say airdrops don't work. They're great, everybody loves them because everybody loves free money, but that's not a sustainable long-term solution for your protocol. And yeah, to summarize, there are different stages. Obviously, like, the public cannot decide for a protocol that's still nascent or that is still, so the design work needs to happen previous to that. But then the adaptation, the measures that you take in order to be able to adapt how this protocol will still be incentivizing the right things that you want to incentivize with this protocol, that needs to be left flexible and to be changed later down the protocol, maybe by the public, maybe by the team, maybe by whoever is the most interested on keeping that protocol.
Thank you guys for this panel and for your thoughts.
Thank you so much. Thank you. Yeah.
What a great panel we just heard. Very important topic. Now we've got 3 10-minute talks on regulation, but don't worry, we're going to keep it quick, keep it moving. We're going to start with US, then we're going to go to Switzerland, and then finally Germany. So to start us off here is Eric. He is a legal advisor for Lido, but not only that, he's also a board member for the Proof of Stake Alliance. So please give a warm welcome for Eric.
All right. Hi, everybody. My name's Eric. I'm going to be both the fluffer and the main presenter at the same time. So we're going to do a little exercise here. When I say I'm not your lawyer, you're going to say, I'm going to say I'm not your lawyer, right? So just to make that really clear, so it's not legal or financial advice. I'm replacing the speaker who's supposed to be here. And unfortunately, she couldn't make it. So before I start, I'm going to just say, introduce our sponsor, which is the Proof of Stake Alliance. And it's basically a group of people that come together, a conglomerate of companies and businesses, law firms, VCs that come together in the United States, and they do one thing, which is they cover areas of regulatory policy and tax, and they do advocacy, education, and they empower. How do they empower? If you remember, your voice can be heard, it gets channeled up, and then they make presentations to people that matter, politicians, regulators, and so on. All over the world, at every meeting that we go to, all the regulators say the same thing, and all the politicians say the same thing. They say, if you send no one, nobody can hear you. So you have to send people with a message. They're not going to listen to 100 people. They're going to listen to 1 or 2 people. So you have to get into groups. This is what the Proof of Stake Alliance is. If you want to talk about it later, when I'm off stage, we can move on to that. So I was handed this topic, decoding US regulations. And there's some problem areas, okay? The first one is taxonomy. Taxonomy is a very fancy word for vocabulary, which is the words we use. Anybody know what SIGSW means? Self-inflicted gunshot wound, right? So the things we say and how we say them matter, right? Certain words, like you will deposit and then you will earn yield on your deposit, creates very interesting things in the traditional world. And I guess I'll give 2 examples here. The first example, just a simple one, it's not staking, is bond. Don't call something a bond if it's not a bond, right? If it's not a debt, if there's no debt created and so on. But when you use that type of terminology, people who are responsible for bonds get very interested in what you're doing, and they want to know about it, and then they start digging. Then it turns out you're not actually offering a bond. Therefore, you're doing what? You're defrauding people, claiming that it's a bond when in fact it's not a bond, right? So that's one example. The second example is a more recent one, and I was at a workshop table. It's a true example. There's 5 people around the table. To my right was an enforcement officer from a regulatory body. To my left was a prosecutor for a criminal case, and there was 2 other lawyers in front of me. And in the middle of the table was a napkin, and we had a computer science expert come and explain account abstraction. During the explanation, the computer science engineer used the word, I wrote it down on my paper, smart contract 13 times while they were explaining what this was. Right after that, 4 different times, the regulatory enforcement officer interrupted him, pointed at the napkin, and yelled, there's custody there, there's custody there, there's custody there. On the 4th time, I stopped it. I said, hey, how about we have this conversation again from the top? I said, never use the word smart contract. If you have to, use the word script. He gave the exact same explanation. He only used the word script 3 times, communicated the exact same message. I looked at the enforcement officer. I said, is there custody there? And he smiled, and his conviction went way down, right? Contracts have been around for 1,000 or more years. The concept, it's ingrained in our culture. There's 2 parties to a contract, which means there's a counterparty somewhere the moment you start saying that. That's a computer science thing, that's fine. If you're talking to regulators or you're selling a product to the public, you have to use the common meaning of something. And if you use the common meaning, you're going to attract attention. So that's taxonomy. The YOLO 8 Pump Investor Advisor, by now you all know what this is. This is the token go up, flavor, right? People on tweets and posts and Discord, you need to get in. That's a problem surface. Indirect participation in staking. So staking, so you can true stake, like you can just take 32 ETH or whatever chain you're on, do it yourself. Or there's an indirect method which has a spectrum of activity. And some of those activities, for example, in the Kraken case in the United States, right? You could give Kraken your ETH. They didn't tell you what they were doing with it. They just told you you would get 21% back. So I know I'm talking to a crowd of people that understands how staking works, and there's probably something else going on besides staking if you're going to get 21% back. And so any type of indirect participation attracts the interest of regulators because they want to know who is controlling it, what's happening, does everybody know what's going on. False staking, which is the co-opting of the term, right? When there's no validation going on whatsoever, it's just called staking. It's really lending and borrowing. Not defining participating and educating, right? So there's nobody, like your own documentation and your own explanations matter. And if you sit around waiting for somebody else to make those explanations, guess what? They're going to be made by an authority who's not a staking authority or not a technical expert. So you need to be, so there's not enough of that. And then at the bottom here is not trying to achieve parallel policy objectives, right? So most of these rules and laws have policy objectives. Protection of the public, consumer protection, source of funds, anti-money laundering, right? Token tracing, for example, is a way of knowing where your funds come from. So there are policy objectives, and the policy objectives don't change, the methods change. If we don't provide alternatives, they will simply take the ones that already exist and say, you're going to have to do this because that's the only way I know how to do it. So those are problem areas. Here's a sample. A yield rewards an investment, either in equity or debt. End of story. A staking reward remunerates the performance of a service that is necessary for the functioning of a blockchain network. Who do you think wrote the top thing? Crypto people, right? Who do you think did not write the bottom thing? Crypto people, right? So what you can do, they asked me what you can do. So Proof of Stake Alliance yesterday released on the 9th of November some industry principles for the United States because you say, well, how do you decode the rules? We have somebody else already looking at what the problem areas are, and they come up with 3 principles. And so the 3 principles I'm going to leave you with that you can mitigate or try to limit your exposure to some of these problem areas. And the first one is users have all the information necessary to make informed decisions, right? So by the way, regulators only care about retail people. They don't care about professional investors or institutions, right? They're presumed to be knowledgeable. They care about retired people who have a limited amount of funds left, who get induced into parting with their money. So be clear about the services being provided and disclose all relevant information to stakers. APR, APY, how is that calculated? Is it rearward looking? Because if I'm not that sophisticated and it says annual percentage rate, I might think it's based on an annual calculation, when in fact it might be backwards looking for 7 days or something, okay? How are the fees paid, right? Use accurate terminology and refrain from investment advice, right? Investment advice is saying something is risk-free, has lower risk, right? Suggesting that this is a better investment than the other one, comparing to tokens when one of them is yours, comparing to protocols when one of them is yours, right? The second principle is users should control whether and how much of their assets to stake. That just means if I give you 10 tokens, that 10 tokens are staked. That I don't give you 10 tokens and you stake 9 of them, and with the 10th token, you do something that I don't know about, which has happened. Focus on providing access to the protocol and the ownership of staked assets. And the third principle, is service providers should have explicitly delineated responsibilities, right? So in traditional finance and investing products, you know, the custodian is separate from the broker, is separate from, that they have it separated, delineate. One of the issues in crypto is sometimes those things are merged together. So the third principle is do not manage or control liquidity for users. Do not provide guarantees on the amount of rewards earned. That's a promise. It's a very forward-looking promise, inducing you. You will get a guaranteed fixed reward of some type. And that's it. So the Proof of Stake Alliance, those are the three principles. I've got 10 minutes on the nose here. That's the website. What else are they doing? It's my last slide. So they do education on proof of stake. So you get on calls. There's 25 lawyers, another 25 project people, and we all talk about a particular topic, and we figure out what's the next thing. So education of proof of stake, they take it to lawmakers, policymakers, explain with hand puppets how it works. Staking industry principles, I just read you that. You can go check them out. Base layer neutrality, they do a lot of work on that. They do a lot of work on liquid staking, put out white papers, legal papers, and so on. The next one coming is MEV, and in the US, they do a lot of work on taxation of staking rewards. That is the director. She couldn't be here today, and that's it.
A great talk from Eric. He definitely doesn't look like some other lawyers that I know, but therefore his talk was a little bit more engaging than some other regulation talks I've seen in the past, so appreciate that one. Next up, we're going to Switzerland. So Yves is going to tell us how things look over there. Of course, Switzerland has been, you know, a big part of the push for crypto here in Europe, or I should say in Europe. So yeah, Yves, please, let us know.
Good afternoon, everybody. So we have this triple of speeches or short keynotes on 3 different regulations, the US, now Switzerland, and afterwards Germany. So I was also asked to decode Swiss regulations. I put it in quotes because I'm more or less telling you a little bit about how regulation evolved in Switzerland and current topics that are being discussed. So quick word about me. My name is Yves Hohenstein. I'm the head of custody and staking at Bitcoin Swiss. We're a broker, a custodian, and a staking service provider based in the Crypto Valley in Zug, and have been one of the OGs that actually built up the Crypto Valley. I have to take it a notch up from Eric. I do know a few things about tech, but I'm not even a lawyer, and this also makes me not your lawyer, and I have to do the same disclaimer here. But I'll quickly start with what are the principles in Switzerland regarding regulation, but also the legislation that enables subsequently the regulation. So FINMA has a few prior one goals, one being the protection of clients, that could be investors or other types of clients of financial institutions or regulated institutions, and the protection of the market integrity, but also has a mandate to strengthen the reputation of the Swiss market and the innovation and the competitiveness. The way they do it is that they have a so-called principles-based regulation. They try to be as much as possible technologically and competitively neutral, and they look at the actual function of the service that is provided. So what does it represent independent of technology? And also try to apply the principle of same business, same risks, then it needs the same type of regulation. And they have had a past of trying to remove uncertainties and obstacles, and we'll come to that right now. So it started in Switzerland more or less with a federal council report. So in Switzerland, the government is basically a federal council of 7 councils that run the country. They have published an official report on virtual currencies as early as 2014. And there's various players, including the federal government, but then especially local governments, that facilitated some of those activities of early projects, and one of them being the canton of Zug and some legal service providers that helped Ethereum Foundation settle in Zug and then facilitate the crowd sale that then attracted a whole lot of crypto projects to Switzerland, to the canton and the city of Zug, and made it eventually the Crypto Valley. And only 2 years later, the city of Zug started accepting Bitcoin as world's first government agency for paying services. And a few years later, also Bitcoin and Ether for taxes, again, a world's first. Then in 2017, FINMA did something really, let's say, positive for the industry. They launched the Innovation Sandbox. We could also call it like a regulation-free zone. So as long as you would only have customer deposits of less than 1 million Swiss francs and adhere to anti-money laundering rules, you could actually more or less freely act. And that had really the intention to allow smaller companies and projects to not have to deal with all the regulatory difficulties and obstacles until they have a certain size and certain traction. A year later, FINMA released the ICO guidelines. There was a lot of uncertainty, especially 2017 ICO hype about what is allowed, what is a crowd sale, what is an ICO, what do I have to do, and that provided proper clarity and also provided for the first time a classification of what is an asset token or security, what is a payment token, and what is a utility token. So we had that already in 2018, and this has helped a lot of projects to not have, as we have it in the US nowadays, wonder what am I allowed to do, what I'm not allowed to do. Same year, world's first crypto index fund was launched that was listed on Swiss Stock Exchange, and in 2018 it was an ETP, in 2021 it was a proper fund. In 2019, Facebook's famous Libra project was basically inquiring with FINMA what are they allowed to do, what not. This led to FINMA publishing guidelines on how to treat stablecoin. And in the same year, a new type of license was launched because the banking license was quite an obstacle for a lot of innovators and entrepreneurs. And the fintech license gives you a new type of banking license light environment where if you don't receive more than 100 million in customer deposits and you're not active in the interest differential business, you have less regulatory obstacles to deal with. And the last big milestone in Switzerland was what we call the DLT law, which is actually not a specific law. So Switzerland took a different approach than some of the other countries. The parliament was of the opinion that there's not just one law that would fit all use cases. So what they actually did is they amended 10 different federal laws selectively to create more clarity on, let's say, digital ledger related topics. But going to staking, because I think that's what most people interested here are with, is there's currently been a bit of press coverage about staking in Switzerland, and there's a lot of uncertainty. And I want to quickly tell you what it's all about. So this summer, FINMA, for the first time, indicated that they might change the practice, their supervisory practice related to staking. So their position currently is that some forms of staking, they no longer fulfill a legal requirement in order to consider a custodial position custody as opposed to being a deposit. And this one requirement is that if you're a custodian, in order to keep assets off the balance sheet and bankruptcy remote, you have to have hold them always available for your customer. And the position that FINMA now has is they say if you are offering staking services on protocols that have a slashing risk and or have exit locks, this requirement may no longer be fulfilled. This would then classify the holdings of your customers as deposits and would require a banking license. And this then has a whole lot of consequences. So at the moment, the industry has responded to that, and there's a lot of workshops going on with the regulators, and we expect to hear some more guidance from the regulators in Switzerland in the coming months. But it's a very constructive dialogue. So it's really what Eric said. It's about educating, about making clear that not every protocol is the same. Not every service provider is actually sculpturing his offering the same way. So we're now in this dialogue, and we actually hope that I can come back in a year and give you an update on what came out. So that was more or less it. Big question here. Any audience questions that I might answer? Then I say thank you very much.
So we've got one more 10-minute regulation talk coming, but stick around because after that we've got an MEV panel. So just one more 10-minute regulation talk, this time from the perspective of Germany. So we've got Daniel Schrader, who is the Managing Director of FINOA Consensus Services in Berlin. So Daniel has changed the title of his talk a little bit to also think about potential future regulation because staking is not yet regulated in Germany. So let's hear what he has to say. Please give him a warm welcome.
Test, test. All good, all good? Hello, hello? Nothing? Now? All right. All right, good to be here. As Max said, I'm from FINOA Consensus Services. We are a validator based in Germany. And I would like to talk about potential staking regulation. And I would like to start the talk with thinking about a question. And that question is, who are actually the customers of a validator? Because I think this question is key if we think about how regulation could work in the future in general. And that's why I would like to ask you in the audience, what do you think are the customers of a validator? So please raise your hand if you think that the stakers who are delegating their assets to a validator are the customers of a validator. If you think that, like 15, 20 people? All right, let's do the other way around. Who of you thinks that the network where the validators providing the infrastructure is the customer of a validator? Also, please raise your hand if you think that that's the case. A bit less, but more or less the same. And this is also how I think about this question at the moment. It's kind of both, but let me give you my thoughts on this question. So if we are thinking about the delegators, I mean, the delegators are putting their money, locking their money with the validator and are expecting to be able to earn some yields, to earn some rewards. And additionally, in most of the cases, the delegators and the validators have some kind of legal agreements. I mean, it's either some terms and conditions, some individual contracts, or similar. And there are even like liability clauses inside, like if you are not performing accordingly to SLAs that we agreed on, there is some reimbursement from the validator. So very good arguments for the delegator being the customer of a validator. On the other side, we're having the blockchain network. And without validators, there wouldn't be any blockchain network, right? Because there wouldn't be new blocks. No transactions would be validated. All of the use cases would not work on top. So the technical service that the validators are providing are essential for the health of a blockchain network. And in the end, the validators and the delegators are getting paid from the blockchain network with like new tokens for this service of building trust and building the technical infrastructure. Oops. And this shows that staking has kind of two sides. On the one hand side, staking is some kind of financial enablement. Validators are enabling, in the end, delegators to earn rewards. And on the other side, validators are providing a technical service for the networks. And this is kind of very close together in staking, what we are not seeing in other traditional industries. And that's the challenge that I see in regulation, because regulators need to balance those two things out: the financial enablement and the technical service. If the validator would see staking as a clear financial service, they would probably fully regulate this. And we are seeing the first steps here in Switzerland, as I've said, from the FINMA in this direction. And on the other side, there's a technical service where, I mean, technical services aren't regulated, right? And this is kind of the balance that the delegators need to find if they think about regulation or staking in general. So how are the regulators looking at that at the moment, or what's the current status? Mike said it already, and there's no presentation without a meme. MiCA is coming. MiCA is coming probably next year, but MiCA, the European regulation is not giving any guidance about how staking should be treated in Europe. I mean, there are a lot of very important topics covered in MiCA, like the declaration of tokens and different crypto assets providers, like custody and other topics. But staking for now is not part of that, and it's good to give the groundwork before doing additional regulation on top of that. But they communicated that it's planned to tackle staking in what regulation soever in MiCA 2, which we are currently expecting in like 2 to 3 years. Let's see. As Finor Consensus Services, we are a subsidiary of the German regulated custody provider called Finor. And with the combination of a validator and the regulated custody service, we are able to facilitate different use cases for our customers. For example, we launched the first, let's say, regulated e-staking offering from a regulated institute to enable our customers to use this service in a regulated and safe way. And on the other side, found a very new approach to the Mina staking ecosystem to reduce the risk of the counterparty risk of validators in general. And what those conversations showed me with the local regulation in Germany is that regulators are keen to learn and understand already much more than most of us think, I guess. But even though I think, and I want to end with a call for everybody here, that it's key to educate more and more about staking in general, not only the regulators, but also the communities that we have in the different blockchain networks. It's about educating the investors about the risks that are involved here. Because each of the networks have very different mechanisms if we think about the staking. And not all of the details are clear to all of the parties involved. So let's use the conference here to collaborate and come together to think about what are the best way to continue educating about staking in general. Thanks a lot.
Sorry? Hold on, we got an audience question for you. Stay right there.
Thank you very much. So you were saying in the beginning that in Germany staking is not yet regulated, but then in the end you were saying that Finoa Consensus Services has managed together with Finoa to launch the first regulated ETH native staking offering. How does this work with each other?
Yeah, very valid question. I think the key here is kind of the combination of custody and staking. Because you're interacting from a regulated custody provider directly to the validator of your choice. And this in the whole, let's say, ETH native way. How we are seeing this with a lot of other providers out there is that they are having like omnibus wallets to commingling assets is maybe the wrong framing, right? But they put them in a big bucket and then choosing the validator on your behalf. What we built is that you can directly from your own address within our custody stake to the validator of your choice without mixing your assets with other customers and without using any external smart contracts, liquid staking or other intermediaries, and see, let's say, everything on-chain with a direct interface, let's say. So that's kind of the question or the difference to a lot of other offerings that we are seeing out there, and that's why that's our framing. Any other questions?
Any other audience questions? All right, thanks, Daniel. Okay, so that's us done with regulation for now. Thank you again to those three for giving us a view of 3 different parts of the world, the US, Switzerland, and Germany. Now we're going to kind of pivot a little bit and talk about MEV. So we've got a panel with 3 panelists being moderated by the head of research at Chorus One. So I guess I'll give these guys some more time. Who was at the Staking Summit last year, by the way? Who was in Lisbon last year? Just a few hands. Okay. Who's super excited to be here this year and have 2 days instead of 1 day? Everybody's excited. All right. Thank you all for coming, by the way. It's great to see so many familiar faces, so many new faces as well. For those who don't know me, I'm Max Sherwood. I recently joined Obel Labs in content and communications, and I've been running H2O Nodes Validator on the side. So now that we have chairs, I guess let's please give a warm welcome to our panelists.
Okay, so hi everybody. This seems to be working. I'm Michael. I'm head of research at Chorus One. We are validator, but we have a big focus on MEV. One thing we've released is the official kind of grant study on the MEV mitigation on DYDX v4. And then we also do some validator-side MEV optimization on Ethereum. We've actually just released an article on this, so if you're interested in statistics on this kind of stuff, check it out on our website. Yeah, for this MEV panel, I think we're going to tackle it in 3 parts. In part 1, we're just going to talk a little bit about what is MEV, right? What are some nuances you might have to be aware of. Different types of MEV might be good or bad for different actors in the ecosystem. Then in part 2, we'll talk about where MEV accrues now. And then in part 3, we'll give an outlook in terms of, how might MEV accrue in the future and what are kind of some things that the panelists see there that could be moving in the medium term. Yeah, I think with that said, let's kick it off. Let's do a quick round of intros. Alex, do you want to take it away?
Thank you. My name is Alex Watts. I'm the co-founder and CEO of Fastlane Labs, and we run the MEV system on the Polygon proof-of-stake network. Before we started working on that, my background was actually as a searcher, and I did a variety of different types of MEV, not sandwich attacks, not the bad kind, but pretty much all of the others. On a few different chains before I started working on the Fastlane relay over on Polygon.
Hi everyone, I'm Tomasz Stanczak. Here when talking about MEV, you can focus on my role at Flashbots, mostly in the last months focusing on MEV and PBS designs for L2, also designs on integrations of Swav, which is a Flashbots chain for the market for the mechanism designs for block building. And privacy for the user transactions. Also, I have experience building the NetApp client and generally the infrastructure for Ethereum and other chains for the last 6 years. Also, being in the staking world, representing here TwinStake, which is the institutional staking system.
Okay, thanks guys. So I'd say let's start tackling it by discussing what MEV actually is, right? So I would say it would be great if you could give your kind of definition of what MEV is, and if you could talk about different types of MEV, right? So typically there's something called a sandwich attack, which many people don't feel good about, like Alex, for example. But for example, if you're an LP, sandwich attacks could be a source of revenue for you, right? So there's actually some nuance there. What is harmful MEV, and would people have different perspectives on that? Alex, if you want to start.
Yeah, so MEV is one of these concepts where it seems like every year or so the definition changes. I remember back in the beginning, it was minor extractable value. Then it became maximal extractor value, and I think the real irony is that these days miners don't even really exist. It's validators now. But whenever I think of MEV, I think of just value that accrues to any sort of party that is a result of how the transactions in a block are ordered. So for instance, if there is value to being the very first transaction in a block, the very first trader to access a trade that is only with limited availability, then I think that value might be considered MEV. There could be other forms of MEV where you can create value by reorganizing certain transactions inside of the block, and I think that would also be MEV. But I think the general idea here is that it's value attributable to where a transaction is located inside of the block, how it's ordered. But that's just my own personal definition, and I know that there are quite a few others out there.
I think one stable definition that we've been using for a long time with Flashbots is that MEV is any value that's available for the privileged actor by censoring, injecting, or reordering transactions. So usually when we think about privileged actors, we think about miners, validators, someone who does the block construction, but depending on the chains, that block construction has very different forms. Like think about chains which are offering first come first serve systems, then the MEV definition changes quite a lot. I mean, like, does it disappear or it stays? I think that privileged actor is very important because in any system, when we design the protocol, we can enshrine those privileged actors, so we can try to remove their ability to access that value, extract that value. And I think the whole idea of Flashbots always was how to design systems where either you remove the privileged actors whatsoever, so they don't appear in the design, or you restrict their ability to act in a malicious way, so to act maybe greedily or egoistically, and force them to redistribute the value in a most efficient for the entire network, for the users of the network way.
Okay, great. And then if we zoom in on Ethereum, which really is the prime venue for MEV at the moment, I think most people would agree with that. If you could just quickly describe the way PBS is set up, kind of who the different actors there are, and where the value accrues, right, across these actors. And if you think that there might be one actor in the PBS supply chain that's not compensated at the moment, and kind of, yeah, if you could quickly describe PBS and who captures value under PBS.
I think I've heard maybe 80% of what you said, so I guess I'll answer everything properly. There's a bit of echo. So we're talking about the current construction of PBS in Ethereum mainnet. So Ethereum mainnet is where MEV is dominantly looked at because of simply other chains having much less volumes. And the PBS was introduced as a concept together with Ethereum merge. So we transitioned from proof of work to the proof of stake, and we introduced a system based on a few components, one of them being MEV Boost, which is like a sidecar component that was designed by the Flashbots team together with Ethereum Foundation in preparation for the merge. So when you think about all the participants of this PBS ecosystem, so you have users who are interacting with the wallets or front ends, send their transactions or intents. You have the system of searchers who are practically traders, arbitragers, some specialized operators who have better knowledge of the markets, have market data, can have the capacity to simulate different types of transactions, liquidations, and so on. You have the relay, which actually allows, well, first maybe we have block builders, so block builders that can collect information from mempool and also receive the information from searchers who send the bundles, so like the atomic sets of the transactions ordered in very specific sequence. Those transactions can be transactions collected from mempool or other sources. Very often it's a private order flow, so like builders can purchase the order flow from the wallets or front ends. And they construct bundles when they inject their own transactions. As we said, this is all about reordering, censoring, and injecting transactions. So that's what searchers do, and then send it to builders. Builders can actually act as searchers as well, combine the bundles and mempool transactions into blocks. They try to build the most profitable blocks, and the one that is most profitable can pay the most of this profit share to the validator. And the relay in the system is responsible for comparing all the different block builders' results and choosing the one that is most valuable for the validator, for the proposer, sending that to the proposer. Proposer runs MEV Boost on the side of their node, which acts as a backup block builder, and the MEV Boost can select the best block and propose it to the network. There are some mechanisms that also ensures that we introduce some trustlessness, but the biggest problem is the relay has to be trusted to much extent by the block builders nowadays. So we try to enshrine the relay, and it's a long story.
Alex, anything you'd like to add?
So the way we've the MEV system over on Polygon is that we've intentionally not used PBS, not because we think that PBS is bad. I think there's also a lot of efficiency and a lot of value to be gained in a system such as PBS. Our main focus over on Polygon is that we're looking to limit the proliferance of bad types of MEV, most notably sandwich attacks. And so what we've done over on Polygon Proof of Stake is whenever anyone sends a bundle to our relay, we immediately broadcast the contents of it out into the public mempool. And this has this really fascinating side effect of extremely, very strongly disincentivizing sandwich attacks. And the rationale is very straightforward. If you're an attacker and you're trying to sandwich attack someone, You have to front run them first, then they do their transaction, the victim, and then you do a back running transaction. There's 3 parts of the sandwich. There's the victim in the middle, the front run in the front, and the back run in the back. But this front run is actually something that we like to call a loss leader. It is something that costs money. It's usually having to pay swap fees, and it's usually buying a token that no one really actually wants to hold. The only reason the attacker is doing this is so that they can increase the price for the user. And what we found is that by taking these transactions and these bundles and just broadcasting them to everybody, other sandwich attackers will actually sandwich the sandwicher, which is quite a fascinating phenomenon. If you guys think back to, I think it was like March, there was this beacon chain exploit, the low-carb crusader, and they ended up tricking a relay into releasing transactions and then sandwiching a sandwicher to the tune of $24 million of exploit profit. Now, it was a genuine exploit. Some people might joke that the sandwich attackers should have used a lower slippage setting. But at the end of the day, it was an exploit because of the way that they access these transactions. And what we've really leaned into is using this as a defense mechanism. And because of this, we've not observed in the last year a single sandwich transaction occurring over our relay. And we get quite a lot of transactions. Polygon is a very fast network. I'm not going to say all the swaps are huge in volume, but we do get a lot of them. And so it's just been a really fascinating thing. But we don't do this in a vacuum. There is one huge trade-off that we make, and our trade-off is that we do trust validators. Validators alone have the ability to sandwich users. And what we've found is that Polygon validators are very aligned with the Polygon ecosystem, and so they don't. But it is one of the core principles that we are operating on.
So the title of this panel is Sustainable Optimization in the MEV PBS type supply chain. And I think a good way of discussing this question is by now diving a little bit deeper into the various actors that we just discussed, right? So on Ethereum, if I attempt a quick taxonomy, you have users, you kind of have wallets facilitating their transactions. You have searchers that take advantage of said transactions. You have builders that build blocks with searcher and user transactions. You have relays that propagate these transactions to validators, and then you have validators that end up putting the block on the chain. Now, there's been a discussion that has gained some steam around the fact that relays are not currently incentivized. And I think something that's on people's mind is block native just shut down the relay because of a lack of incentivization, right? So relays on Ethereum are essentially being run as a pro bono good. So the way I'd like to tackle this question is by asking Thomas what your opinion is on relay incentives, if you think it's sustainable, if you think it can be run as a pro bono good, or if there would have to be some kind of economic compensation. And then Alex, if you could talk about the way that this is set up on Polygon and via Fastlane, and what you think some of the learnings there are that you've made. So Thomas, what do you think on ETH?
Yeah, I think relay incentivization remains a problem, and that's why we also think about the enshrined PBS to remove the relay role from the system. Still, I think that in the past people were giving up a bit too fast any tries to make the relay something that can make money. We've seen recently the approach from Titan Relay to make an offer of saying, okay, Relay can provide a set of services to the builders that may make it a profit-making solution, and how the relays can compete with each other. Because when you want to monetize a system, you need to decide that you can provide any added value to whoever sends you information, right? So you Relay, you provide services for the builders. And what builders care about a lot is the latency of delivery of the blocks, and also the access to the full domain of all the block proposers. And that's what the relays can compete on, like how well integrated they are, and how efficient routings to the proposers they have. Are they having some routing to the collocated endpoints with the major data centers, or directly with the operators, with the major node operators? Do they have some solutions for solo validator operators? And also, is their infrastructure robust and efficient and can provide some additional data and insights into the operation? So can you actually operate by selling data in real time, selling data without affecting users, without any harm to the users? Can you provide low latency and good distribution? Still, I agree it's very, very hard to imagine that this provides enough value to like long term to build a sustainable business that has some like kind of growth opportunities. So the other options are to establish some kind of granting solutions from the foundation, from the major ecosystem players to ensure that at least that system while we work on ePBS, which is quite hard to solve as we've seen, that in the meantime we can cover the cost of independent relays operations. The other thing is very often the relay will arise from the operations of the searchers, builders, and it will lead to vertical integration. So just in the search for decreased latency, we'll end up with the relay acting as maybe not profitable, but part of the profitability of the vertical integrated system.
So this is something that we've actually been able to observe in real time on Polygon, because the way our system is set up is that searchers don't actually have to use our relay. Our system in Polygon uses a smart contract as an entry point for all searcher operations. It's one of the ways that we've been able to keep it, relatively trustless and decentralized. But because of that, searchers are able to submit their bundles through the mempool, with each transaction referencing the hash of other transactions that they would like included in the mempool. And so if they wanted to, searchers could actually entirely bypass the relay that we have set up. But they don't, because to Thomas's point, there is a huge latency advantage to using a centralized relay. And honestly, I just don't see any way around it. We've actually been monitoring, we've spent a decent amount of time looking at some of the numbers in comparison between the bid values, like the value accumulated through transactions or through MEV bundles coming through the mempool versus over the centralized relay. And it's a huge difference. Like it's more than twice as high bids are just like in terms of same value, same MEV, same target for the bundle, but the auctions are just much more competitive when they're happening faster and coming in over the centralized relay. And yeah, even if you do have some sort of enshrined, decentralized fallback option, and it is great having that, because I do like to tell people that with Fastlane we could turn our relay off and everything would still work, but it would be a huge hit to the MEV value that is earned and accumulated by the validators if we were to do that. And I think, yeah, to Thomas's point, it's something where there's some solutions being considered, but we're still waiting to see which one is going to end up on top.
Okay, so this is one actor in the MEV supply chain, the relay, and kind of where that would go. And I want to zoom in on another actor that's a bit earlier in the MEV supply chain, and that is the builder. Because of adverse impacts on user flow that manifest through MEV, we've seen the narrative around incentives, around intents pick up a little bit, right? So everybody here is probably familiar with CalSwap or similar types of solvers, which are set up to satisfy user intents in a manner which is, so to speak, MEV resistant. I'm curious where you see this particular space going. Could builders perhaps also be solvers? Because it seems like there might be a lot of synergies there. Alex, I know you have some opinions on this, so let's start with you here.
Yeah, absolutely. And I think this actually this is a perfect segue after talking about the latency advantages of running a relay. When it comes to intents, what are intents? It's when a user indicates that they want something. They don't really take a preference on how that thing is achieved. They just say, hey, I want it. And one of the fascinating things about MEV is that MEV searchers, they are extremely well positioned to be fulfillers of these intents. But another really fascinating thing too is happening, which is that builders, oftentimes we're seeing integrated searcher builders. These builders are able to simulate the fulfillment of these intents in a variety of different positions inside of the block. And because of that, the integrated searcher builders are actually the best positioned to fulfill these intents. This leads to quite a few potential adversarial conditions if you're looking at like intent networks that are off-chain, having to negotiate with potential intent fulfillers that are on-chain. And I think it's going to be really fascinating to see how this all plays out. This is also one of the reasons why I am arguably the largest Suave fanboy there is, because I've been going really, really deep into that code base, and I'm really excited to see how intents can be fulfilled on the Suave network as well. But I think in general, when it comes to the latency advantages of having like an in-house vertically integrated builder, that is something that is going to be huge, and that's also something that I think a lot of that revenue may get indirectly passed on to proposers and to validators. And so in the short term, yes, I think that a lot of the revenue for validators is highly related to just like your generic MEV. But protocol designers are getting better and better and more efficient at limiting that. But now we have this entirely new space where we've got intent fulfillment and these solver networks, and it's my belief that a lot of that value, bundling revenue, so to speak, even inside of the 4337 EIP space, a lot of that value I think is going to get passed on to validators and to proposers, and I'm super excited to see how that plays out.
Yeah, so that's an excellent segue. You talked about Suave there. Thomas, how do you see it?
To expand on Suave, right?
Suave builders, intents, synergies.
Yeah, Suave builders, intents, sure. So Suave being the system from Flashbots, like a chain where you can deploy the mechanism and say, okay, this smart contract, and here obviously when you hear about Fastlane being a smart contract system, it seems that Suave is a perfect platform for this. So Suave is a platform for these smart contract systems to say, okay, this is how you solve for intents. This is how you get access to the private order flows. This is how you manage the payments for the access to order flow. This is how you manage payment for some block construction opportunities. This is how you support the smart contracts to integrate, to compose together towards the block building. So Suave aims at allowing multiple parties to participate together in this decentralized block building process with the protection of the user intents or transactions that they sign or not sign if it's intent, and doing all of this with delivery for multiple chains. So starting with Ethereum and very naturally expanding to layer 2s or EVM related chains and then further. So the system is meant to be permissionless for various participants to build their solutions on top of Suave, and quite flexible for the MEVM. So it's practically EVM system with extension of multiple pre-compiles. So it's very Ethereum-like system that does not have to progress at the speed of other chains, and this is important. So the Suave chain only allows to deploy different smart contracts, but the block building happens really like off-chain. You invoke the smart contracts to slowly construct the block within the confidential data storage, and then you can access that block even if any block is not, if no block is produced on Suave. So yeah, I think it plays with all of this.
Okay, great. So we talked about relays, we talked about builders. I work as at a validator, so I'm also curious how the role of validators could develop in the future, right? So we talked a little bit about intents and builders fulfilling intents and Suave providing some capability there. And then a lot of intents, if you look at the CowSwap example, for example, really are more or less settled off-chain, right? How do you think validator revenue will develop in the future with this kind of intent settlement systems gaining some prominence? And Alex, I know that you're a team validator on Fastlane. How do you see it? Where should the incentives accrue in the kind of future vision of the MEV pipeline?
There's a really interesting game playing out in the Polygon that I think is going to be really fascinating, and I think might be a forecast of things to come. So right now, there are these, right now there are these bundlers, right? And these bundlers, what does a bundler do? This is not an MEV bundler. This is an account abstraction style bundler. This is an operation bundler. And what these bundlers do is they take these operations, which are these signed messages from users, but these signed messages are not transactions by themselves. And so what the bundlers do is they take the signed message, they put it inside of a transaction, and then they sign the transaction. Why do they do this? Why do they pay for the gas by signing the transaction? Well, because they get reimbursed. They get reimbursed by the user who had signed the original operation. And that's normal. That's been going on for over a year now. But what's fascinating is that on Polygon, there's this new type of MEV that's popped up, which is where these bundlers are taking these user operations, putting them in transactions, and then because there is no private relay, because we've blocked it as part of our attempt to stop sandwich attacks, they then put this transaction into the public mempool where other bundlers see it. And when the other bundlers see it, they can copy the user operation out of the transaction. Then they can make their own transaction that has a higher gas price, which is to say a higher amount of value to go to the validator. And then they then put the user operation inside of that, effectively front-running the first transaction. And it's this actual scenario where we're looking at, a bundler versus bundler MEV game where the winner, like the real winner, is actually the validators, because these bundlers will keep front-running each other until all of a sudden it's at such a high gas price that it's no longer profitable to do so. It's this really fascinating MEV game, and I can't help but think that some version of that is going to play out with validators in the long term. Because fundamentally, it's up to the validator, it's up to the proposer, or even the builder, to determine which transactions are placed in what order. And with these user operations, in the future, with EIP 4337, they're all going to be publicly available. It's a full-on, publicly visible alternate mempool. And that is, in large part, a big part of the future of intents. And if you have a scenario where these different entities are competing over which one gets to fulfill the intents, well, who gets to decide who wins that competition? It's going to be the builder. And if we're looking at which builders get to decide which block it's going to be the one that can propose the most valuable block, which is to say it's going to be the one that extracts the most value so that they can then convey that value onto the validators. And so I do think that in the long term, we're going to see much lower revenue for validators from your traditional MEV as more and more of that get fixed. But we're also going to see much higher revenue to validators from user operations and from intent fulfillment, which will predominantly be handled via user operations.
Yeah, so I think that when we start talking about validators, that suddenly our thinking expands beyond the revenue and searching world and builders world, because we start talking about the security of the network and the security budget. So exploring both Ethereum layer 1 and all the L2s, analyzing of what should be the budget, the spending on the security that they pay to validators. Well, you want to minimize it. From the perspective of the protocol, you want to pay the least possible amount to validators for securing your protocol. And, well, there's probably lots of node operators here, so you know that your revenue is combined of the block rewards, transaction fees, which very often are considered part of MEV, the MEV payments from the systems like PBS, Fastlane, and so on. And some of it is very predictable, some of it is a bit more volatile and maybe smoothens when you operate a lot of nodes, lots of validators. Now, also for many of those networks, it's very important design choice, or whether those validators can be permissionless or have to be selected via some governance model. So all of this defines of what exactly you want to do with the revenue from MEV. It might be a lesser evil and convenient thing to pay that to validators, but it's not really the ultimate goal. You want to either remove that MEV entirely by very efficient protocols, or not pay to validators at all and just redirect to users. If you pay validators from MEV, then you can decrease the general payment from the block rewards. And the total thing is what the protocol developers have to kind of like, or maybe like protocol economists have to plan as the security budget and kind of yield interest rate that you pay, because all of that will be compared by the node operator when they make a decision whether they escape chain in search for another yield, whether for the allocators of capital, whether they want to stake with this chain or another. And I think soon we'll be entering into much more mature world of economics of the yields from different protocols and how much we pay for security and organizing that payment.
Okay, thank you. So we are out of time, but I think it's okay to conclude this panel by volunteering a quick summary of where the various actors in the MEV supply chain may go in the future. So if I'll just attempt that, stepping down, validators from first principles are responsible for chain security and are under pressure of opportunity cost because there are many chains out there and people want to be in the asset class, but might not be as opinionated on where they want to be, in which token. So from that perspective, validators will be fine because they'll need to be properly incentivized. Relays can build a business case around co-locating, is what Thomas mentioned earlier, and in general, there might be something around latency, or you can run it as a pro bono good. And then builders in a world where many retail transactions are settled as intents could assume a kind of new hybrid role where they also work as bundlers. Is that fair? Anything to add to the summary?
No, I think on that point, when it comes to bundling, I think one of the fascinating things with the bundling revenue is that a lot of it goes to validators when there's competition over who can be the bundler. And one of the things that we're actually working on right now is a system for dApps to be able to control exactly that. And it's something that we find to be very fascinating. It's a way to repurpose all of the solving energy and the searcher networks that we've already built out on Polygon in order to have this maximally value retentive, it's a new phrase I came up with, environment for solving intents for different dApps. So we're very excited about that coming up.
Okay, Thomas, anything you want to close with?
Well, lots to explore. Generally, these are most possible ideas, but I think we'll be exploring how different L2s will approach it, FCFS or new PBS models, enshrined PBS, and so on. It's quite exciting time to look at different mechanisms.
Yep, it's an exciting time, so thank you, and thanks everybody. That's it.
SSV about distributed validators. If you haven't heard about distributed validators or distributed validator technology, I would politely advise you to pay attention because these things are starting to appear on Mainnet. I'm personally very bullish on this technology, and what better way to foster innovation than with a little bit of good old-fashioned competition. So first up we have SSV speaking now. Later on we'll have Obol speaking. So yeah, SSV we'll hear from Massimo, who is developer relations. So let's please give him a warm welcome. Massimo.
Hello. Okay. Thank you for the introduction, and hello everyone. I'm Massimo. I do developer relations at SSV. So I'm here to talk about how we're launching a DVT network on Mainnet. I think just in the finishing panel, on the panel that just finished, I heard decentralization multiple times in the last 5 minutes. So we all know that decentralization is kind of like the key for Ethereum staking. We believe as an ecosystem, as a community, that it should be in the hands of as many people as possible, as many entities as possible, but vulnerable to none of them. So as a team, SSV, we set our goal to decentralize Ethereum staking. And the truth is, this current situation, as the picture showed, is not ideal. We're kind of far from it. There's many companies, like there's a small number of companies that control a big portion of the staking, and they grew so fast and so much, they basically got too good for their own good. And this is, of course, I don't have to say it, but it's a systemic risk, because the bigger they grow, the bigger the risk is for the entire network. And so I'm here to talk about what these companies can do to sort of like stem the tide or reverse this excessive centralization. I think the slide has been converted, so the animation doesn't work. But what this slide was supposed to represent is the picture in the background is the famous, I guess, roadmap that Vitalik Buterin posts on Twitter, formerly Twitter, now X, from time to time. And decentralized distributed validators has been on the roadmap for a while. You can see the circled at the top right there. And what this means is that distributed validators has been on the roadmap for a while. It's a part of the Ethereum tech stack. It's a technological primitive. And simply put, SSV has been working on it since the beginning, since the inception. And we believe that this leads to that Ethereum staking is central to the future of Ethereum itself. And DVT is what basically will unlock this central position, because with services built on top of Ethereum staking, it eventually will drive the success of the overall network. And let's talk about like what DVT is at a glance. I think many here know already, but for those who don't, the purpose is to be, like I said, vulnerable to none of the entities that run the network. And how this is done is by splitting the key, the validator key is into key share, and letting the validator operations be managed by multiple parties that cooperate in a trustless manner by using threshold signing and using Byzantine fault-tolerant consensus protocol. This is generic DVT definition, and the benefits that you get from running your validator as a DVT cluster is that you help with the decentralization of Ethereum. If the cluster is built correctly, you also help with the with diversity, because you increase the resilience of the network by making sure that the cluster is composed of different operators that run different tech stacks. So that would mean different execution clients, beacon clients, and so on and so forth. The added resiliency is due to the fact that being fault tolerant, if one of the nodes or a certain number of faulty nodes in the cluster, as long as the consensus is reached, as long as this number is below the threshold, your validator will still correctly attest and propose blocks. And this ultimately leads to a minimized slash risk, because what's happening is your key is distributed into key shares, so you can safely keep it and store it offline. It doesn't have to be online all the time. So it's an increased inherent safety for you and for the network itself. But talking in specific about what SSV SSV network is, we are pioneers in the DVT space. We started working in basically in the inception of DVT when it started circulating as a technology. As a matter of fact, we are so old, we're so OGs, that SSV stands for Secret Share Validator, which is actually the initial name of the technology. It later got renamed to DVT. We have like 60 plus dedicated contributors across like multiple countries, and we are collaborating with proof of stake leaders in the space. I later have a slide showing all the names, and they have been running more than 100 nodes with us in between testnet and mainnet. We have experience of running actually almost 3 years of running a staking service, and we use this experience to work on DVT and create a DVT testnet that has been running for basically 2 years right now. But what I want to stress, it's very important to me as a software engineer, is that all of our work has been open sourced. It's done as, has been created as a public good, and it's designed to be running as an infrastructure for staking. It's not a product that we want to like sell to the end users. We want services to be built on top of it. As far as the technology goes, it's composed of a layer, a contract-based layer, where you can register your validator with zero manual coordination, with just essentially a transaction. And you can, at the same time as you can register, you can also swap operators just as easily. So for this reason, it's easy to be onboarded as an operator. You can come in and just run our node software, register as an operator, and you're good to go. So it's just one piece of software you need to run, and a transaction to join the network. And same time, you can come in and register your validator and distribute it with just one transaction, as long as you have the key and you split it. So all of this basically composes a reusable infrastructure, like I said, that can be used by multiple different teams, different like companies that want to build on top of us. And on top of it, yes, it's DKG ready inherently, because as long as you like provide us the key shares, we're happy. As a matter of fact, we're also building right now a tool to initiate DKG ceremonies. And we have also grantees that are doing the same thing. What this slide represents is what we think is the evolution of DVT as a technology, starting from the like traditional validator stack. And that is like two separate DVT clusters that are doing their thing, and like they might be from different companies and different teams. What we have created, and what we think is the winner in all of this, is a DVT cluster, a multi-cluster DVT network, where just the network effects alone means that different teams that maybe want to create islands, want to like don't necessarily want to cooperate with others, can still benefit from the network effect. But it just multiplies when you can essentially, you have the freedom to pick and choose different operators from different teams, and you can compose multiple clusters with different like sets of operators. And as soon as you see the performance of someone degrading, you can just swap him out, and you're good to go. That ultimately leads to a summary of the key properties of SSV, key advantages of distributing a validator with us, which is the simplicity, which I already said. You can come in and join the network in just the time it takes for you to have a transaction validated by the network. It's going to be, it's already permissionless on testnet, and we want to launch fully permissionlessly by the end of the year. I'm going to talk about that in a second. And I already mentioned it's zero coordination. So as soon as the transaction is validated, the operators that you chose are going to start attesting for you. No coordination needed. You don't have to know the guy. As soon as you are happy with the performance of that operator, you're good to go. Yeah, I already talked about the swapping in and out. And most importantly, I want to stress it again, we built it as a common, community-owned public good. We have, all our code is open source, both the smart contract and the node. And there's a DAO governing key aspects of the whole network, like the network fees, how much, what are the limits of the operator fees, how much they can increase, what is the windows for it to take effect, and so on and so forth. And ultimately, once again, I want to stress the flexibility that this kind of configuration leads to, and the fact that it allows teams to essentially scale how much they want and however they want to. I mentioned Mainnet, so let's talk about it. I'm happy to basically report that our like we took a very deliberate approach to our rollout. It has been divided into 4 phases with very cautious approach. We had started with a launch with just us as operators. We monitor it, we monitor performance, and then we started the limited launch, which was with verified operators, which passed KYC and vetting, and we once again monitor the performance. The launch phase, which is still limited partially with launch partners, which are applications that have built on top of us, and it has been going. Let's talk about some stats about it. It has been going for more than 100 days, and 50 plus operators have been running on Mainnet, and that slide has been basically rendered outdated yesterday, last night, because I said 750, and I checked it today. It's already 180 validators distributed on Mainnet on SSV, and those 50 operators are present in 30 plus countries. So we're fairly we're fairly distributed in terms of geolocation on 21 data centers. And like I said, that launch phase, it has fostered the development of 15 plus applications on top of our network and protocol. I think everyone here is interested in this slide, particularly on the performance, because at the end of the day, it's about money. The attestation rate is approximately 100%. And what I think I want to stress out is the attestation effectiveness, which is a net increase compared to the mainnet average. And this is due to essentially the gossip effect of the network and the collaboration between operators in a single cluster, because when they agree on they reach consensus on a certain attestation, they all 4, 7, 10 components of a single cluster start to spreading the message, and this essentially multiplies the liveness of the cluster itself. So that's why the attestation has increased with respect to the mainnet average. And like the slide says, basically 100% proposal rate. This represents the SSV ecosystem. Like I said, I mentioned we are collaborating with leaders in the proof of stake ecosystem. So you'll see many familiar names. And like I said, we are trying to help many of them stem the tide of staking centralization. Moving on to, I think, what's going to be even more interesting, we're very excited to bring this program, to this incentivized mainnet program, because our goal is to expedite the distributed validator adoption, and we want to reward people that join us as pioneers of this. So what you're going to get is, if you run a distributed validator with us, you're going to get an APR boost of up to 50% in SSV tokens, depending on the number of validators. So it's gradually scaling down as the network is increasing. But what this means is that you basically you create a win-win situation where the network is decentralizing, you get a better service, better better results in general, better attestation rate, and you also have an APR boost on top. To be eligible, simply this program is running for an entire year. It has just started, but you have plenty of time to join, and just simply run a validator with us, distribute it, and make sure the performance stay above 90%. The last thing is very dear to me. We're running out of time, but I want to stress the fact that we believe, we're very heavily invested in fostering development in the ecosystem. And so we believe that the future of staking is built upon lots of services that are still going to have to be built. And the vast majority of staking, of Ethereum stake, is going to go on to those services. And we want them to be building with us. We want them to help. We want to help them build. And that's why we have destined, that's why our focus, our audience, that was supposed to be Steve Ballmer shouting developers, developers, developers. I kind of got broken. But that is our focus. That is our audience. We're not a service for users or end users. We are an infrastructure provider for people building on top of our protocol. And that's why we have a 50 million ecosystem fund. And on top of that, we have a 3 million grant. So just come join us, come build with us. I think that's it for the slides. Thank you for listening in. I'll try to rush through it because we're running out of time. But if you have any questions, feel free to join us at our booth, which is on the room opposite to this one. Thank you for listening.
You heard it here first, distributed validators. More decentralization, better attestation rate, a little bit of boost with some SSV tokens, what's not to like? So, now we're going to talk a little bit about staking, but with a bit of a flair. So who's concerned here about centralization? Are there any, censorship, sorry. Are there any censorship doomers in the audience? Okay, well, Alex is a censorship, what do you say, anti-censorship maximalist. That's a bit of a mouthful. But he's going to tell us about a new approach to liquid staking. He's the CEO of Tenderize. So let's please give a warm welcome to Alec.
Can you hear me, everyone? Ooh. So back to the intro there. I would consider myself a censorship-resistant maxi. So whichever chain can deliver censorship resistance, I'm that maximalist. Okay, so today we'll be talking about a new approach to liquid staking. But before we get into the talk, I just want to kind of bring something to everyone's attention. I think that we may have just made it out of the deepest and the longest bear market in our industry's history, and that's not easy. And I think everyone in this room deserves a round of applause for that. So let's just take a moment. It really isn't easy to run your business, stay solvent, and frankly keep a level head during a bear market. So you all should be really proud that we're here. So today's talk is going to be a new approach to liquid staking. Let me give a background on myself. So I am a finance guy. But the reason I'm interested in crypto is the censorship resistance. I think that we can create a new financial system that is more transparent, more publicly accessible, and more fair. But I think that we're at a unique crossroad because the certain financial products that we're building now on top of this infrastructure are potentially removing some of those attributes in exchange for higher yield. So we're at this crossroad where we are preferring yield at the expense of censorship resistance. And I think that's a massive problem. So today we're going to be talking about a new approach to liquid staking, one that satisfies this demand for high yield products, but doesn't infringe on those core principles that brought us here in the first place. So let's just get right into it. We're going to first talk about liquid staking in its current form, and some potential shortcomings. We'll talk about Tenderize V2, which is the protocol we're working on. Then we'll talk about, or after the core principles of what we believe, credibly neutral liquid staking should be, we'll talk about how those principles get translated into on-chain architecture. And then we'll close it out by looking at some of those fun degen style strategies that a lot of people really love, and we can build them in such a way that still respects those core decentralization, permissionless, and censorship-resistant attributes. So let's look at liquid staking today. Think of this like you're looking down on the Ethereum staking ecosystem. All of those dots on the left are various validators that custody stake and are validating and supporting Ethereum. In the middle, you'll see a couple of the popular liquid staked tokens. And then on the right, you'll see that a lot of these liquid stake tokens get their liquidity from Curve or Uniswap. And if you see, each and every one of these LSTs are pointing over toward a certain subset of those validators that are circled. And that's because depending on which liquid staking token you're holding or which protocol you're using, that is what determines which validators are allowed to participate. So it's not permissionless. If you're holding RETH, you're actually holding what is effectively an index of validators that have less than 32 ETH. And the second liquid stake token up on the screen is the Liquid Collective product, which allows for OFAC compliant validators to support that liquid stake token. And let's skip down to the bottom where we have Staked ETH. Staked ETH is an index of the 29 most well-known, reputable, and performant staking service providers in the ecosystem. So the key takeaway here is that these liquid stake tokens are effectively index products. The performance of the asset is directly dependent on the performance of the underlying validators. And each and every one of these indexes also has a philosophy around who's allowed to validate. When it comes to liquidity, all of these indexes use the same vanilla liquidity approach. They incentivize the crap out of it on Curve or on Uniswap. And this works pretty dang well for the DeFi native or for the DeFi degen, but it leaves out some really, really important stakeholders. And this might resonate with a lot of people in this room because the people that are left out are the actual node operators. In the liquid staking V1 ecosystem, node operators are basically a second thought. The real user who's prioritized is the individual holding this index. So with this index style, node operators have no ability to create a liquid position for their own independent staking hardware. You're basically stuck minting an index, and then dependent on other people's performance, you may have decreased yield. And even though you're running your own operation and everything's sound, you're now holding an index that could underperform because some other person that you don't even know. So you can't silo your risk to your at-home operation. And two, when you use an index style approach, the stake ends up distributed across all of the validators that support that index. So if you're a staking service provider and one of your large delegates approaches you and says, hey, I have $50 million staked to you, I would love to get a liquid product so I can borrow, lend, do whatever I'd like to do. But today, staking service providers are forced to go tell their delegate that, hey, if you liquid stake with any of these indexes, we're going to lose some of our AUM. So the staking service provider doesn't have a solution where their delegates can stay staked to that preferred partner while still enjoying liquid staking. Not to mention, when you use this index style approach with some subset of validators, you almost can guarantee that you're going to have centralizing attributes due to the fact that liquidity begets liquidity. So the most liquid index on Curve will attract the most stake and centralize that stake to whatever validators are supporting it. So we're arguing that it's time for a new approach. And we're arguing that it's time for the tenderized approach. Our vision is really simple. We want to create an extremely bare bones, governance minimized, and credibly neutral liquid staking infrastructure. And on top of this infrastructure, that's where you build all your cool indexes, financial products, leverage products, whatever you might want to build. All of the financial structures go on top of the infrastructure, and the infrastructure is radically bare bones. Such a credibly neutral liquid staking infrastructure is comprised of three core principles. First, you have the permissionless validator set. So instead of the protocol having some sort of whitelist or some sort of philosophy around who and how one validates or joins as a validator in that network. Instead, you make it permissionless. Second, you make liquidity permissionless. This probably sounds a little too good to be true, but I'll get into it in a moment. And then finally, we do a bottom-up approach to all DeFi structures. So instead of shipping the product with some philosophy from day one, you ship only infrastructure and you allow the market to build on top of it. So let's look first at the permissionless validator set. And the only way to make this thing actually a permissionless validator set is you do validator-specific liquid staking tokens. This means that when the user selects which validator to stake to, their risk and their reward is siloed to one specific hardware, one specific validator. There's no whitelist and there's no governance. This allows independent operators to stake to their at-home system. This allows staking service providers to service their current delegations without losing AUM. And ultimately, it allows for the end user to sleep well at night, knowing that there won't be some governance decision that will change where their stake is living. So let's see what this would look like from a UI perspective. It looks a lot like a delegated proof of stake system. You scroll through to see all the active validators on the network. Let's just say that we want to go to Chorus 1. We select Chorus 1. We send our assets to the smart contract. The smart contract stakes them and returns to you a liquid staking token derivative that is siloed to the performance of Chorus 1. Okay, now we have validator-specific LSTs. But I'm sure you're thinking, how the hell are you going to make these things liquid? Fragmentation's already a problem before you even add this phenomenon of potentially hundreds of liquid stake tokens in the market. And we're going to service these liquid stake tokens not in the vanilla DeFi degen way, which is just to incentivize on Curve, or Uniswap, or whichever your preferred DEX is, but rather, we don't do that at all. We do a shared liquidity approach. And this is possible because we've reduced all of the smart contract risk. These LSTs aren't complex financial structures. They're hyper basic, extremely vanilla, and as a result, you can treat them as one-to-one to its unstaked counterpart. This way that even the newest, smallest validator can enjoy the equal amount of liquidity compared to the incumbents, and there's not this runaway liquidity phenomenon which we observe in the staked ETH ecosystem today. Each and every one of these new derivatives can be routed or liquidated through this liquidity pool. So let's just see what it would look like from the user perspective, because as I mentioned, this isn't designed for the DeFi degen. So we throw it all in one user interface. So there is our validator-specific Chorus 1 position. And very simply, we can begin the unstaking process, which is unstaking it one-to-one, or we can instantly swap, and that will be routed through that public shared liquidity pool. So you're never left holding a bag. You can always unstake by waiting the unstaking period, or you can directly route through the liquidity pool. It's up to you to decide what you'd like to do as the end user. And when it comes to popular liquid staking token DeFi strategies, oftentimes people are curious about, what about liquidations? Is that shared liquidity model going to be deep enough liquidity to offer loans against assets? And I'd challenge everyone to think beyond just the Curve or the Uniswap approach. In traditional finance, there's no robots liquidating positions, but rather you do peer-to-peer liquidations, meaning that in the event that the collateral value is decreasing close to the margin call price, instead of a robot selling that through a public on-chain liquidity pool, any market participant can go in, buy the collateral, and then the difference between the collateral value and the repayment amount of the loan is their profit that they get to capture. So as liquidity re-enters the market, in this hopeful bull market that we're on the forefront of, more sophisticated market participants are entering and will play the role of exercising peer-to-peer liquidations. So when you combine validator-specific LSTs with public permissionless liquidity, you get all of your favorite liquid staking experiences, and those are the ability to tokenize validator-specific stake, you can swap or unstake, and then you can borrow against it. But of course, it doesn't stop there. You can still build your favorite degen products as well. Let's talk about some bottom-up financial structures. So say the market really does prefer a Lido-style index. Let's just say the 29 most performant validators. Fine, build that index, but build it with validator-specific LSTs. Say you want an index of OFAC compliance, just like Alluvial or Liquid Collective. Fine, do it. But do it with validator-specific LSTs. Let the end user have complete flexibility as to where they want to silo their risk. The purpose of this is to allow for flexibility and allow for correct risk-adjusted experiences in the market. And you can build cool things like LST-backed stablecoins. So now if you're a service provider and you want to offer loans against your assets, you can do it completely on-chain with our infrastructure, and your end user gets to stay siloed to their preferred partner, and you all get to retain your assets under management. And then finally, you can get real degen and build structured products on top of it too. You can borrow against it with the stablecoin, buying more of the LST. And you can do this all while siloing your risk to whichever hardware you deem worthy of holding your assets. So that's really what we stand for here. Together, we can take a conscious effort to build all of our favorite high-yielding products, but we can do this all on top of validator-specific LSTs. That's the future of liquid staking, and we don't have to compromise on yield to make it happen. Using validator-specific LSTs, we can retain our decentralization attributes, ensure that our networks remain permissionless, and we can actually deliver on this promise of a new, transparent, and trustworthy financial system. But at the end of the day, we have to do it with validator-specific LSTs. And we just launched our testnet proving out this concept, and I would love to talk more about it to anyone who's interested. If you're a node operator or you're just a user of liquid staking protocols, please come by our booth, check out the testnet, and we'd love to welcome you in our launch cohort if you're so interested. So that's all I have for you today. Please come by, say hello, and thank you very much.
Particularly liked the pause to give ourselves a round of applause for making it through the bear market. That was good. So just out of curiosity, is anyone here joining us from Latin America or South America? Not many hands, one or two hands. Que pasa? All right, so next up we have one of the top DeFi projects from Latin America. He's come all the way from Mexico to tell us about what Metapool is doing. Some of you may know Metapool from Near, but they're expanding to Ethereum as well. So I think, is Claudio ready? Okay, he's getting mic'd up. Anybody know any proof of stake jokes? I've got nothing. Well, what else can we talk about? Maybe we could do a drum roll. By the way, if anyone's looking for seats, there's a couple empty seats in front of me here, so don't be shy. All right, Claudio, please tell us, give us a warm welcome.
Hello, everybody. My name is Claudio. Flew in all the way from Mexico. My co-founders right there flew all the way from Argentina as well. Thank you very much. Really happy to be here in Istanbul, in Turkey, more so than anything, because it represents why we're building on crypto. And this is what I'm going to be talking to you today. So just to show our hands, who here has faced more than 20% inflation? in their countries? 1, 2, 3, okay. 30%? No? There you go, Argentinian for sure. 40%? Argentinian for sure, 60? There. So when we started building in crypto, we first thought of who we're going to be building this for. And emerging markets for us is at our heart. So we'll tell you a story about it, but let's get this party started. So we're going to be talking about how to scaling communities, community impact with liquid staking tokens at the center of this strategy. So what is Metapool? Metapool is the first liquid staking token for Near Aurora. We just recently launched on Ethereum. And more importantly for us is it is fully owned by a DAO. We're putting community first. And this year, what we've voted on is for all protocol fees from the liquid staking platform to be distributed to the community. We're going to be talking about that in a little bit of a while. So our roots, yes, like I said before, I've come from Mexico. My co-founder is from Argentina. And we had a long story about how to hedge against inflations. And this is the answer that we had for the last 50 years. Yes, sorry, it's not pretty, but this is how we hedge inflation. We went in, buy dollars, right? I've lived in the border all of my life. I'm from Tijuana. And so it's like easily, you go trade dollars, you go to the bank and you deposit them, and then that's how you hedge against inflation. That's how my dad did it, that's how his father did it. In Argentina, you used to be able to buy dollars. Now it's illegal. So how do we hedge against inflation? That's a big thing. That's what got us, Lucio and myself, together on a Discord, started talking, and he said, you know what, there's this thing called liquid staking. So how does Metapool work? It's a non-rebasing asset. We're right now live on Ethereum mainnet, on Near, which is where we got started, on Aurora, which is an EVM-compatible platform. We have an internal AMA, so that way we can do the fast liquid on staking. But most importantly is that the smart contract itself is the one dictating the price on the asset. So when you trade that asset, you're not losing your staking rewards. That's calculated immediately through the smart contract every second. So the big question here, right, is like, how do we onboard 1 billion people, right? Sorry, it's not going to come from Western countries. And actually, that's why I'm really excited to be here in Turkey, because this is going to be one of those regions where that billion user adoption will start, right? And for us, coming from Argentina and Mexico, well, we know that we are truly solving a problem. It's just, how do we have this value creation process that it's now fully on-chain, fully transparent online? Can we bring that to people from the different regions? So what is our goal, right? We understand, I think most of everybody here know what a liquid staking token is, right? I'm preaching to the choir. But one important thing is like, not all assets are flowing back into the ecosystem. And when I'm saying flowing back to the ecosystem, I'm not talking about just DeFi and all this degen stuff and the large whales coming in. I'm talking to the people who we are solving a big problem is how to hedge against inflation. The other thing is the accessibility and decentralization aspect as well, right? And Tenderize brought in a good comment, right? It's like we are having and facing the problem of different validator nodes or operator nodes cartels, right? And so I don't want to shoot or throw anybody under the bus, but it's a big problem that we're going to be facing. I believe that adoption in emerging markets will allow us to kickstart the decentralization process. Of course, it's going to be ants at a time, but I think that's the way to roll, right? Immobility, we already know a lot about this. That means that you're not leaving your tokens in one place. That's flowing back into the ecosystem. We believe that emerging markets are going to be a key part to make this work. Now, the adoption process, and this is where in emerging markets is a little bit different than in Western countries. Most importantly is centralized exchanges and fintechs are going to be a core part of it. And this is why we partner with Near to launch an enterprise node program, because we understand that the custodial side and having centralized exchanges access to the underlying liquid staking tokens is going to be a key component in this. And so, again, happy to be partnered with a couple of the great ones here, right? Like Luga nodes, we have NordStake, we got Sensei node from Argentina, friends from Berlin, crypto capable from India, A for one or all for one based in Korea, right? We're trying to do decentralization at the core, and more importantly, because this is how people are going to have access to a liquid staking token. A little bit of our numbers, right? So we have around $23 million in TVL. We've started on Near. We moved to Aurora. We're now on Ethereum. We know that we are the new kid on the block, but we have a solid vision on how we want to scale Ethereum staking for the emerging markets. One important aspect here is that we are running fully on a DAO. Every decision that the protocol makes is dependent on the DAO voting. Right now, our governance is on Near. We're moving slowly but surely over to Ethereum. We're going to leverage the Near blockchain operating system in order to bring decentralized frontends into that type of governance. But more importantly for us, we're focusing on how much delegation we can distribute. Right now, for example, on Near, we got 130 node operators that we're supporting. Over on Ethereum, we're using SSB networks, and we're using a cluster right now of four operators. And so we're slowly but surely keeping true to our roots, which is the decentralization aspect. How do you make it liquid? How do you get it accessible for folks? And it's going to be a mixture between centralized solutions, custodial services, and decentralization aspects. Now, another important aspect here is like, okay, where does this support come into an emergent market? How do we get this started? The DAO right now is supporting more than 28 projects on Near and Ethereum through different initiatives running by the DAO. So how do we get this started? Like I said before, right? We passed this on through a DAO voting. We're splitting all protocol fees on Near. 50% are going to go to people coming into the DAO, requesting funding for projects, initiatives that are hopefully, knock on wood, going to kickstart the growth of the protocol. The other 50% are for DAO governance participants. And we're distributing not governance tokens. We're distributing the underlying asset, which is a liquid staking token, ST-Near. For Ethereum, we're committing the first 2,000 ETH, 100% of the protocol fees are going to go back to the community. So we're putting our stake where our mouth is, and we're really pushing the boundaries on how a liquid staking token can put community front and center of everything we do. Now, again, like the more resources we have, the more we can distribute. We think that this is a sustainable loop we can create. We need your help to make it. Two crazy guys, one from Argentina, another one from Mexico, cannot do it alone. So it takes a village, and that's why we're here at Staking Summit. And that's why we partnered as well with Gitcoin. So we launched Gitcoin Round 18, I think it was in the summer. We supported 14 projects from Colombia, Argentina, Venezuela, Peru, Chile. We want to scale this. So this is a little bit of the impact from our numbers from the DAO and from the Gitcoin as well. Collaborating with Refi, we believe that that's an important aspect. Education, again, how do we get those 1 billion users? Sorry, it's not going to be too degening and doing this high stakes, high yields, because you need to understand that you're putting people's capital into play, and not everybody is and everybody's risk averse of that, because the small money that they have or capital they have, they cherish that, and we value that as well. We've onboarded more than 100 stakers. We've distributed more than $100,000 in different initiatives to support these projects, and we want to continue to do so. And this is the only way to do it is through a village type of initiatives. Again, all voting on Metapool is done on-chain. Nothing about going to a forum, going to a flame war there. Everything is on-chain. You put your stake where your mouth is, and you put your delegation on where your mouth is as well, and that's active participation in an on-chain governance. So lessons in supporting emerging markets. You need to understand that at the end of the day, where value creation is happening. You need to map that out. You need to understand, okay, here is where I'm participating. Here is where value creation is happening. Enable like new and current users to learn and deliver. Eye on the target always. What are your KPIs? Understand them. I've seen a lot of new projects here, and this is a little bit of the lessons learned that we had to do. Review results in 8 weeks. If nothing's happening, rinse and repeat. No worries. Like that's the name of the game. At the end of the day, you're building trust. Trust takes time. Select your partners wisely. At the end of the day, you're building these relationships and partnerships for the long haul. Some are not going to survive, but the others are going to take you to the next step. Sustainability is a few years ahead. Please be patient. So how do we make this sustainable, right? Yes, we partnered with SSB Networks. We're leveraging their incentives program. We right now have a 7% APY on Ethereum staking. So we're all open up for doors. We're here to talk shop, and we're here to deliver. Also, there's up and coming projects. We believe that stablecoins will be one of the main, I was going to say something related to Tijuana, but I'm not going to say it. But it's the carrot to bring him in. Sorry, not the gateway drug. So anyhow, stablecoins are a very important part of it because people will always be looking for dollars. That's the reality of our markets. That's the reality of our regions. And we believe that this technology, even though it's quite new, shows a lot of potential. And last but not least, we believe in a multi-chain strategy, in a multi-chain world. And that's why we're supporting EVM-compatible chains such as Q Network. We're launching a liquid staking token on their network. They're aligned to our philosophy behind DAOs, behind governance. We want to explore this. This is something that is very close to our hearts because our vision is for everything related to the Metapool DAO to be on-chain. Transparency is key because at the end of the day, you need to understand that even though it's going to be 0.01 ETH, which is the minimum that you can stake on Metapool, that means a day's work for somebody in an emerging market. And so we need to we're taking this into account. We're putting in their needs in order for us to build that trust and to not lose that. That is a big component of what we're going to be building for the next few years. And like I said, we're really interested in talking to every one of you. We have a booth right there. My co-founder is right here if you want to talk shop from the technical side. And more importantly, thank you very much for today and for being bullish on emerging markets. The last opportunities. Hey, the best for last, right? LSTs are the simplest form of savings online for emerging markets, nonstop. A stablecoin will be the driving force of adoption. How would you support it? How will your programs or your projects support them? And this is a little bit of an invitation to all of you, right? I know many of you were saying, okay, this guy, Metapool, where the hell does he come from, right? So there are up-and-coming projects, DeFi projects in a lot of places like Africa, South and Northeast Asia. Look at them. There are big opportunities, low-hanging fruits in order for you and your company's organizations or DAO to grow. More importantly, understand that the first exposure in emerging markets are going to be to a centralized exchange or a fintech application, because that's where people are more used to getting exposed to crypto assets. For example, in Argentina, you have Lemon Cash, right? You have Ripio, who have been there for more than 3 years, and so they're kind of like the gateway to those emerging markets. Peer-to-peer transactions are another key channel where folks get access to crypto. Look into them and study them. Yes, a big one is Binance. Yes, there should be more decentralized options for peer-to-peer transactions. Last but not least, yes, restaking, still out there, worth exploring. Heck yeah, because at the end of the day, you need to understand that these people are looking for those extra yield that they can get out of their assets because it's their hard-earned capital. And now with that, please join us in making emerging markets a big part of crypto through liquid staking. Thank you very much, everybody.
Fantastic talk from Claudio there. We talk a lot about geographic decentralization, but it's also important to remember that people in different parts of the world are looking for different products, different solutions. Of course, here in Turkey, unfortunately, there's also a bit of an inflation issue, to put it lightly. So it's good to see that we're working on something on that front. So now we're going to talk about distributed validators again. We're going to welcome Oshin from Obol to the stage, who is one of the co-founders. So yeah, without further ado, please, Oshin.
This thing on? Sweet. Hello, everyone. Nice to be here. My name is Oshin Kain. I'm CTO and co-founder at Obol, and today I'm going to be talking about distributed validators and to specifically give you a bit of a snapshot of where we're at. So, firstly, I'm going to go into the current state of distributed validators in the market, give you an update on where things are. Then I'm going to talk about how DVs impact different segments of the staking. And I'm going to talk about some new announcements they have to make. So this is a pretty staking native audience. I'm not going to dwell too much on what distributed validators are, but a distributed validator is like an Ethereum validator that runs on multiple machines instead of one. And if one machine fails, no big deal. Server stays online, your validator stays up. The easiest analogy is to consider it like a multisig for a validator. What's particularly important about this is you don't have to have one single entity running all of the nodes. You can instead have a group of operators running nodes. And we'll see as we go on, this is something that's very important to it. Before I get too into the use cases, though, I do want to, if you'll allow me, talk one bit about the technical side of things and how we've built our implementation of distributed validators as a middleware. So why a middleware? A middleware is something that sits between the validator client and the beacon chain. And most importantly, it doesn't have runtime access to your private keys. It's just simply deciding on what every validator should sign and aggregating the signatures that come back. This is important for a number of reasons, security being top of my list. If anything were to happen to our software, it doesn't have your private keys, shouldn't be able to get you slashed, shouldn't be able to do anything except maybe knock you offline. But it also has, your user experience benefits that you don't have to replace your existing private key infrastructure. You can keep your validator, you can keep your Web3 signer, you can keep your vouch, and you can generally just slot this in as one extra container. And as well as that, the networking side of things, each of these clients are hooked up directly to one another with TCP connections, so you have fast latency between them, and your signatures aren't going over a multi-hop public network where people can kind of eyeball them, disrupt them. So as for where we're at in terms of maturity stage, we are just coming to the end of our alpha phase where we've had 40 entities and around 40 solo stakers running on Mainnet with us. We are currently in the process as we speak of deploying the simple DVT module for Lido onto Holski. This will be aiming to almost 5x the operator count within Lido if everything goes to plan. We have spent the last 2 or 3 months at this point running Operation Solo Staker in conjunction with EtherFi. This is getting solo stakers that wouldn't otherwise have the means to run on Mainnet, the ability to run DV clusters with one another and get delegation from EtherFi to take part in protecting the network. We've been doing enterprise testing with the likes of Mega Labs from the Barcelona Supercomputer Center, along with some of our other enterprise partners, where we can prove that this software can scale to 5K validators on Gurley to show that this works on the enterprise side of things as well as on the solo sticker side. We've completed a security assessment with Sigma Prime. On Monday, we're kicking off our second audit with Quantstamp, and we've also done an audit of our Solidity, which I'll talk about later on. So that's a quick update as to where we're at in terms of adoption, and now I want to talk a little bit about the use cases and the benefits as we go through the different parts of the market, because not everyone uses DVs for the same reason. So the first I want to talk about is the professional validator side of things. For a professional validator, one of the main benefits of distributed validators is the idea that they can have high availability. High availability is the fancy way of saying, if one of my servers dies, I don't want my whole validator to go offline. Currently, these enterprises often run like an active node and a passive node, and if the first one dies, they turn on the backup. The problem is that if the primary comes back, you get slashed. And of the 99 slashing incidents so far on the network, almost every single one has been from double signing. So instead of having your full private key in 2 different places and praying they don't run at the same time, with distributed validators, all of the different nodes have a piece of the key, about like a third in a 4-node cluster. And the idea being that if you run 2 copies of this by accident, nothing really goes wrong. Monitoring realizes something is a bit misbehaving, but these clusters are Byzantine fault tolerant. You don't get double signed or double slashed, sorry. As well as this, because of that, you can then start to change your ecosystem and your deployment. You can move to bare metal because you couldn't normally run on bare metal as an enterprise because if your machine died, there was nothing you could do and you were sitting there looking at a dead node. Whereas now you can say, okay, I'll spin up an extra node. If the first one comes back, no problem. This can amount to very significant cost savings for these people, particularly the ones that are running in the cloud and that are struggling with egress costs and vCPU performance. And yeah, they're the main things I want to talk about on the professional side. The other major kind of part of the market is the liquid staking protocols. For a liquid staking protocol, one of the biggest benefits of distributed validators is the idea that different entities can run pieces of the validator. You no longer have to give the full validator private key to one entity and cross your fingers and pray they don't lose it. This is super important for the LSPs that want to become very decentralized, for bringing in, more solo stakers and bringing in people with kind of low collateral. You can have much more peace of mind that so long as there's a group of them running and they don't all collude against your protocol, they can't withhold from you, they can't all get, well, if they all lose their keys, you have a risk of slashing, but so long as, only a subset of them do, not the end of the world. And generally speaking, this is how we see the decentralized liquid staking protocols moving forward, getting groups of people to run validators instead of individuals. I've already talked about it, but Lido is one of the main ones. They're looking to bring 0.5% of their stake onto DVs on Mainnet early in the next year. A new set of the market that is hopefully something that I would like to see grow over the next few years is the idea of community validators. There are lots of communities within the Ethereum ecosystem, from different parts of the world. Latin America has a super strong community. Shi-Fi is a group of women in crypto. All of these entities have an interest in staking. The vast majority of them don't have, the 32 Ether to stake alone, or even if their DAO has a significant treasury, they can't really just give it to one operator or one member to run it on their behalf. However, with distributed validators, they can set up a cluster amongst their own community, and they can either seek delegation or they can delegate their own Ether to them, and they can keep the rewards within their community, and they can generally grow the pie for themselves and to build a place where they can make the revenue from running validators. As Ethereum needs to decentralize, we don't want a world where the Nakamoto coefficient is 3 or 4 or 5. We want a world where there's hundreds of these entities that are their own small little pools, running their own Ether, controlling their own destiny. This is where I hope the community side of Ethereum goes, where people just stake their own Ether on their own nodes in groups. On the token holder front, this is the idea that if you're trying to hold an LST, you want to be pretty sure that it's going to behave. You can sleep better at night knowing that there's a group of people running the validator rather than if you have one specific operator running your LST. I don't know about you, but I wouldn't be as comfortable as that, but that might be because I would have built a validator project before. But last but not least, I want to talk about Ethereum more broadly. So Ethereum itself needs its operator set to be decentralized. It needs the validators to be resilient from client bugs. We have only about 5 clients at the moment, and every now and again something goes wrong. That's just kind of the way it is. If you have a distributed validator cluster where you have different clients in every single node, if there is a failure of one, you shouldn't go offline. This actually happened earlier in the year when Ethereum lost its finality. None of the distributed validators we had in Mainnet missed a single attestation because they weren't overly exposed to the clients that had the issue. Ethereum wants to decentralize. It wants groups running validators. It wants not to be controlled by one single protocol. So Ethereum benefits from the idea that groups run validators rather than individuals. So that's a little bit about some of the use cases. And now I'm delighted to be able to talk to you a little bit about our journey. I've been worrying about Ethereum proof of stake since about 2018 when I kind of got to grips with the energy use of proof of work and then started to look into the alternative. We've been working together formally as OBOL since early 2021. We deployed our first mainnet validator at the end of 2022. We announced alpha in the middle of this year. And as of today, I'm super thrilled to announce we're now in open permissionless beta for anyone to run coming on the 1st of December. This is the first time we're going to allow generally anyone to run one validator if they so choose and are willing to give it a run and to really kind of grow the amount of people running this software. And more specifically than that, the focus in beta is less about running just one DV, and the focus of alpha was to get people testing and prod, frankly. And with beta, we now have 2 new tools that we're releasing, and we're going to really focus on developers, particularly of liquid staking protocols and any sort of staking project. And those 2 pieces are the SDK and OBOL splits. The DV Launchpad, to touch on it briefly, this is our user interface for creating distributed validators. We've taken the approach that you need to know your counterparty in a DV because you're placing a lot of trust in them to work with you. So this is now going to be available for the public for anyone to use capped at 1 validator. And then the OBOL SDK is a TypeScript SDK to allow people to provision DVs programmatically behind the UI. So if you're building a staking project, you want to bring DVs in, you'll just use this SDK to propose a cluster. All the operators will create the keys to the kind of spec that you've asked for, to your withdrawal address, to whatever you need, and they will return the deposit status to you, and then your front end can can deposit with the 32 Ether to activate those validators. Coupled with the SDK is something that I'm also very happy with and something that I think is novel in the space, which is our smart contract splitters we know as O-ball splits. O-ball splits are immutable, non-custodial, and novel to everything else is Oracle-free. Most staking projects today have this kind of dirty little secret of depending on an Oracle to tell them how much Ether's in them. There's even been situations where there's like keys on this Oracle being compromised, and if enough of the keys get compromised, you have an infinite mint bug. This is something I was, not willing to settle on, and have been since about 2020 trying to design something that was permissionless and immutable and Oracle-free. And thanks to the help of the splits.org team, I'm happy to say we have something working. It is entirely pull-based and allows you and your cluster to divide your rewards and principal and fees all programmatically and all pull-only. So I would advise anyone that's into the Solidity side, give them a look, give them a test, and let me know how you get on with them. And last but not least, we have Charon, our software client. We're moving into beta. We're getting a second audit for it, and it's been behaving better than I could possibly have hoped. So I'm thrilled with that. So I'm coming up to the end. I want to conclude with the idea that staking doesn't have to be run by individuals, particularly in a world where you're kind of delegating stake to others. I'm a firm believer that validators should be run by groups, because I think groups are harder to compromise than individuals. If there's a scenario where it's like, oh, defect, do something weird with this validator, censor this person, if you have to kind of coordinate with your full group of 6 other operators to be like, hey, we should do this sketchy thing, it's a lot harder of a sell than to do it if you have total control. And even when it comes to private key loss, people lose private keys, people get key loggers, it happens to so many people in the ecosystem. You do not want your validator to become slashed and compromised because somebody clicked on a dodgy PDF or got a dodgy MetaMask extension. So I hope over the next year we move in a world where validators are run by groups, and this idea has more been popularized by the bankless crew is squad staking. I'm hoping that people will find their squads, people will set up validators, we'll have smaller groups of people all working together, running validators, making kind of a cut of the reward for it, and that Ethereum is run by groups, not individuals. That's more or less everything for me. I don't think we're actually doing any questions, so I'd like to thank you all for your time. And if you want to find anything, we'll be outside in the main hall. You can come chat to us. Thank you very much, everybody.
Some chairs on the stage. You know what that means. We got a panel coming up. So we're going to talk a little bit about institutional capital. Is anyone here from institutional providers or kind of bigger companies in the audience? All right, well, one thing's for sure is the market is pumping on the back of the ETF news, so institutional topics are definitely important. So yeah, I'm gonna just introduce Ashwan, who's the moderator. He'll introduce the panelists. He's from Protocol Labs. You might recognize that name due to projects like Filecoin, et cetera. So yeah, please, let's have a warm welcome to our panelists.
think this is on. Hello, everyone. It's super great to be here with you all today at the Staking Summit. A big thank you to Staking Rewards for having us. My name is Ashwan Samuel. I work at Protocol Labs, and specifically, I work on Filecoin DeFi. You might be thinking in your head, like, Filecoin, like the storage network has DeFi? It does, and it has been growing incredibly quickly, although it is an emerging ecosystem. And so I have a very unique opportunity today to be joined by some experts on this panel, where I'm going to be in your shoes as well. I am an audience member just as much as I am a moderator today, learning about how to grow a DeFi ecosystem, specifically from the institutional perspective. So with that, would love to get to know our panelists a little bit more. So 3 questions for you all. Who are you? What organization are you part of? And can you tell us a little bit more about your first experience with DeFi or liquid staking? David, take it away.
Thank you. My name is David Walsh. I'm the sales lead at Alluvial. I joined Alluvial around 2.5 months ago. Prior to that, I was at StakingRewards.com, the company that's hosting the event today. So I've been in the staking space for around 3 years now. Joined Liquid Collective and Alluvial around 2 months ago, as I said. Really focusing on servicing the needs and of enterprises, institutions that have strong kind of compliance and regulatory security needs. So I guess from when I got into DeFi, I learned about Bitcoin in 2015. Slowly but surely kind of started going down the rabbit hole, and then by 2021 I was fully in, working with Staking Rewards.
Great, thanks David, thanks for joining. Marin?
Hi, I'm Marin, Master of Protocol Relations, contributing to Lido DAO. My experience predominantly comes from startups and advising unicorn company for investing into startups. So my approach to institutional capital was from VC side. Started helping myself, and that's what brought me to this type of role, which also includes DeFi, which is an awesome part of cryptoverse. Essentially, Lido protocol is institutional grade liquid staking, but I like to highlight that it's staking for everyone. So it's not only for institutions, but everyone at any point of time can interact with the protocol. Additionally, I would like to make a distinction between the protocol itself, which is a middleware on Ethereum blockchain, has a purpose of connecting the users with their ETH and delegating it to the node operators and their validators without interaction with the asset itself. So at no point in time, the protocol has custody of ETH or ST ETH. My first interaction with DeFi, I guess at the time when Atland was pitched, or IDEX was the place to go to make a P2P swap. I actually originate from the age where everyone complained about UX, which is so much worse than this current UX everyone is complaining about. So,
good to know you've been around the block for a while. Awesome. And Mohawk, go for it.
Hi. Hi, I'm Mohawk Agarwal. I'm the founder of ClayStack, which is a multi-chain liquid staking protocol with primary focus on Ethereum. My background is in computer science and finance. Prior to ClayStack, I was running Wolfedge Capital, which initially started as a Web3 fund, then transformed into a staking as a service company with around $200 million assets under delegations. I always saw, because I was so exposed to staking, I always saw illiquidity or inflexibility as biggest barrier in staking. And that's what led me to start ClayStack to solve liquid staking. My first interaction with DeFi in the last bear market, when Ethereum was trading at very low prices, I just wanted to invest in more startups. And I did not want to sell my Ethereum. So I started using MakerDAO a lot to mint DAI at that time to be able to kind of mint or get my Ethereum back later on. And then obviously rode the whole kind of yield farming and all those waves.
Got it. Got it. Well, as you can see, we've got a pretty diverse panel up here with a wide variety of experiences. And so, Mohawk, I want to start with you. I think in order to understand how to attract institutional capital we've got to go back to the beginning. So what were some of the first groups, or who was interested in liquid staking right out of the gate, initially?
In the beginning, it was mostly retail audience because people do want like flexibility in their life. When they saw staking, they were like, if I stake my assets today, in order to get them back, I have to wait for unbonding periods. And that created disincentive at the first place to stake. So the biggest promise in the initial days of liquid staking was just flexibility. And then as we grew, then more use cases came around, which was like primarily around using these assets and DeFi to earn more yields. But I think just the flexibility to get your principal at any time back was the biggest one in the beginning.
Got it. And so we now have one side of the coin where it's about the users who are interested in staking. But Maren, talk to me a little bit more about the narratives for the ecosystem on that side. Why is staking so vital for ecosystems?
It has multiple angles. So as just explained, it started from retail, and it's important. It's a public DeFi primitive, right? It's the source of rewards where everything is based. But most importantly, it goes back to the actual consensus, to the blockchain itself, how it's shaped and how the blocks are closed. It's securing the network. So we do name it staking, but it's not traditional staking, which would relate to giving your funds to the bank, and then they give you an interest for that, meanwhile consuming third-party products. No, here you actually delegate your assets, and in return, your rewards are block closure rewards or validator emissions. Where institutional side comes in here, it's a very specific and spotlighted niche. It resembles fixed income product, right? So what's important for institutions is to have this predictability. So we know the emissions, and we can predict, even on Ethereum, depending how much stake comes in, what would be the future rewards. Similarly with other blockchains, they literally write out emissions years in advance. So when you are an institution and you want to have that security and to remove the risk from the actual income, right? Especially if you are long on the specific asset, right? You expect the rise in value in future.
Right.
It reduces the risk significantly.
Right, right. And so I think what both of you are kind of hitting at is initially a lot of the adopters of liquid staking or DeFi protocols are on that retail side, and that's something that we've seen in Filecoin as well, where in the past 6 months we've seen 130 million USD in TVL, which is very exciting. But we want to try to shift that to institutional. And so, David, was wondering when you help me understand and the audience understand, when does that shift happen from the retail to the institutional side? What factors need to exist?
Yeah, so like when I joined Staking Rewards, that was 2021. There was obviously a lot of retail interest, but I think even at that point, there was quite a bit of institutional interest too. More on the crypto native side for sure, but like even the likes of Bloomberg, multiple different funds were using our staking API to get for their own research, for their own investments. But I think really Schmiedl and the merge in general has definitely kind of accelerated a lot of institutional interest in the space. I think, like, you look at today, like BlackRock filed for the spot ETF yesterday, 3iQ went live with a staked ETH ETF in Canada last month, and I think this is a trend that's just going to keep continuing and growing. So it's been slowly but surely, and then takes off pretty quickly. So I think we're here. Institutional adoptions are in the corner, and yeah, positioning ourselves to be at the right place at the right time.
Definitely. And so you mentioned a couple of exciting names there. Oh yeah, go for it.
I actually have a bit different take on the ETF family. I mean, everyone is not going to like it, but I feel like any institution who really want to invest in crypto can still do it. Like even if they cannot hold crypto in their books, like they can create SPVs in multiple ways. I feel like ETF will definitely solve like retail audience very, very heavily. Like right now, if any retail audience wants to buy crypto, it's so difficult. They have to go to an exchange to KYC. I mean, KYC is fine, but deposit their money, then get those assets out, store private key of MetaMask. always be concerned that it's not going to get hacked, versus being able to buy Bitcoin or Ethereum directly from your favorite stockbroker and just like being relieved that it will never be able to, or no one can transfer it or can hack it, I think is a huge probably step towards bringing retail interest more via ETF than institutional.
Interesting. So yeah, maybe some of this news might be both retail and institutional, but I think that's a very fair point. So getting back to the institutional side of things here, when you mentioned a couple of pretty big names that are getting into this, but what are some of the characteristics of institutional investors? You know, there are subsegments that are likely going to be more involved in DeFi or liquid staking. What are some of those characteristics?
Yeah, so I guess you have a number of different institutions, right? So you have the asset managers, both on the traditional finance side, like the VanEck, the Fidelities of the world. You have the crypto native side, the Galaxies, CoinShares, and a couple more. Then you have the family offices, hedge funds. You have banks that are getting involved, especially like different regulations, right? But in APAC and EMEA, definitely banks are getting involved. You have endowment funds. And yeah, I think the whole space is definitely growing. I think everyone has a little bit of interest. I think a lot of enterprises are potentially looking at diversifying their treasuries as well, DAOs. So yeah, I think the whole industry is definitely growing and at least looking into the opportunity, if not taking advantage already.
Yeah, Marin, I want to give you an opportunity to double tap into that. Are there any of those segments that David mentioned, that are particularly interested in using Lido, or you've seen an uptick in the last couple of months?
So it's a pretty broad division, right? So I would add also infrastructure there as well. You can see emerging number of projects, protocols, and enterprises actually building institutional infrastructure. I would say it really depends on the type of the institution, as previously mentioned, because based on the type, jurisdiction, where they belong, risk tolerance, know-how, what we are facing here is they want to interact, but some of them, more traditional ones, so to speak, don't have the know-how. So they are depending on ETPs, ETNs, ETFs. What we need to push here is to have staked asset, ETPs, ETNs, and ETFs, because staked asset is more evolved asset. So as you mentioned, there are means, some of them can't stake, right, for previous mentioned reasons, but they can always acquire the asset. So there are multiple models how we can enable them. And so to answer you directly, majority of institutional types already today interact with staked Ethereum, Lido staked Ethereum. I would say they interact with other projects as well. I'm not saying we are exclusive at this, but being the largest one out there, only battle-tested solution where the protocol itself handled over $1 billion of withdrawals, tick-boxed deep security analysis, right? And number of audits, it all has meaning into this. What we are changing here is the face of the whole industry. Previously, we were known more as DeFi degens, so to speak, right? Now, the talks are to put faces to those nicknames on Telegram, to go more traditional, to emails, to Slack, to enterprises, to go back to the traditional way and actually onboard them, involve them more. So it brings down hand-holding a lot. Yeah, so industry is changing in this direction.
Yeah, that's funny. I might be the only person in this room who prefers email over Telegram, so I'm aligned with that.
There with you.
Well, that's great. Well, and so I think you hit on a lot of points in Mohawk. I want to follow up with you in 1 second about some of the points that you made. But David, do you think that institutional investors care about the narrative, or do you think they really only care like the narrative of an ecosystem or the utility that something is providing, or is it truly just some of the aspects that Marin mentioned?
They definitely care about the narrative. I think from my discussions, like a couple of the ones that they're definitely thinking about is around regulation, compliance, and security. So they're the three. In terms of the regulatory side of things, America and the US in general is still a little bit slow on that side. I think it will come eventually. Shout out to Evan Weiss, who is the head of business at Alluvial, and he's the leader of POSA. They were in DC last week talking with the SEC, talking to them a little bit about staking, traditional staking, but also liquid staking. So doing great work on that side. I think as well on the compliance side, a lot of the asset managers and offices that we've talked to, they do require some level of KYC, AML to be done, like in terms of having a clean pool of ETH. And then also on the security side, so like who are the node operators, what audits have been conducted, is there SOC 2 compliance? Yeah, there's quite a bit to it. But when you're talking about institutions, they're the kind of three that I see, and then of course liquidity.
Yeah, and Mohawk, I want to ask you specifically about the security piece. What are some of the most important features that a liquid staking service needs to have from a security perspective in order to work for institutional capital?
I feel liquid staking primarily has 3 risks. One is the smart contract risk, which exists across all DeFi. Second is the price risk, that if the asset that you are liquid staking, if the asset price goes down by 10%, you probably lost like 3 years worth of yield. And third is the slashing risk. If the validator goes down or double signing, then you are losing principal itself. If you are able to hedge all these 3 risks and build a structured yield product that we eventually want to build, then you are looking at like pension funds, endowments, big capital, because right now, yes, US Treasury bill yields are very high, but that's not going to be the case for long term. And institutions know that. And they're looking for something where eventually they can bring hundreds of billions of liquidity with a stable yield. And all these 3 risks actually can be hedged today as well. But today the problem is it's not cost effective. It's very difficult to hedge price risk, for example, cost effective manner. Smart contract risk, the premium that most of the insurance are underwriting is again like way high. They're only able to underwrite the part of the pool risk, not the full AUM. So, but in a few years, this will change. And then you are looking at like attracting hundreds of billions of capital.
Yeah, and I'll give you an opportunity to expand here. Specifically, how does ClayStack solve some of these security risks for those who are interested in using the platform?
So one of the things is, for example, for institutions, they look for KYC at every point, but at the same time, you're looking, they want censorship resistance. And it's hard to find that balance. So what ClayStack does is, we have a modular DVT-based architecture, which is distributed validator technology, where none of the nodes are being run by single operator or single validator. It's being run by a cluster of operators, where if one goes down, then the other can take over. If one tries to censor one transaction, the other will not censor the same transaction. If one tries to mistakenly or knowingly do any malicious transaction, others will not agree to it. So that creates kind of an architecture which is secure, scalable, and somewhat decentralized.
Got it. Yeah, and Marin, I want to flip to you on kind of functionality and scalability, right? These are themes that we've heard all throughout today. Attracting institutional investors is on everyone's roadmap, but it needs to be easy for them to use, and it also needs to scale to more institutional investors. So, Marin, how do you find that balance between those 2 factors?
It's actually hard part of the balance to find, but it circles back a bit to these questions previously asked. And they both highlighted, which is interesting to me, because how different staking services or staking providers are positioning themselves differently in the ecosystem. So for example, from my perspective, when I go to the bank and bank KYCs me and my capital, I don't need to know KYC, KYB of their service provider, right? So where Lido is positioned is in the middle, same as that service provider. You don't expect your bank to run your validators or staking services. They use external providers, right? So you need to be satisfying all those boxes that we just discussed, and then to bring that balance of interaction, ease of integration, and then the most important part that brings power to the liquid stake tokens there is the liquidity, right? What institutions need is a fast way out. If you don't have enough liquidity to satisfy the demand in case of black swan events, you will never scale. And then we get to the chicken egg problem, essentially, because liquidity is not easy to get, especially if you're going to the direction where liquidity needs to be fully KYC. Right? Now we are talking about the different approaches to market, and what I want to highlight first, there are no specific regulations today that regulate this, so everything is compliant. There's no regulation that says either of the protocol is or is not compliant, so we are all wild guessing. So we are taking different go-to-market strategies, different regulatory strategies, and we are giving a best bet, right? But then back to the capital. Essentially, if you have it free-floating, the asset is free-floating in DeFi, specifically now talking for Ethereum, it's really, really hard to control those aspects, like who interacts with the asset. So the logic would be if you control the on-ramp and off-ramp, plus you know where the emissions come from, it's super simple. Right. If you go deep into rabbit hole, then it becomes super complicated, and it's never going to be institutional grade, right? They don't need complications.
Right. So a follow-up question for you there then, do you think it's easier for institutions to just purchase a staked asset off an exchange, or do you think they should actually go through the whole process of staking with the provider?
If you're talking about a bank, definitely. Yeah. Like for their customers, it's much simpler for them to just swap. If you're talking about capital allocators, portion of them already interacts with vanilla DeFi. Right. For them, it's cheaper, right? More capital efficient to do it themselves because they have the know-how. They have the security part solved because they either use qualified custodians, which have native integrations, or they use hardware and software that's good enough for them. So it all comes to what type of institutions are you targeting to service. Where I sit or stand, I don't think all the protocols will be able to serve all the type of institutions. It's impossible.
So you're very much aligned with go after a specialized segment, or go after one segment, build a specialized product that fits both the flexibility and scalability for that specific segment, and do that until you're able to kind of expand to other.
Essentially, more segments you cover, more successful you will be.
Yeah, that makes a lot of sense. Well, I want to do a quick kind of round robin here in our last five to 6 minutes of, I want to understand, what are the most important tooling or features of a liquid staking platform that must exist in order for institutions to adopt these platforms. So David, we could start with you.
Yeah, so we have an API-first approach. So we have all the APIs. We work with integrators. We have reward reporting APIs as well for them to be able to calculate the rewards, obviously, for their end users. We do have the compliance piece in place. So we work with a third party called Exeter, who was recently acquired by Capgemini. They review the KYC and AML policies of the integrator. So it's not each individual going through the process. They kind of go through with like Coinbase, Bitcoin Swiss, for example. And then obviously I think the liquidity is like a key major part. So making sure that you're working with market makers, OTC desks, and making sure that institutional capital can get out, much to your point.
Got it. And just following up on the first point you made in terms of pulling out all that data, what are some of the most important metrics that matter to institutional investors?
Yeah, I think everything around consensus layer, execution layer, rewards, I think the more granular you can get, the better. And I think we're still early days, but I think that's probably key of where everyone's looking at right now.
Got it. Same question to you, Marin. In terms of tooling or features that a service must provide, what are the most essential for institutions?
From our aspect and all the interactions we had so far, access to liquidity, so infrastructure access points. Yeah. It's what makes the difference.
Got it. Can you give me just a couple of examples of those access points?
So you can put it like even traditional stock exchanges, more familiar to us here, crypto exchanges, OTC desks. It all needs to fall in place to be simple for institutions to execute in their familiar environment.
Got it. So for any service providers that are building liquid staking solutions, you would recommend that they go and work with all these different access points and set that up for their eventual customers or
exactly.
users.
Like the whole logic behind it, when you deploy software on Ethereum, it's there forever. Like, you don't need random front end to access it. If you have enough access points and it becomes a public good, you achieve the ultimate goal of decentralizing Ethereum, creating an asset that everyone can interact with, retail, institutions. It's as safe as it gets. You can never say something is safe and secure. I mean, let's go back to the merge. Like, why everything skyrocketed after the merge? Because now we can breathe. You never know if the upgrade will succeed, right? So there's always that type of risk involved.
Got it. Makes sense. And Mohawk, same question for you.
I think David and Maren has already added good points. One of the points that I would make is for institutions, like if they just wanted to earn any staking yield, they would do regular staking. It's much cheaper, as Maren said, like they already have a technical know-how, they can afford to have a technology team. The reason they go to liquid staking is because of the same reason that retail came in, which is leverage on those assets. So, and the beauty about institutional liquid staking is that in terms of traditional or retail liquid staking, like different protocols have different ecosystems. But here, everyone is like at square one yet. So once, I think, like you are able to use those assets across DeFi, which is again like institutional DeFi. You are able to leverage those assets. I think that would be like something more enticing for institutions.
Got it. Makes a ton of sense.
One thing that kind of just crossed my mind, which is a phenomenon for this industry. Like, you see institutional DeFi, but it overlaps with retail DeFi. So it's very, very unique.
Right, right. And do you think it's important that those are separated down the line from a framing perspective or from an actual service provider perspective?
I don't have a crystal ball, so it depends on the regulators and compliance, right? But we might see a future where it remains together.
Yeah, got it, got it. So going back to, I know I've been talking a lot about Filecoin because it's near and dear to my heart. But as an emerging ecosystem in DeFi, here's where we're at. We're number 25 ranked protocol in TBL across all of Web3. We've seen a lot of growth. What are the biggest pieces of advice that you'd have for someone like me or the Filecoin ecosystem service providers building in this world? David, we can start with you.
I think having a clear node operator strategy, kind of a growth strategy is key. I also think thinking a little bit and working with regulators, like trying to get a feel and understanding of what the industry could potentially look like in the medium to long term, and really building around that for like a long-term sustainable, ecosystem in general. So that's what I would say.
Perfect. Maren?
My advice would be more to a protocol level, to always think long-term, go for simple tokenomics, right? And think sustainable. Each cycle, something new is trendy now. Previous panels you could hear about airdrops, and it's what drives engagement, draw engagement during this bear market, but it's not something sustainable, right? So you need to think about business models and how do you plan to make your revenue of the protocol consistent and long-term. You can't even rely long-term on VC funding, right? If you don't have the numbers, you will not have the funding.
Yeah.
So sustainability and ultimately for the ecosystem composability. So that would be extremely high important to have the backing of the foundation, to do the connections between the protocols, to think ahead, to make products that work together in unison compared to cycles that Ethereum had to go through, where everyone was testing in production and deploying various types of dApps for itself, and then years after started to combine them and do the products jointly.
Right. The good thing is the playbook has almost already been written.
Yeah.
Yeah, Mohawk, to you.
Yeah, one of the things I would say is in DeFi, decentralization and scalability does not go hand in hand. So it's very easy to build a protocol which is very scalable and probably centralized. And that's one piece which is very, very difficult to fix later when you grow a lot. So, and decentralization, obviously it's a journey. It's not like it doesn't happen on day one, but have that in your roadmap from the beginning itself. Like think about it that it needs to be decentralized someday. So versus making like a completely centralized architecture in the beginning, then it becomes impossible to decentralize at some point.
Right, right. Well, thank you all for your time, Mohawk, Marin, and David.
Thank you.
We just ran out of time, but thank you all so much for listening. Really a big thank you as well to Staking Rewards for putting on an amazing event this year. And if you want to learn more about Filecoin DeFi, you can check out an event we have at the Swiss Hotel on Wednesday, November 15th. We'll have a couple of teams there that are building DeFi solutions. You can learn a lot more about them. Find me, I'll be in the back of this room today. But thank you again to all of our panelists. Thank you to Staking Rewards, and we'll see you next time.
Chairs are staying on stage. We've got another panel coming up, also on liquid staking, with a couple different liquid staking providers, including one from Polygon, if anyone's interested in Polygon. Yeah, get settled. There's plenty of empty seats up here at the front, if anyone's kind of curious about what's going on here. So yeah, I'm going to let Joseph from EtherFi introduce the panelists. So let's please give a warm welcome to all of our panelists.
Good to go? Test? Yeah.
Blah. Hello.
Hey everyone, very glad to have you with us today as we go through the liquid staking ecosystem, looking at where we are right now, assessing how far we've come with this, and then giving some insight into what we can expect for 2024, some innovations, some challenges, and what we can see for the ecosystem to evolve. To kick it off, I'll give an intro of myself before I introduce my team members. Joseph Vogel, I'm with EtherFi, which is a non-custodial liquid staking protocol on the Ethereum network and soon to be a natively restaked protocol, which I think we'll kind of touch on today as well with restaking more broadly. Before that, I was with the Aave companies. So I'll pass it off to my fellow panelists to give themselves a quick intro.
Hello everyone, I'm Christian. I'm growth manager for Bifrost Finance. Bifrost Finance is a liquid staking protocol built and secured on Polkadot, Kusama, but we are also active on other ecosystems such as Ethereum and Filecoin and much more.
Hi everyone, my name is Nico. I'm the CTO at Tenderize. We build validator-specific liquid staking for Polygon, the Graph, and LivePeer at the moment, and ETH coming in 2024. And before that, I was an engineer at LivePeer for a few years.
Hi everyone, my name is Jason. I'm the CTO and co-founder at Puffer Finance. So we're doing Ethereum liquid staking with deep eigenlayer integrations.
Cool, thanks guys. So we're all, I guess, have a different approach to liquid staking. I think it's quite important, maybe just initially, we can kind of set the stage as to how the liquid staking market has evolved, how our protocols kind of fit within that structure. So maybe pass it off here.
Sure thing. Well, I believe that over 2023, liquid staking had a massive and I would say even unexpected growth on a certain side. Like it was one of the few DeFi topic that was like on top of the wave for so many months. Actually on Polkadot, we saw an increase of interest of retail users into the product that was like really stunned us. I can tell you that, for example, we had like this massive increase of interest over the last summer, and it was like due to this fact that we keep pushed like proposing more and more use cases for liquid staking token, because we do really believe it has like a lot of advantages, and it kind of like amazed us, this amount of interest despite the market that wasn't like big at its heights over the last year. So we are pretty happy with it.
I think fundamentally, if we look at the design level of liquid staking, it hasn't changed that much over the past few months or the past year. What has changed a lot is indeed the visibility and the heated discussions we've had over the recent months, for better or for worse. I think there were definitely some good points made in those, and that can drive the space forward in the year to come. But fundamentally, I think we haven't seen a lot of change except for integrations for existing protocols. That has slightly increased. We've had restaking with Eigenlayer. But yeah, I think we need to also update the liquid staking designs a little bit going forward.
Awesome. I think from the Ethereum point of view, it's been a pretty crazy year. I guess like Marin had mentioned in the last panel, like post-merge, I think there's a lot, more room for people to breathe, knowing that we made this transition. And that really led to a lot more protocols emerging, like liquid staking protocols on the Ethereum side. And then post-Shapella, especially once we got withdrawals, that really allows for more and more diversity, allows for more liquidity to flow between these protocols. And we've kind of seen a lot of these narratives coming to play, a lot around DVT, anti-slashers, and now Eigenlayer restaking being another large topic, going into 2024.
Yeah, I think you mentioned DVT, and we've seen a lot of good presentations today on distributed validator sets. I would say that's been a really good evolution within the staking market. I think we've seen a lot of adoption there, and we've seen that tech come a very long way from, I guess, just even looking at the beginning of this year, where it was just almost a proof of concept, to now we're actually proposing mainnet blocks using DVT technology. So it's good to see that, and it's good to see also, I guess, the DeFi ecosystem that is built around these liquid staking protocols. I think there's a lot of new protocols that have come forward that now allow a lot more utility with staking tokens. So I think that's another really interesting thing that we've seen a lot of growth with. Just as everyone starts to build in the bear market, it was a really good product to really solidify. So, go ahead.
No. I just wanted to mention that utility is really the key word in this sense, because as Nico was mentioned before, there wasn't any kind of massive change in the product itself, but the visibility came with an increase of utility of these liquid staking tokens. Because maybe 1 year ago, what can you do with your liquid stake token was just maybe using within the protocol, or maybe with some kind of other partner protocol through some bridge or something like that. The increase of attention in the product really is also the possibility to come up with partnership, increasing use cases of these tokens, increasing the interoperability, the possibility of users, and end of the day, this is something that really drives adoption in the long term.
Yeah, you've seen some really good products built out of that too, just by extracting yield or whatever you can do with these different products. So I guess if we look now at liquid staking protocols, looking ahead within the next couple of months, what are a few of the major milestones that we're looking to achieve? What are some of the major challenges that are there right now that we hope to achieve and succeed in addressing over these next, I guess, short-term timeline?
Yeah, sure, I can take that.
Yeah, go ahead.
So yeah, I think really one of the major milestones we want to see as an industry is sort of a movement towards decentralization, to have a healthy dose of competitive liquid staking protocols as we move into the long term. And I think there's kind of a handful of technical issues in getting there, and one of them, the main one, would be how do we improve the sort of viability and profitability of nodes, like validators, especially ones running at home that don't have as much capital to spend. So capital efficiency being one of the major issues. And I think things like DVT are ways to allow people to reduce the bond requirements, split it up multiple ways. At Puffer, we're introducing anti-slashing hardware as a way to reduce the bond without requiring you to cooperate with other nodes. And there's again, the Eigenlayer narrative of now there being additional forms of yield to supplement the income of these validators, and these all being different ways to increase their profitability and increase their profit margins. And I think teams that are tackling that are necessary for us to keep some semblance of decentralization within the validator set.
Yeah, good points about profitability for home stakers. That's definitely an important one. I think for me, my opinion is that the biggest milestones we can achieve are credible neutrality and decentralization, as you also mentioned. The question we get a lot from validators today or node operators on networks other than ETH is, can we use liquid staking ourselves, or can our clients use this? And the answer up until today has been no. Despite these people being probably one of the most important stakeholders of these networks, being the ones that operate them, they are not able to participate. And I think if we want to drive liquid staking forward as an industry, those user groups definitely need to be included in liquid staking as well.
Yeah, and on top of like the technical topics brought up by my colleague, I do believe that on my end, like working for a Polkadot parachain, the milestone we are trying to achieve, we already started to work on that, was like to kind of lower the threshold for user. Either they are like retail users, investor, like so different kind of like approaches to the market, is to lower the threshold to access this product, like liquid staking product, trying to make sort of one-click dApp in order to make the experience effortless, because end of the day, as I do believe, like being a growth marketer, a growth manager, it's important to have like a great product which works, but it's also important that this product can reach people in a seamless and effortless way. Otherwise, when like you lack the adoption, and I'm not talking about mass adoption, I'm talking about like crypto professionals and people in the ecosystem adoption, then you have a problem. So this is something that we put it there as a goal for the next year, to make this whole experience with Bifrost easier, more secure if possible, and even more accessible to everyone, basically.
Yeah, I think more user adoption and making it a very seamless transition is always important. I guess, Nico, you mentioned bringing on all these different users. I guess how do we approach that? Or yeah, what's the solution or potential solution to that challenge?
Yeah, so I think we're tackling that in our own way, which is building validator-specific liquid stake tokens. So if any validator on, let's say, Polygon can have its own liquid stake token for itself and its delegators, very similar to how staking actually worked before liquid staking ever came around. Like, if you wanted to stake on Polygon or other networks, you would select a validator of your choice, you would vet the list, you would check for APY or reliability, whatever characteristics are important to you, and then you would stake your Matic to that specific node. And I feel like liquid staking has kind of lost that along the way, and that's what we are trying to bring back, is that native experience.
Yeah, and I think I guess that's what a lot of the different technology that's building that foundational layer is going to help us achieve. But I'm finding it is quite difficult. I guess there's a lot of issues along that path. Like I guess it is the path of most resistance, if I had to put it that way, but it's a path that we need to take for decentralization to move forward. But as far as latency goes, internet speed for home node stakers, it can be very difficult to rival what the counterparty basically does if we look at what AWS servers are or any of the centralized structures that are running these data nodes. So I think, I guess, Jason, if maybe you have some input on how you see the home node or staker community trying to evolve.
Yeah, so actually one of the new pieces of research we just put out at Puffer on ETH Research the other day is what we're calling smoothing commitments. So it's kind of a reframing of how people are doing bonds for their validators. So of course, Puffer is permissionless, so we're requiring you to put down a bond to run a validator, similar to EtherFi, Rocket Pool, etc. But the difference here is actually it changes the incentives if you're having the validators actually pay a fee up front for the close to the expected value of what they're going to be making over the course of a certain duration. And what this allows you to do is actually decouple the performance of your validators from the actual LST rewards. And so like a mechanism like this would allow for home stakers that may not be performing quite as well as like professional node operator to like join the protocol without like fear of being ejected for like underperforming.
Oh, sorry. I was going to say, actually, I think the project I used to work on, LivePeer, is an interesting case study here, despite not being ETH, but it has a network with a lot of home node operators. There are very little Figments, block daemons, or whatever on that network. Because of the fact that these home stakers or indie operators, like myself am on the network, on the LivePeer network, they were able to build services and add value that these professional operators weren't able to do because they move a little bit slower, they have more overhead that they need to take care of. And what you actually saw was that these home operators with their value-added services are now the majority of the node operators on the LivePeer network and have actually competed out the professional node operators that didn't really care too deeply about running the necessary infrastructure like GPUs. So I think for that, I think the same applies to Ethereum home stakers. Move fast, break things, and add value, and you can receive a lot of contributions from the community in that way as well, in terms of stake.
Yeah, we actually, just recollecting what Nico just mentioned, on Bifrost, it's been up since a while now. We have this, it's called node collator screening. And basically, it is an algorithm that constantly check on the performance, on the efficiency of those validators, kind of like making them compete to each other within the Polkadot ecosystem in order to reallocate on a daily basis funds from users that invest with Bifrost, because as always, like being a decentralized company, we do not own any kind of token. We just redirect the liquid staking directly into validators. And basically, based on their performance, the tokens, the amount of tokens is reallocated on a daily basis in order to allow users to have the best performance out there. And on a user perspective, we actually try to make this very intuitive, I would say, very easy to use. We actually just came up with a new palette, because if some of you is not familiar with the Polkadot ecosystem, a palette is basically a smart contract which runs behind the curtains, let's say. And with this, it's called SLPX, which is a palette that is a cross-chain asynchronous interoperability palette. Basically gives the possibility to user to interact with the palette, and then it's just the palette that takes care of all the liquid staking of the token. Before it was like pretty complicated, not complicated, but I would say long, the whole process of liquid staking on Polkadot. We wanted to make it smoother for everyone that is maybe not like a genius with a computer and doesn't have like the capacity to run, I don't know, code or go through any kind of smart contract, in order to access the product in the easiest way possible, and the palette does all the work for them actually.
I just want one last point on like the node operator, like at-home validator performance. I think this is something that the community is constantly innovating on, because we kind of saw this play back a couple years ago with MEV being this like centralizing force, and this fear that like that will completely centralize the validator set because of the economies of scales you get with MEV. And then now we see things like MEV Boost as software coming out that allows like at-home stakers to earn as much as like professional nodes in terms of in MEV. And so I think on that note, like, actually, yesterday, Drew from Brevin Howard Vanderwerth released some research that I collaborated with him on for an optimistic delegation framework. The idea being, as we move into this eigenlayer-centric world, there's going to be a lot of these different restaking services that are kind of too heavy for at-home stakers to run. And this being like a sidecar similar to MEV Boost to allow these at-home stakers to benefit from these yield opportunities without actually like running it themselves, like delegating it to someone else. So on that note, I just think that like the community will continue to produce these like innovations to help the at-home stakers compete.
Yeah, for sure. I think it's a good point to make. I think it's come a long way and very optimistic that we'll get there. I guess on that point, you kind of did mention a little bit about restaking. Maybe we can dive into that a little bit and just, I guess, broadly some innovation that we expect to see within the space over the next year. I would think restaking is one of them. So maybe if you want to just kick it off and give us a bit of context.
Yeah, for sure. I think it's going to be a very mixed year, I think. Like we're seeing EIP 7514 is going to be released in the next update, and that's really going to slow the number of validators that are able to join the beacon chain. And this is going to really put a halt on the growth of new and existing protocols. So I think putting that next to like maybe the market is heating up, and that kind of means more execution rewards and MEV for validators and more interest in staking. And so those two dynamics kind of contrast with each other. And when you layer on EigenLayer coming to market, like I think they're planning for Q1 or Q2 next year, that's like another source of yield for these validators and more interest in the actual staking side of things. So yeah, definitely like all these dynamics are kind of working against each other. It's kind of interesting to see how it's going to play out.
I have less of an opinion on EigenLayer. Kind of waiting to see how it will play out. I'm not sure if the restaking narrative will fully take off as everyone is kind of expecting it to. I think there's a lot of synergy possible between restaking and LSTs, but that's kind of where my opinion ends on this.
Can you steel man the other side of the argument?
Sorry.
Can you give us the other side of the argument, I guess, if you want to elaborate on, I guess, what might be are the risks associated with that, or how you see, I guess, that within the stack? And
for me, it's more like what services will have a demand for restaking that I'm looking at, rather than like arguments pro and contra. I'm just like waiting to see like how will this actually be used, by who will this be used, and what will the actual increase in revenue for restaking validators to some of these services be. And I think that will decide a lot of whether this will be viable or not.
No, I completely agree on the restaking view. It is something that, of course, is going to be kind of like under like a light of the first 2 quarters of the next year for sure. Everyone is like talking about it. It's more or less like DVT, as you mentioned 6 months ago, and now is at this stage that we saw today, like with so many protocols and people involved and interested in it. But of course, end of the day, it comes to is like usability, like what kind of benefit does it bring to the ecosystem? On our end, we are trying to implement as much as use cases as possible for users, like stronger, like putting in place a lot of partnerships with protocols within the Polkadot ecosystem and outside the Polkadot ecosystem, like for example EigenLayer, as they mentioned before, in order to expand the use cases of LST at the moment. One of them, of course, it could be like the possible of restaking from validators, but the others are like using this token as they are, like in our case, standardized token. They can be used seamlessly cross-chain, and it's basically at that point is up to the user to decide what kind of like, what is the best use of their LST without like put too many strain on that from our side. So I'm pretty curious actually of the outcome. I'm pretty confident that it's going to be an interesting outcome.
Yeah, I think so. Whenever there's more yield involved, I think it really drives people to try to figure out innovative ways to work with it. So I think we'll maybe see some innovation driven by that side.
No, yeah, it just it's obviously it's liquid staking. One of its like, of course, pinpoint is the yield, but it's also like what can you do with your liquidity that is unlocked thanks of your liquid staking, because you are contributing to the security of the chain, liquid staking your token on the proof of stake chain, But then in the meantime, you can use it, I don't know, as a collateral on a particular parachain. I'm saying parachain because I'm thinking about Polkadot, but I would say blockchain. Or like as part of a lending and borrowing strategy. Basically, it opens up a world of possibilities that basically, like, if you think about it, only 2 years ago, it wasn't even like, possible to think about it. And this is what I really like about this ecosystem that is moving so fast. And what is new now, in a year, it's going to be something that has been developed by thousands of people and built on by hundreds of protocols. So I'm confident, I told you.
Yeah, for sure. As we're kind of wrapping up here, I think I want to just give each of our panelists just the opportunity to kind of give us a look ahead into next year, anything that we kind of missed, where you see the landscape moving to, and just give us a bit of insights on what we can expect.
Yeah, I can take that. So again, yeah, I'm going to keep talking about restaking. I think that's like a big narrative. I think I'm really excited to see how all of these DVT protocols like OBOL, SSV, they're now at mainnet phase, and we can really see how that performance plays out over like a wider time span on like the actual mainnet. And I guess with Puffer, we're doing a lot of anti-slashing hardware, and we're trying to release different hardware modules there to diversify on that front. And I'm really excited about the actual interplay and composability between DVT and these anti-slashers as like, I guess, a super anti-slasher. Yeah, but yeah, I guess it's my 2024 forecast.
I'm looking forward to see more decentralization and credible neutrality in liquid staking in the coming months. I think our validator-specific approach could definitely contribute to that. It is something that, as you mentioned, is definitely a path of more resistance than going along with the current trend. But we are seeing real demand for it from validators and their clients. And if it takes off, I think it could also drive a big change in how liquid staking integrations with DeFi and other things look like. Oh, by the way, our testnet is live at cooking.tenderize.me. Go check it out.
No, yeah, on our side, like for the next year, we are focusing on like more or less what has been discussed today. Plus, I want to mention that we are also looking into the DVT solution with our partner SSV Network, which by chance they were like just close by our booth today. And in general, like being, as Bifrost used to call itself, like omni-chain liquid staking, our main goal is to bring liquid staking on more chain. Like, for example, we have on the roadmap, if you can see on our website, like Cosmos and even Polygon, actually. And allow users to actually use those standardized assets freely cross-chain. Now, maybe in the next month, we will see like the Snow Bridge, which will be like a very interesting tool to connect Polkadot and Ethereum and like, access both ecosystems from like both sides. It would be very beneficial for Ethereum users that are gonna experience more use cases on Polkadot, and for Polkadot users that can benefit from the liquidity presence on Ethereum. So it's very busy. It's interesting. I can't wait for that. And congrats for the mainnet.
I have one more thing to add to what you also mentioned. I hope liquid staking or the discussions around staking next year evolve a little bit or revolve a little less around only ETH, but also take into account Polygon and other networks, for example, physical infrastructure networks like Livepeer, the Graph, that have been around for a while, that have staking for their node operator sets, and are providing value-added services to the community for quite a while now. So.
Yeah, I think I would agree with everything said here. Very focused on restaking broadly. I'm very curious to see how that starts to evolve. I guess our ETH is launching as a natively restaked token very shortly. So I'm excited to see that get to market. And then also on the DVT side, starting to onboard more solo stakers, starting to see this technology become something that we can rely on, and see how this community just continues to build itself up and help one another. So yeah, thank you everybody. That's all we have.
We've got one small thing, just one more thing, right? Like Steve Jobs always said. It is an announcement, so you might want to stick around. It's from the Staking Rewards team. But first of all, can we give a big applause for the Staking Rewards team for organizing this? They've been really doing a great job. Thank you guys so much. This is so much fun. Really looking forward to tomorrow as well. So yeah, without further ado, let's welcome the team from Staking Rewards and also QuantStamp and see what they have to share with us today.
All right, this is exciting. So what we're going to announce today is the Verified Staking Provider Pro. And I just want to start giving a quick introduction to like the Verified Staking Provider program, which we launched in 1.5 years ago around. Do we have like the clipper actually for the slides? I don't think so. All right, we're just waiting for this. But anyway, so the Verified Staking Provider program, we started it 1.5 years ago, just as a way for stakers on our website to have an easier way of choosing trusted staking providers. We're doing due diligence checks with them. So it's basically a questionnaire of like 55 questions, and we are making sure that the staking providers that we verify are very serious about the business, because sometimes it's hard verifying from just on-chain operations and seeing if they are like also trustworthy in the future. So we are looking at business operations, looking at their security setup and reliability, and really making sure that they're not going to pivot. So we want to make sure the staking providers that come to our website as verified are very, very serious about their business, and our users can be confident in staking with them. And as a, yeah, so basically currently we have like 56 staking providers on the program. It's a total AUM of like 36 billion combined of all the verified staking providers. So it's a growing initiative. We've made loads of progress. And it does help the staking industry to kind of have a standard, a verification standard that helps all kinds of investors from retail to institution to understand which staking providers are following best practices. And then they can be like have a short list of staking providers where they know, okay, these are trusted, verified by an independent party like Staking Rewards. And basically, yeah, Chris can go deeper into the program as well. And then we're going to talk about the VSP Pro, which brings the whole thing to a next level, basically, with an added audit as well.
So maybe we can go also one slide back, if this is possible. So just want to talk about the program at all. So at the moment, like over 56 verified staking providers on the program, and we focus on the beginning on POS providers, and now expanding into liquid staking, which is also like a big opportunity also for the VSP Pro, because like our partners are also like experts in this field. And at the moment we have like 36.5 billion assets under verification, which might be a bit outdated after the current market conditions, right? So it's more like 40 billion. So, and we are really proud on this. And yeah, more than 2.5 million stakers are trusting the program and staking with VSPs. So talking a bit about the benefits the VSP delivers for users. So it's not only a tag on staking rewards, it's more like a proof that you run transparent, honest, and sustainable operations. The tag is then seen on staking rewards, which has more like 300K users, but also on a lot of different third-party explorers. So you can see the tag on Suiscan, Minascan, Avascan, Mintscan, and a lot more. And also I want to mention here, like a call to action for all VSPs, if you know an explorer where VSPs are not shown at the moment, yeah, please bring us in comms with them or just mention the VSP so that we get this integrated in every main explorer on this world. So next to this, the VSP tag is also used in our staking data API. So big industry players like Coinbase, Binance, as well as Bloomberg are using it to highlight and to show trusted verified providers. So this helps the users then of Bloomberg to find these, and to stake with them basically. Okay, let's go to the announcement, to our VS Pro announcement. Basically, you can see it as a joint venture between Staking Rewards and on the other side, QuantStamp. So this joint venture should strengthen the VSP, make it more reliable, more robust, and more data-driven as well. So QuantStamp is there by taking the job over of the real audit part, and I would hand it over to Sebastian to talk about the program a bit more.
Thank you so much. Yeah, we basically were super excited when we first found out about the VSP program for staking providers, because we really thought something like that will make a big difference. And we looked into it, we looked at how this is being done, and we thought, oh, maybe we can come up with something that complements this process. And given that we're typically doing smart contract audits, infrastructure audits, and pen testing at our company, we thought, oh, we could look at staking providers if they have the technical countermeasures in place to prevent slashing events. And this is what we're doing as part of VSP Pro. We're offering a QuantStamp audit that focuses on slashing prevention. So we're going to generate a report similar to what you're used to seeing from QuantStamp, which mainly consists of findings related to slashing. For instance, one really classical example that we've probably seen just a few weeks ago being sort of exploited was the lack of persistence in an anti-slashing database, right? Or improper key management, or having your validators accessible from the open internet. Things like that are things that we would put in an audit, and once the validators have fixed these issues, we're going to verify by getting read-only access that these issues have been fixed, and that's when you will get the VSP Pro. I'll hand it over to Krishna to say a few words more.
Yeah, I think to add a bit of context here, we also have a licensed insurance subsidiary called Chainproof. And Chainproof insurance will be offered to anyone who is a VSP Pro validator. And it is a fully licensed insurance product, which is basically has full reinsurance from Munich Re, which is the world's largest reinsurer. And we see this as an additional benefit that validators can provide to their users or asset managers who are using their platform. We really sort of started this insurance initiative to help raise the standard of trust in the ecosystem. And I think that together with VSP Pro, we can really sort of raise the bar on what it means for both users and asset managers to have a really safe experience when staking in the ecosystem, right? And I also want to say it's been super awesome being here at Staking Summit, and it's really my first time interacting with many people from the staking community, and Mirko and team have sort of put an amazing group of people together. And unlike many other communities, the staking community is very positive sum. So I hope we can all work together in the coming years to raise the bar for security and safety in the staking space as we onboard millions and millions of users and billions of dollars of capital into the space.
Amazing. Yeah, so in that sense, I think, speaking on behalf of all of us, we're very excited to get the VSP Pro out. We have 2 providers so far that are verified and audited, which is KEYNOTE and Lucrative. And also, if anyone wants to be part of the VSP Pro, I think it's a great initiative for anyone to show trust to the industry, to institutional clients. It's like, that's how we see that like you can really level up, like similar to like ISO certification and so on. Will the VSP Pro be like an indication of, okay, this provider is very serious and they're audited in the sense that like an insurance provider is very happy from like the infrastructure setup. And yeah, we are very excited to push the bar and together make staking safer for everyone. So we can onboard lots of institutions to the staking space.
I also want to add, if you want to talk about it, find any members of the Staking Rewards team or the Chainproof team as well. So Sebi, myself, maybe Tyler and Peter from our team are in the audience. They can raise their hands too. But you can find any of us, and we're more than happy to talk to you and talk about the product and answer any questions that you have. And you can also go to, obviously, just reach out directly to the Staking Rewards team too.
Amazing, yeah. Thank you very much. And just like to close this off, this is the last session now. We're going to have a validator meetup for all the validators under you. It's going to be in Wagamama, just like 5 minutes walk from here. It is probably packed, but yeah, if you're a validator, like there shouldn't be an issue for you to get in. And then we're gonna close the stage for today and gonna reopen tomorrow morning at 9 a.m. and looking forward to the second day.
All right.
Awesome.
Thank you, guys. Amazing.
Okay, that about does it, folks. We're wrapping up for today, but thank you for joining us, and we'll be back again tomorrow, and can't wait to see you all. Enjoy your evening. For those of you that are going to the Validator dinner, it's at Wagamama's. If you are accepted for the event, then I'll see you over there. Thank you so much.